So the first thing that we need to know is the effective date of implementation of GST in India is with effect from 1/7/2017. How GST is formed? By subsuming various old indirect taxes. What are those old indirect taxes which got subsumed? So indirect taxes levied by central government. What are they? Excise duty, service tax, central sales tax got subsumed into GST. So CST, central sales tax, even though levied by central government, but it is collected and retained by the state government. So CST revenue will go to state government, and now CST got subsumed into GST. And customs duty is outside the ambit of GST. Customs duty is not covered under GST. So on import and export, we have still customs duty. However, we have some additional customs duties called as CVD and SAD to counterbalance excise duty and sales tax. As excise duty and sales tax got subsumed into GST, CVD and SAD also got subsumed into GST. And state government specified indirect taxes only got subsumed into GST. What are those specified indirect taxes levied by state government? Value added tax, advertisement tax, luxury tax, entertainment tax, betting tax, purchase tax, also known as octroi. Only these 6 indirect taxes levied by state government got subsumed into GST. Apart from these 6, any other indirect taxes levied by state government like professional tax, local body tax, mandi tax, etc., or corporation tax not got subsumed into GST. Even taxes levied by local authority like entertainment tax is levied by local authority also, but that entertainment tax not got subsumed. But we have entertainment tax levied by state government that got subsumed into GST, but local authority levy is not got subsumed into GST. And India follows which model? Dual GST model. Dual GST model means what? Both central government and state government parallelly levy GST on the common tax base, that is dual GST model. And this dual GST model is incorporated in the Constitution 101st Amendment Act 2016. So for the purpose of bringing GST, they have made a Constitution amendment, and that Constitution amendment happened in which year? 2016. But the GST is implemented from 2017. And India adopted this dual GST model from Brazil and Canada, where both central government and state government have power to levy on the common tax base, that is on the value. Then there is something called as GST Council, which is a decision making body of GST. So as per Article 279A of the Constitution, so this GST Council is constituted by President of India. Who will be there in this GST Council? Union Finance Minister will be its chairman, and state finance ministers and MPs, like MP of State Affairs in charge of revenue or its members. So total there will be 33 members, 1 Union Finance Minister, and for 5 Union territories 1 Union MP, and for 31 states there will be 31 MLAs. So they will be there. And how 31 states? We have 28 states plus 3 Union territories with state legislature, that is Delhi, Jammu and Kashmir and Puducherry. And next, so total 33 members. What is a quorum? 50% is the quorum, 50%. So 50% means what? 33 into 50%. So there should be 16.5, that will be 17 members should be there, but 50% you remember. And in that voting, central government vote will have a 1/3 weight and state government vote will have 2/3 weight, and they need to have a weighted majority. So in order to take any decision, what is the weighted majority that is required? 3/4 of the weighted majority that is required. And basically it is a decision making body of GST. And what are the various types of GSTs that we have? So we have CGST. CGST full form Central Goods and Services Tax levied by central government. On which supply? Intra-state supply. Same way SGST levied by state government. So SGST full form State Goods and Services Tax levied by state government. On what supply? Again intra-state supply. So whenever the supply takes place within the state, it will be CGST plus SGST. Whenever the supply takes place within the union, like within the union territory, then it will be called as CGST plus UTGST. UTGST is Union Territory Goods and Services Tax. So it is on intra-state supply within the union territory, but it is levied by the central government. And this is applicable, for union territories without state legislature. What if it is a union territory with state legislature? That is 3 union territories with state legislature. It will be SGST Act only that will be applicable there. And IGST is Integrated Goods and Services Tax. On which sale or which supply? Interstate supply levied by central government. But in this IGST, what happens? So 50% will go to the consuming state based on place of supply. And there is something called as GST compensation cess. It will be levied on notified goods to central government, and this money is collected by central government, not retained completely by the central government. It will be given to the states for the purpose of compensating the loss of revenue to the states on account of implementation of GST. And this GST compensation is not on all goods, only on notified goods, and it will be levied up to one date. What is the date? 31/3/2026 it will be levied at present. and it may be extended in future. And IGST levied by central government, and 50% out of that is transferred to state based on place of supply. What if place of supply cannot be ascertained? If place of supply cannot be ascertained, it will be given to the consuming state. Now, what is the importance of place of supply? So, in order to classify a transaction into intrastate or interstate, place of supply is relevant. So, intrastate means what? If location of supplier and place of supply is in the same state, it is intrastate. If location of supplier and place of supply is in two different states or two different union territories, a state and a union territory, then it will be coming under interstate supply. So, what are the two factors? Location of supplier and place of supply. So, in the question we need to check the location of supplier, and then we need to determine the place of supply. Then we will know whether it is intrastate or interstate, which is given in section 7 of IGST Act and section 8 of IGST Act. You need to remember the section number also, because in the updated syllabus, so these IGST provisions are also made applicable for you. So, section 7 of IGST interstate, section 8 of IGST intrastate. Then generally location of recipient is considered as the place of supply, that is general provisions. So, in place of supply chapter we will again see that. So, the general provision is location of recipient, but we have some specific provisions also. Then there is something called as zero rated supplies. Zero rated supplies means what? Export of goods or services or supply of goods or services to special economic zone is known as zero rated supplies. And why is it called as zero rated supplies? Because the burden will become zero. So, whether GST is paid on inward supply? Yes. So, when my outward supply is zero rated, I will have some inward supply on which I will pay GST and I can avail it as ITC. And on my outward supplies, I have two options. Option 1, I will not pay any GST or I will pay GST. Option 1, I will pay GST on outward supply by utilizing the ITC and I will get refund. First, I will pay GST and I will get the refund of it. And second option is I will not pay GST on outward supply, but on my inward supply, whatever GST I have paid, I will get the refund of that ITC with respect to inputs and input services. Then we have state of Jammu and Kashmir divided into two union territories, that is Union Territory of Jammu and Kashmir and Union Territory of Ladakh. Union Territory of Ladakh is union territory without state legislature. So, the GST that is applicable there will be UT GST. Whereas Jammu and Kashmir, Union Territory of Jammu and Kashmir is union territory with state legislature, and the type of GST that is applicable there will be SGST. And Union Territory of Dadra and Nagar Haveli and Union Territory of Daman and Diu got merged into a single union territory, so that will be considered as one union territory only. Then there is something called as GST network. So, basically GST network, section 146 of CGST Act, it provides information technology infrastructure for the purpose of implementation of GST, and it is referred to as common portal, and it provides services to whom? Central government, state government, taxpayers and other stakeholders. And basically what are the activities that can be done through the GST portal? We can do registration, we can do filing of returns, and we can pay the taxes, settlement of IGST, e-way bill. These are the various activities. Then the next area we are moving on to is supply under GST. Supply under GST is the taxable event. So, every time whether the GST is applicable or not depends upon whether a transaction is supply or not. Supply is defined under section 7 of CGST Act. Section 7 of IGST Act is interstate supply. Section 8 of IGST Act is intrastate supply. But this section 7 of CGST Act is meaning of supply. And supply, 7 subsection 1 is inclusion in supply, 7 subsection 2 is exclusion from supply. So, whenever we are referring to 7 exclusion from supply, we need to write 7 subsection 2 read with schedule 3. And whenever we are telling that it is including supply, we need to write 7 subsection 1. And 7 subsection 1a is classification of supply into goods or services. And 7 subsection 3 we don't have at present. So, government is having power to reclassify supply of goods into supply of service and vice versa, but they have not done anything at present. So, therefore, 7 subsection 3 is not there. And 7 subsection 1 supply includes. So, we have total 4 clauses. 7(1)(a), any activity for consideration in the course or furtherance of business. First, there should be any activity, and that should be in the for a consideration, and that should be in the course or furtherance of business. So, between any person, then it will become supply under 7(1)(a), whereas 7(1)(aa) is not between any two independent parties, it is between a person other than individual and its members. Person other than individual means HUF, AOP, company, partnership firm, etc., and its members. So, partnership firm and partners. company and its shareholders, or HUF and its co-partners. Between them, if there is any transaction, then 7(1)(a) will be applicable. Any activity between a person other than individual and its members, but this should be for a consideration. 7(1)(b) is import of services. That import of services should be for a consideration, and that should be whether or not in the course or furtherance of business. It may or may not be in the course or furtherance of business. Example, Netflix, Amazon Prime, Zoom, cloud storage, all these are import of service, not in the course or furtherance of business. Even then it will become supply under 7(1)(b). 7(1)(c), there are 4 activities which are given in schedule 1. These 4 activities can be remembered in an easy way. DRIP, DRIP. D for disposal of business asset on which ITC is availed, and that is, we have purchased some business asset on which ITC is availed, and that business asset is disposed of without any consideration. That disposal may or may not be in the course or furtherance of business. Then R for related party transaction, including transaction between distinct persons. Then I for import of services. From whom? From a related person or from a establishment located outside India. Our establishment located outside India, and that should be in the course or furtherance of business. P for principal agent transaction. That principal agent transaction should be only for goods, not for services, and these 4 activities are treated as supply even though without consideration. And first we need to check if an activity is covered under 7 subsection 2. If it is covered under 7 subsection 2, it is not a supply. If the activity is not covered under 7 subsection 2, then you need to refer to 7 subsection 1, inclusions. If it is covered under inclusion, then it is supply. Otherwise, it is not a supply. If an activity is not covered under 7(2), then 7(1) should be checked. If the activity is not in 7(1) also, then the activity is not a supply. Then 7 subsection 2 talks about exclusion from the supply. So supply excludes. What are the activities? We need to read with schedule 3. So spalled slow. S for sovereign functions of the government. Sovereign functions of government means all activities of government other than 4. That is transportation of goods or passengers, post department of post services, airport or port service, and services to business entities. Means these 4 activities are only covered as supply, and all other activities are excluded from supply. Then post. Post refers to government post, constitutional post, and nominated post. And government post, for example, MLAs, MPs, constitutional post will be so like governors, president, and nominated post. So we have some body, and the head of that body like SEBI chairman or RBI governor appointed by government, that is nominated post. So whatever remuneration that they receive is excluded from supply. Then actionable claim other than specified actionable claim. So what are the specified actionable claim? Other than specified actionable claim. Other than specified actionable claims. So what are considered as specified actionable claims? So HC blog are considered as specified actionable claim. H for what? Horse racing. C for what? Casinos. B for betting. L for lottery. O for online gaming, and G for gambling. So these are only covered under supply, but all other actionable claims are excluded from supply. So H for what? HC blog. H for horse racing. H for horse racing. Horse racing, and C for casinos, and B for betting, L for lottery, O for online gaming, then G for gambling. So these are the activities which are covered under supply now. All other actionable claims are excluded from supply. And next, L for legal fees collected by court or tribunal. So court or tribunal collecting some fees will be excluded from supply. Then next L will be land sale, including sale of building, where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier, which means I am selling land, that is excluded from supply. Building also excluded from supply. But when building is excluded from supply, when the entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. What if consideration is received before completion certificate? It is covered under supply. What if part consideration before and part consideration after? Then also it is covered under supply. Only if entire consideration is after completion certificate or first occupation, whichever is earlier, then it is excluded from supply. First occupation means the day on which the property is occupied first. Completion certificate means a certificate which we get from the Urban Development Authority. Then next one, E for employee to employer in the course of employment. So there is an employee who is providing service to the employer in the course of employment, that is excluded from supply. And D for death related, that is funeral, burial, crematorium, mortuary, all post death activities also excluded from supply. Spalled slow. S for sale before import. So when the goods are in transit, I transfer the document of title to some other person. That some other person will only clear the goods from the customs. So my sale is excluded from supply. And then L for liquor license. Who will grant this liquor license? By the state government. O for outside the country movement of goods. So goods starting point outside India, ending point outside India. So that will be excluded from supply. And W, warehoused goods under customs. That is, goods are imported and deposited in the warehouse without payment of customs duty. I transfer the documents to some other person. That some other person clears and pays customs duty. So I am excluded from supply. That is known as sale of warehoused goods under customs. So these activities are excluded from supply. And next we have two special points in this regard. Gifts by employer to employee. So whenever employer is giving a gift to the employee, so we need to check, is this gift or perquisite? If it is a perquisite, it will be covered under salary offer document. So if it is covered under salary offer document, it will be part of salary. It will not be treated as supply. If it is not covered under salary offer document, then it will be called as a gift. So gift, we have exclusion up to 50,000. So gift by employer to employee per annum, we need to see how much it is. Less than or equals to 50,000, not a supply. What if it exceeds 50,000, entire gift value, for example 53,000, entire 53,000 will be treated as supply under 71C. So why it is 71C? Because employer and employer are treated as related parties. Then next, specified actionable claim, HC block, horse racing, casinos, betting, lottery, online gaming, including online money gaming and gambling. So these are the specified actionable claims which are covered under supply now at present. Then sale of land. So usually we will be purchasing a land and we will do the development. After development, we will be selling the land. So now in that case, whether that sale of developed land is also excluded from supply? Yes. But what if we collect some amount towards the development charges? Say land value is 2,000 rupees per square feet and development charges is 1,000 rupees per square feet. So 2,000 rupees per square feet land is excluded from supply. But towards the development charges, we are collecting 1,000 rupees. That will be covered under supply. We don't have any exclusion with respect to that. So sale of land after some development such as leveling, laying down drainage lines, electricity lines, etc. is also sale of land and is excluded from supply. However, services provided for development of land is not excluded from supply and shall attract GST. Then perquisite. The difference between gift and perquisite is the perquisite is mentioned in the offer document, but the gift is not mentioned in the offer document. If the perquisite is mentioned in the offer document, and it will not be subject to GST because perquisite will be added to salary and salary is excluded from GST. Then this is summary of 7 subsection 1. First we need to see 7.1a, nature of activity. Any activity, consideration should be there in the course or furtherance of business. From whose point of view? Supplier point of view. 7.1aa, activity between person other than individual and its members. Consideration, yes. Course or furtherance of business also, yes. Point of view, supplier. 7.1b, import of services. Consideration, yes. It may or may not be in the course or furtherance of business and it should be seen. Always import of service should be seen from the recipient point of view. The rest of the transactions and all will be from supplier point of view. 7.1c, D, disposal of business asset. So R and IP, all these cases consideration is not required. In case of disposal of business asset, that disposal may be in the course or furtherance of business or not in the course or furtherance of business, it will come, and from supplier point of view, and rest 3 should be in the course or furtherance of business. Wherever we have import of service, that should be from recipient point of view. And next we have some important definitions. So meaning of goods and services. Goods is defined under, all the definitions are in section 2. You just remember section 2. So goods means what? Any kind of movable property. Immobile property will not come under goods, and goods includes 2 things: actionable claims or growing crops and things attached to or forming part of land agreed to be severed. Severed means cut before supply or under a contract of supply, and it excludes money and securities. Even service definition also excludes money and securities. Services means anything other than goods. And as money is excluded from both goods and services, but if there is a transaction in money for a separate consideration, then it will be treated as service. So then facilitating or arranging transaction in securities. Only sale of securities is excluded from supply, but facilitating or arranging transaction in securities like stockbroker service or depository service will be covered under services. And next we have actionable claims. Actionable claims means an instrument which satisfies 4 conditions. First, you should have a right to receive a benefit or recover a debt that is transferable and legally enforceable, and the holder of such right is entitled to receive the benefit or recover the debt. Example, bill of exchange, promissory note, lottery ticket, etc. These are some actionable claims, but not all actionable claims are covered under supply. First, actionable claims which are covered under money definition are neither goods nor services, that is bill of exchange, promissory note, etc. These are covered under money definition, so neither goods nor services. But other actionable claims we have treated as goods, but in that also only specified actionable claims are treated as supply and others are not treated as supply. Then, so these important points related to specified actionable claims, we need to know what is the meaning of online gaming. So online gaming, so means basically offering a game on the internet or an electronic network includes online money gaming. So whenever we play the game over the internet, so we need to spend some money for that. That will be called as online gaming. Whereas online money gaming means we deposit some money, we use that money for playing the game by betting the game. For example, Dream11, Rummy Circle, these are all examples of online money gaming. Online gaming means a normal game where we spend money to play the game. Whereas online money gaming, we spend the money by way of betting. So that is Dream11, etc. will be coming under online money gaming. So both are covered under specified actionable claims. Online money gaming will be treated as goods, whereas online gaming will be treated as service, OIDR services. That is what important point you need to remember. So online gaming will be treated as OIDR services, whereas online money gaming will be treated as goods. Okay. And next, basically in online money gaming, what will happen? You will deposit the money. For what purpose you will deposit the money? To make a betting. So here, whether or not the outcome of performance is based on skill, chance, or both, which means that betting involves skill, or that betting involves chance, or that betting involves both. But it will be coming under online money gaming. Online money gaming is treated as what? Goods. Is treated as goods. Whereas online gaming is treated as services. The two what services? Treated as OIDAR services. Next one, money means what? Money means Indian currency or foreign currency or any instrument recognized by RBI, but money excludes. So cryptocurrency, like money excludes any currency which is not in circulation, currency held for numismatic value. So whether cryptocurrency and sale of gold coins is treated as supply of goods? Yes. Why? Because cryptocurrency is not an instrument recognized by RBI, so therefore it is not money, and sale of cryptocurrency attracts supply of goods. Same way sale of gold coins. Gold coins is excluded from the meaning of money, so due to that reason it will also be treated as supply of goods. Then next definition, consideration. Consideration includes and consideration excludes. Consideration includes two, either monetary or non-monetary consideration, and monetary means something received or receivable, non-monetary can be in the form of goods or services. But consideration excludes what? Subsidy. Subsidy from whom? Subsidy from central government or state government, or refundable security deposit. These two are excluded from consideration. From whom we should receive the consideration? Either from recipient or from any person. So presence of consideration is only relevant, and consideration should be in respect of, in response to, or for inducement of supply of goods or services. Then suppose if there is any activity without consideration, or there is a consideration without any activity, it will not be coming under supply 7(1)(a), because in order to become supply under 7(1)(a), there should be activity for consideration. What is the meaning of consideration without any activity? Donations. So the donations are divided into two, conditional and unconditional donation. Conditional donation means what? You are giving me money, in return I need to do something in return for you. So that is conditional donation. So I am doing some activity against that money. So the conditional donation is treated as consideration, and this activity will become supply under 7(1)(a). Unconditional donation means you are giving me some donation and I don't have any obligation to do anything in return for you. That is called as unconditional donation. That is not treated as consideration, and it is not a supply. What about display of donor's name in the premises? Whenever we display the donor's name, is it required by the donor or not required by the donor? So not required by the donor. You don't want your name to be displayed, but as a gratitude I displayed the name. What name I displayed? If I display a business name, means that gives you a business advantage, means I am promoting your business, so it will become supply under 7(1)(a). Suppose if the display of name is not giving you any business advantage, then in that case I am not promoting any business of yours, so therefore it will not be treated as supply. So display of name, business name displayed, supply under 7(1)(a). Display of name does not result into business advantage, not a supply. Then meaning of person. Person is defined under section 2 clause 84, and person under income tax plus person under GST difference is what? Central government and state government. What is person under income tax? Individual, HUF, AOP, BOI, company, cooperative society, artificial juridical person will come under person under income tax act, plus central government, state government is person under GST, even government is also person under GST. Then meaning of business. So business we have a general meaning. So in the general meaning we have trade, commerce, manufacture, then profession, occasion, adventure, or wager, any other similar activity. So these 7 activities will be coming under the general meaning of business, and this may be So irrespective of the volume, frequency, continuity or regularity, incidental or ancillary, so it's also covered under the meaning of business. But there are some specific activities which will always be treated as business. That is, when the time of commencement of business or closure of business, if you supply any goods or services, that will be coming under business. Then provision of services or facilities by club association to its members. Example, maintenance charges collected by resident welfare association. Then admission for a consideration, entry tickets will come. Service supplied by, that is a person is holding an office which is accepted by him in the course or furtherance of his trade, profession or occasion. So for example, CA becoming central council member, that is also business. And activities of a race club, all activities of a race club including betting transactions. And an activity or transaction undertaken by central government, state government or local authority in which they are engaged as public authorities, that is government activities also will be treated as supply, the business. Okay, so these are all the various points that are covered under the meaning of business. Then we have meaning of related. So meaning of business is not that much important because majority of the activities that is covered under business. So therefore in exam easily by reading the question itself you will know whether it is business or not business. Only personal activities will not be treated as business. Whereas related definition we need to understand. Total 9 points we have in related definition. Point number 1, such persons or officers or directors of one another's business, which means that I am appointed as officer in your business, you are appointed as officer in my business, now we both are treated as related. Number 2, they are legally recognized partners of a firm. So partners of a firm will be related, but the firm and partners are not related, only partners of a firm are related. Number 3, employer and employee are always treated as related. These are the first 3 points. Then next one, so related to control. So there are two companies having a common shareholder. That common shareholder should be holding how much? 25% or more. Now these two companies will be treated as related. Then control, one company controls the another. Control means what? Either investment more than 50% or majority common board of directors or controlling by way of operations. And next point is that they are under the common control of a third person. There are two subsidiary companies and having a same holding company. So definitely these two subsidiary companies are also treated as related because these two companies are under the common control of a third person. And next 3 points, so special cases, that is both of them directly or indirectly controls a third person. For example, two shareholders together controls more than 50% of the equity of the company. Now these two shareholders will be treated as related. And next point, they are members of the same family, and family is defined. What is the meaning of family? Spouse and children. Spouse and children, whether or not dependent. Whereas brothers, sisters, parents, grandparents, if they are wholly and mainly dependent on that person, then only they will come under family. And next one, 9th one, sole selling agent. Sole selling agent means there is only one agent and all the activities will be happening through that agent only, and that sole selling agent is also treated as related. So total 9 points we have in related definition that we need to remember, and we have to apply this in the exam. So next one, meaning of various supplies. So taxable supply means what? Balancing figure actually. So we have zero rated supply. Zero rated supply given under section 16 of IGST Act. Zero rated means what? Export of goods or service or supply of goods or services to SEZ. And non-taxable supply means what? 3 things will come under non-taxable supply. So which are not leviable to GST. So 2 things actually. So what are not leviable to GST? Alcoholic liquor for human consumption and petroleum products. What are the petroleum products that we have? Crude oil, petrol, diesel, aviation turbine fuel and natural gas. So alcoholic liquor for human consumption and petroleum products are treated as non-taxable supplies. Exempted supplies means what? Notified as exempted from time to time. Nil rated supplies and non-taxable supplies. These 3 will come under exempted supplies. So the balancing figure which are leviable to GST is known as taxable supply. So supply of goods or services divided into 2. Chargeable to GST, that is GST payable, or not chargeable to GST, GST not payable. If GST payable, it is called as taxable supply. If GST is not payable, why GST not payable? Maybe it is leviable to GST but it is nil rated. So nil rated means the rate of GST is nil, or notified for non-payment, or it is not at all leviable to GST, that is non-taxable. These 3 will come under exempted. So the balancing figure is only taxable. And all these 4 should be included in the meaning of aggregate turnover. In aggregate turnover, we need to take taxable supply, exempted supplies, then non-taxable supplies, even zero rated supplies, exports, etc. So usually aggregate turnover is computed on what basis? All India basis. So if I have business across the country, all the businesses, all the supplies should be taken together. That is called as aggregate turnover. But two important points. Aggregate turnover excludes inward supplies, because basically turnover means outward supply. So even though you have some inward supply on which you need to pay GST and RCM, that will not be taken into aggregate turnover. Even taxes, CGST, SGST, only CGST, SGST. What about the old indirect taxes? Suppose if excise duty and VAT is there, will it be added to aggregate turnover? Yes, it will be added to aggregate turnover. But GST alone will be excluded from the aggregate turnover. Then GST on sale of flats or buildings, already we have seen. If entire consideration is received before completion certificate, is it covered under supply? Yes, and GST payable, and it will be treated as works contract service. If entire consideration is received after obtaining completion certificate, is it covered under supply or not? No, it is excluded from supply and no GST, because it is sale of immovable property. If part consideration before and remaining money after, is it covered under supply? Yes, entire amount is covered under supply, and we need to pay GST on the entire amount, and it will be treated as works contract. And first occupation means date on which the flat is occupied by the buyer in the project, it is deemed as completion, and whatever remaining flats unbooked will be excluded from supply. And works contract means what? Works contract means a contract involving both supply of goods as well as services. For example, I am constructing a building. While constructing a building, I will only supply the cement, bricks, etc. required for construction. I will only do the construction activity. So for a single consideration, then it will be called as works contract. Works contract should always be treated as service. Meaning of job work. Job work means what? Carrying out process on the goods belonging to other person. So you are giving me some raw material. On the raw material, if I do the process, then the activity is called as job work. For example, you are giving me cloth and I am doing the stitching, then the activity is called as job work. And next, meaning of distinct person. So distinct person means one registration of a person to the other registration is known as distinct person. Why a person will have more than one registration? If they are doing business in different states, definitely they need to get two separate registrations. If they are doing business in the same state but in different place of business, they have an option. Either they can go for single registration or they can go for separate registration. If they go for separate registration within the state itself for multiple places of business, one place of business to another place of business will be treated as distinct person. But between the states, we don't have an option. Always we need to get separate registration in each and every state. So another establishment in another state, whether registered or not, is also treated as distinct person. For example, I have establishment in another state that is engaged in exempted supply. So I have not registered that. Even that will also be distinct person? Yes. So there are two meanings of distinct person. Number one registration to the other registration, or one registration in this state to other registration in the to another establishment in the another state, even though not registered, is also treated as distinct person. And meaning of recipient, generally who will be called as recipient? If consideration is involved, the one who is liable to pay consideration is the recipient, not one who is paying consideration. For example, I am providing services to you and you are liable to pay consideration, but you are not paying, some other person is paying, but for me you are only the recipient because you are liable to pay the consideration to me. Whereas consideration is not involved in the transaction, the one to whom we are supplying the goods or the one to whom we are supplying the services. So the person who receives such goods or the person who receives such services will be taken as the recipient. Then once an activity becomes supply, we need to classify that activity into goods or services. So that is given in 7 subsection 1A read with schedule 2. And first we need to see the activity is movable property. If there is a transfer of title, it is supply of goods. If there is a transfer of right to use, it is supply of service. For example, I have a car. If I am selling the car, it is supply of goods. If I am renting out the car, it is treated as supply of services. And this sale of car may be at present or at a future date. Example, hire purchase. In hire purchase, I enter into contract today, I give the possession today, but the title will be transferred at a future date. So it will be treated as supply of goods only. Immovable property will never come under supply of goods, but it will come under supply of service when? If there is a transfer of right to use immovable property, like renting of immovable property or constructing the immovable property, will be coming under services. Then intellectual property rights. If there is a permanent transfer of IPR, so I have a patent that completely I have transferred to you, permanent transfer. Now it is treated as supply of goods. Suppose if it is temporary transfer, it is supply of services. Example, music director composing music for a movie is a temporary transfer. Whatever consideration received will be coming under supply of service. Carrying out process on the goods belonging to other person. So you are supplying the raw material. For example, you are giving me the cloth. I am doing the stitching. This activity is supply of service. So majority of the material given by you, I am doing the process, it is supply of service. Suppose if I only buy the cloth, I only do the stitching and I give, it will be treated as manufacture, supply of goods. If the substantial material required for the process is supplied by the supplier, then it is supply of goods. If the substantial material required for the process is supplied by the recipient, then it will be called as supply of services. Then supply of goods along with supply of services means in the activity there involves both goods and services. If it is notified supplies, what are the notified supplies? Works contract information technology software and supply of food. Works contract, even though it involves both goods and services, it is always supply of services. Information technology software, it involves both goods and services, always services. And then supply of food, food involves both goods and services, but it will always be treated as supply of services. Apart from this, if there is any other activity that involves both goods and services, how we need to classify? We need to check whether it is composite supply or mixed supply. Composite supply, so if the is based on principal supply, if the principal supply is goods, entire activity is treated as goods. Example, AC and installation is composite supply, and principal supply is AC. As AC is goods, entire activity will be treated as goods. And in case the principal supply is service, entire activity is treated as service. For example, coaching and study material is composite supply. In that, coaching is the service and study material is the goods. But the principal supply is what? Service. So entire activity will be treated as supply of service. Suppose if it is a mixed supply, if the highest rate is goods, entire activity is treated as goods. If the highest rate is service, entire activity is treated as service. Example, TV and optional warranty. TV is goods, optional warranty is service. Highest rate is TV, so entirely it is treated as goods only. And then video lectures and pen drive. In video lectures and pen drive, highest rate is for video lectures, service, so entire activity will be treated as supply of service. Then apart from this, any other activity will be coming under doing an act, not doing an act, tolerating an act. Doing an act, so normal, any activity that is being done. Not doing an act, example, non-compete fees. We are collecting some money for not starting a competing business. Then tolerating an act, so that is we are collecting some damages, so from the other person for breach of the contract. So we are tolerating his act of breach, for which we are collecting some damages, that is coming under tolerating an act. Then next one we have composite supply and mixed supply. So when we will apply composite supply, mixed supply, first we need to check whether there are two or more supplies involved in a transaction. Only then composite supply and mixed supply will be coming. If two or more supplies naturally bundle, three conditions should be satisfied for composite supply. What are the three conditions? All the supplies should be taxable, naturally bundled in the ordinary course of business, and principal supply is identifiable. Then it will be called as composite supply. Price may be single or different. If it is composite supply, what we will do? We will take the rate of principal supply and apply it on all all the amounts. Okay. Whereas if any of these three conditions, that is all must be taxable and one of which should be principal supply and it should be naturally bundled in the ordinary course of business. If any one condition is not satisfied, we need to check whether it is a mixed supply or not. To become a mixed supply, only one condition. What is that? It should not be a composite supply and there should be a single price. There should be a single price, then only it will be mixed supply. Suppose if there is no single price, it is not a composite supply, it is not a mixed supply, then it will be coming under individual supplies. We will take respective rate for the respective supplies. So AC and installation is an example of composite supply because all are taxable, naturally bundled in the ordinary course of business, and the principal supply is AC. So it will be treated as supply of AC and the AC rate will be taken on the entire transaction. Same way transportation and insurance, replacement of parts during servicing of vehicles plus labor charges. And then mixed supply, inverter and battery. Why inverter and battery is mixed supply? It is not naturally bundled. What is the meaning of naturally bundled? If one has to be supplied along with the other, then it will be called as naturally bundled. Okay. And suppose if it is like one can be supplied even without the other, then it will be called as not naturally bundled. And renting of building and renting of furniture can be given separately also. Popcorn and Coke also can be given separately also. That's why these three are not treated as naturally bundled. And here we need to see it from the supplier point of view, not from the consumer point of view. For example, inverter and battery, even though from consumer point of view, if you see, without inverter, battery will not work, without battery, inverter will not work. But from the seller point of view only, we need to see that he can sell the inverter separately, he can sell the battery separately, he can sell it together also. That's why it will not come under naturally bundled. Suppose if it is, there are two or more supplies which is not composite supply and not involving single price, then it will be individual supplies and it will be taxable accordingly. So how to determine the taxability here of a transaction or activity? Mainly this will be useful for this 14 marks questions. So first you need to check whether the said activity is supply or not. If the activity is not a supply, GST is not payable. And suppose the activity is supply. So this already I have discussed in the fast track batch also. So we have this flow chart over there. I told you this. So that is, if the activity is not a supply, GST not payable. If the activity is supply, so then we need to check whether it is exempted. So what is the first aspect we need to see? Supply or not. What is the second aspect we need to see? Whether it is exempted or not. What if it is exempted? Then also GST not payable. What if it is not exempted? Then it will be taxable. When it is taxable, then the next aspect is what? Whether it will be FCM or RCM. First we need to check supply, then we need to check exempted supply, then we need to check FCM or RCM. So in that, so RCM, whether the transaction is covered under RCM, yes, then who will pay GST? Recipient only will pay GST, and the recipient is compulsorily required to get registered unless they are exempted from registration. So unless they are covered under section 23 exemption from registration, they are compulsorily required to get registered. Every recipient who is liable to pay GST under RCM is compulsorily required to get registered. Now, suppose if it is no, so then who will pay? If it is not covered under RCM, who will pay? FCM. Supplier will pay. What is the difference between FCM and RCM? FCM is forward charge mechanism, RCM is reverse charge mechanism. In forward charge mechanism, who will pay GST to government? Supplier will pay GST to government. In RCM, who will pay GST to government? Recipient will pay GST to government. Okay. So supplier is liable to pay GST to government in case of FCM. And now we need to check supplier is registered or not. See, it is a supply, it is taxable supply, supplier is liable to pay, but the supplier is not registered, then there won't be any GST liability, so GST is not payable. What if the supplier is registered? Then GST will be payable. Whether compulsory registration is applicable for the supplier? No, only for the recipient liable to pay GST, compulsory registration will be applicable. So this chart will help you in solving that, like questions, big questions are then the first question that you have. The first question that you have is like, consolidated question. So there it will be helping you. Then the next one, that's it, 3, liability to pay GST. So even though these informations are not there in your book, don't worry, I already told you, you can download the PDF, it's there, and from there you can take the screenshots of that and you can keep the extra information also from that. Okay. So now liability to pay GST. In this liability to pay GST, we have 3 sections, section 9.3, 9.4 and 9.5. 9.3 says that there are like 9.1 and 9.2, liability to pay GST is on supplier, that is FCM, whereas 9.3 there are some notified goods and services where the liability to pay GST is on the recipient. 9.4 there is a promoter or builder who is purchasing inward supply from an unregistered person, and a promoter or builder is required to pay GST under RCM. 9.5 there are some notified services supplied through e-commerce operator, liability to pay GST on notified services is on the e-commerce operator. First we will see 9.3, notified goods or services supplied. What are notified? List of services are notified. These list of services are notified in notification 13 of 2017. That we have to remember with the keyword sir, CG, got, salads. So these are the list of activities. And who will be liable to pay GST? Recipient will be liable to pay GST, and supplier may or may not be registered. Whereas in case of 9.4, inward supplies by a notified registered person from unregistered person. Here basically supplier is unregistered person. Who will pay GST? Recipient will pay GST. What is notified? Promoter or builder who is purchasing goods from an unregistered person is only notified. 9.5. There are some notified services supplied through e-commerce operator. Who will pay GST here? E-commerce operator will pay. What are those notified services? HATE. H for housekeeping services. Example, urban company. And where services, housekeeping service like plumbing, carpentry, AC mechanic service which is provided. Then accommodation services, example, Goibibo, Oyo, etc. And then transportation of passenger service through any motor vehicle, that is Ola, Uber, and eating food from the restaurant, Swiggy or Zomato. So these are covered under notified services. Liability to pay GST is on e-commerce operator, and supplier in case of housekeeping service and accommodation service, the supplier should be unregistered. If the supplier is registered, it will not be coming under 9.5. So whereas the next two, that is T and E. What is T? Transportation of passengers and eating food from the restaurant. Supplier may or may not be registered. It will always come under notified service 9.5, where liability to pay GST is on e-commerce operator. That is, for example, there is a restaurant which is registered selling food through Swiggy. Liability to pay GST is on Swiggy only. So whereas the restaurant is not registered, selling food through Swiggy, liability to pay GST is on Swiggy only, because in case of transportation and eating food from the restaurant, the supplier may or may not be registered. Whereas in case of first two, the supplier should be unregistered, then only 9.5. For example, there is a hotel which is registered and they are providing accommodation through Goibibo or Make My Trip, etc. Now who will pay GST? The hotel only will pay, as a hotel is registered. What if the hotel is not registered and they are listing through Goibibo or Make My Trip? Who will pay GST? That Goibibo or Make My Trip will be paying GST. Then next 9.3, what are the list of services? So whenever you are referring to RCM, you need to write section 9 subsection 3 read with notification number 13 of 2017. What are the list of services? First, yes. Yes refers to security lending services. Security lending services provided by lender of securities to borrower of securities, and liability to pay GST is on borrower of securities. Here, won't it come under exclusion? No, it will not, because transaction in securities is only excluded from goods and services, but facilitating or arranging transaction in securities is covered under services. So therefore, this is a service, and liability to pay GST is on recipient. We don't have any exemption condition for RCM or non-applicability of RCM. Then import of services. In case of import of service, supplier is outside India, recipient in India. Is there any exemption? Yes, we have one exemption. What is that exemption? Import of other than OIDR services by non-taxable recipient is exempted. So import of other than OIDR by non-taxable recipient. So what is the meaning of OIDR service? Any service which is mediated through internet, it will be called as OIDR services, and imported by non-taxable recipient. Who is a non-taxable recipient? Three people will come under non-taxable recipient: individual, trust, government. Individual, unregistered; trust, registered, unregistered; government, registered, unregistered. Individual for what purpose? Personal purpose. Trust for what purpose? Charitable activities. Government for other than business or commerce. So import of other than OIDR by non-taxable recipient is exempted. All other import of service will be taxable. Generally, import of service will come under RCM. So we don't have any condition for RCM, but non-applicability of RCM. In one case, supplier only will pay GST under FCM. What is that one case? Import of OIDR services by non-taxable online recipient. So OIDR services imported by non-taxable online recipient. Who is a non-taxable online recipient? Any unregistered person. For example, we are importing Amazon Prime services. We are unregistered person. So therefore, we will not pay GST. Amazon Prime only will be paying GST. Any unregistered person or registered person only registered for deducting TDS will come under non-taxable online recipient. This is an amendment, very important point. This will be tested. Then R for renting of motor vehicles. In case of renting of motor vehicles, so what are the exemptions that we have? So we have hiring of motor vehicle greater than 12 passengers to a state road transport undertaking, hiring of vehicle, that is I have a vehicle that has more than 12 passengers, I am giving on rent to a road transport corporation, or I have a electric motor vehicle that can carry more than 12 passengers, I am giving on rent to a local authority, or I have a lorry, so which I am giving on rent to a goods transport agency for carriage of goods, or I have a bus which I am giving on rent to a person to provide transportation service to educational institution up to 12th standard. So these four cases it is exempted, all other cases it is taxable. And what are the conditions for RCM? So condition number 1, supplier should be other than body corporate, and the recipient should be body corporate, and the rate of GST should be 5%. All these three conditions satisfied, then only RCM. If any one condition not satisfied, it will be coming under FCM. Then next, renting of residential property. Renting of residential property, we have two exemptions. What are the two exemptions? If it is given on rent to an unregistered person, it is exempted. If it is given on rent to a what property? Residential property. Given on rent to an unregistered person, exempted. Given on rent to a registered individual for his family stay, then also it will be exempted. In other case, it will be taxable. And who will pay GST? So recipient will pay GST. So recipient should be registered. That is the condition. Then copyright services. In copyright services, we have temporary transfer of copyright related to original literary. Original literary means books, dramatic works means story writing, musical works means composing music, artistic works means paintings, drawings, designs, etc. So these four copyrights RCM will be applicable. What are the four copyrights? Original literary, dramatic, artistic and musical works. RCM will be applicable, and we don't have any exemptions. We don't have any condition for RCM. But we have one exception. What is that exception? In case of original literary, so if the author opts to pay GST under FCM, for the next 1 year, author only will pay GST under FCM. So there is a lock-in period of 1 year from the date of exercising the option. So means for the next 1 year. For example, author today opts for FCM. For the next 1 year, author only will pay GST under FCM. Then next, goods transport agency services. GTA services, what are exempted? So we have 3 exemptions for GTA services. That is notified goods. What are the 6 notified goods? Agricultural produce, food grains including flours, pulses, milk and salt, organic manure, then newspapers and magazines, relief material for natural and man-made disasters, defense and military equipments. And then second exemption is if the recipient is individual HUF or artificial juridical person which is registered, so unregistered and not having a factory. Then third exemption is if the recipient is government which is registered only to deduct TDS. So in these 3 cases, GTA services will be exempted. In all other cases, it will be taxable. And GTA has 2 options like original literary. GTA is also having 2 options. Either GTA can pay GST under FCM or the recipient can pay under RCM. So they have to exercise the option for every financial year by previous quarter of the previous financial year. So this financial year, whether FCM or RCM, depends upon January 1st to March 31st of the previous year, last quarter. So they need to decide this. And if they go for FCM, again they have two rates. What are the two rates that they are having? 12% with ITC, 5% without ITC. So therefore, the moment you see 5%, don't blindly take that it has RCM. So it depends upon FCM or RCM. We need to check for the question. Suppose if the question is silent, you take the assumption that it will be covered under RCM. So if GTA opts to pay GST and FCM, lock-in period is 1 financial year. So whereas what is the difference between author and GTA? Author 1 year from the date of exercising the option. So that can be any date to any date. So whereas in case of GTA, financial year. And next option to be exercised between 1st January to 31st March of the preceding financial year. Then next we have government services. So whenever government is providing services to the business entities, including services provided by parliament, state legislature, court or tribunal, so that will be covered. We have some specific exemptions and some general exemptions. So we are discussing specific exemptions. RTA charges, any charges collected towards Right to Information Act. Then interdepartmental service, one department of central government or state government to another department of central government or state government is exempted. Then I have a telecom spectrum, that is government is having telecom spectrum. They are giving the telecom spectrum before 1/4/2016 and for which they collected one-time charges or annual royalty, everything will be exempted. Suppose if they have right to use natural resources, that right to use natural resources they are giving to an individual farmer. So that will be fully exempted. But if they are giving right to use natural resources to any other person, so that should be before 1/4/2016, only one-time charges will be exempted. And next we have merchant overtime charges collected under customs for clearances after office hours or working hours. Then safety certificate charges for providing the safety certificate, consideration for tolerating an act, you entered into contract with government and you breach the contract for which you pay some damages, that amount. And share of profit petroleum. So whenever government and leaseholder enter into a joint venture for giving the mining rights for extraction of crude oil or natural gas, so government will get a share of profit. That share of profit received by the government is exempted. And then registration charges under any law and fee for birth certificate, death certificate, the driving license, visa or passport, guarantee commission for guaranteeing the loans given to PSU. So government will be giving the loans to the public sector undertakings for which they will collect some guarantee commission, that one. And excess royalty collection contractor to the extent of variable royalty. So usually ERCC will be appointed by the government, that ERCC will pay some variable like fixed royalty to the government and ERCC will receive the variable royalty. So when ERCC is paying money to the government to the extent of variable royalty, it is exempted. And fee for granting national permit. So permit charges for going from one state to another state or across the country. These are the 14 exemptions that we have with respect to services provided by whom to whom? Government to business entities. Apart from these 14 exemptions, we have two general exemptions. So apart from these 14 services, any other activity provided by government to business entity, if that business entity turnover during previous year does not exceed threshold limit for registration, that is exempted. But this is not applicable in case of renting of immobile property or any other service where the value of supply does not exceed 5,000 rupees. In case of continuous supply of service, it should be 5,000 rupees in a financial year. So these cases it is exempted. Apart from this, all other cases, services provided by government to business entity will be taxable and we don't have any conditions. But in two cases it will be FCM. What are the two cases it will be FCM? Railways will always be coming under FCM, and renting of property, renting of immobile property by government to a business entity, unregistered business entity, then government only will pay GST and FCM. In case of renting of immobile property to an unregistered business entity, FCM, or in case of supply of goods or services by Indian Railways, always FCM. Then next one we have is overseeing committee services. So there is a overseeing committees which is providing services to the RBI. So basically overseeing committee services is provided to RBI. So RBI only will pay GST under RCM, and we don't have any exemptions, condition for RCM, non-applicability of RCM not applicable. Then TDR FSI long-term lease. So this TDR FSI long-term lease is given by the landowner to the promoter or builder. So promoter or builder only will pay GST under RCM, but we have proportionate exemption with respect to residential units booked before completion certificate or first occupation, whichever is earlier, divided by total number of units. For example, I am a promoter or builder. I am getting some inward supply of TDR FSI long-term lease. Now to what extent it is exempted? So value of inward supply. value of inward supply, we have a formula for this, value of inward supply into 18%, into, so carpet area, area of residential units, booked before completion certificate, or first occupation, whichever is earlier, divided by total carpet area, So this will be taken as the exemption. So first we need to see what is the value of inward supply. Say for example, the value of inward supply is 10 lakhs. So that 10 lakhs into rate of GST 18% into what is the carpet area of the residential units booked before completion certificate. So in that project, how much is the total carpet area? Say the total carpet area of that project is 10,000 square feet. Means the total constructed area in that project is 10,000 square feet. In the 10,000 square feet, how much is the residential units and which is booked before completion certificate, and what is the carpet area of that residential units? Say there are some flats we have in that project, and that flat booked before completion certificate, its carpet area is 6,400 square feet. Now to this extent it is exempted. So what is exempted with respect to TDR, FSI and long term lease? So 10 lakhs into 18%, 1,80,000 into 6,400 divided by 10,000, that will be 1,15,200 is exempted. So remaining amount will be chargeable to GST. So what is the remaining amount payable? Total 1,80,000 is the GST liability. From that 1,15,200 is exempted. So 64,800 we need to pay GST under RCM. So this is the proportionate exemption that we have. So the proportionate exemption is value of inward supply into 18% into area of residential units booked before completion certificate of first occupation, whichever is earlier, divided by total carpet area. And we don't have any condition for RCM or non-applicability of RCM. Then next one, sponsorship services. So generally sponsorship services is provided by organizer of an event, and we have one exemption. What is the exemption? In case of sponsorship service, be careful. The one who is organizing the event is a supplier, and the one who is paying the sponsorship money is the recipient. If it is in relation to sponsorship of a recognized sporting event, so that sporting event related sponsorship money is exempted. All other sponsorship monies will be taxable, and the condition for RCM, yes, the recipient should be body corporate or firm. If the recipient is other than body corporate or firm, it will not come under RCM, it will be FCM. Then agent services, total 5 agents are covered. Insurance agent to insurance company, there is an insurance agent providing service to insurance company. Recovery agent providing service to bank, financial institution or NBFC. Direct selling agent providing services to bank or NBFC. Business facilitator to banking company. Agent of business correspondent to business correspondent. These are the 5 agents, that is insurance agent, recovery agent, direct selling agent, business facilitator, agent of business correspondent. Their outward supply covered under RCM. In that, insurance agent to insurance company, if it is insurance agent working in rural area, so then it will be exempted, and we don't have any condition for RCM, non-applicability of RCM. Recovery agent services to bank or NBFC, we don't have any exemption condition for RCM, non-applicability of RCM. Direct selling agent to bank or NBFC, no exemption, but we have a condition for RCM. Direct selling agent should be other than body corporate or firm. What if direct selling agent is body corporate or firm? It will not be covered under RCM, it will be FCM only. So direct selling agent should be other than body corporate or firm. Then business facilitator to banking company, if the business facilitator is working in rural area, the commission received by them will be exempted. Same way, agent of business facilitator to business, agent of business correspondent to business correspondent, if they are working in rural area and they are getting commission, that is exempted. Then next one, so sir, yes for sponsorships, yes for security lending services, I for import of services, are for renting of motor vehicle, another are for renting of residential property. C for copyright services, G for GTA services. Then GOT, government services to business entities, O for overseeing committee services to RBI, and T for TDR FSA long term lease. And in this salads, S for sponsorship service, A for agent service, L for legal services provided by individual advocate or firm of advocate to business entity. And we have 4 exemptions here. What is that? If they are providing service to a person other than business entity, it will be exempted. If they are providing services to central government, state government, local authority or government authority, it is exempted. And if they are providing services to individual advocate, another individual advocate or firm of advocate, it is exempted, but this exemption is not applicable for senior advocate. Then fourth one, services provided by advocate to a business entity whose turnover during previous year does not exceed threshold limit for registration, then it is exempted. These are the 4 cases it is exempted, and all other cases advocate service will be taxable. Wherever it is taxable, who will pay GST? Business entity will pay, advocate will not pay. Whereas arbitrator, we have only 3 exemptions. What are they? First, third and fourth. What is the first exemption? If they are providing service other than to business entity, or services to central government, state government, local authority, or service to a business entity whose turnover during previous year does not exceed threshold limit. So these are the exemption for arbitrator service to business entity. And apart from these 3, wherever it is taxable, business entity only will pay GST. Then next one, director services. There is a director who is providing services to a company or body corporate. The liability to pay GST is on the company or body corporate under RCM. But what if the director is an employee of the company? Then it is not a supply. What if the director is providing service to the company or body corporate in their personal capacity? Then also it will not be coming under RCM, it will be FCM. Director providing service in personal or private capacity will be FCM. Then security agency services. We don't have any exemption. What are the 2 conditions for RCM? The security agency should be other than body corporate. And the condition, another condition is that recipient should be registered but not opting for composition scheme, or not registered only to deduct TDS. And non-applicability of RCM, if any condition is not satisfied, then it will be FCM. So what are the 2 conditions for security agency? Supplier should be other than body corporate. Recipient should be registered, but they should not be opting for composition scheme, or not registered only to deduct TDS. Then next we have, these are the notified service under 9.3, then 9.4, inward supply of a promoter or builder. So promoter or builder, we need to check inputs and input service other than, so these 5, electricity, high speed diesel, motor spirit, natural gas, TDR FSI, long term lease. So this you don't bring under 9.4. So electricity no GST, high speed diesel no GST, motor spirit no GST, natural gas no GST, TDR FSI, long term lease already it is covered under RCM. Apart from this, any other, at least 80% of total in a year should be from a registered person. Otherwise, they need to pay GST under RCM at the rate of 18%, on the shortfall up to 80%. But cement should always be purchased from a registered person. Otherwise, they need to pay GST under RCM at what rate? 28%. Whereas capital goods should always be purchased from a registered person. Otherwise, they need to pay GST under RCM at the rate applicable to capital goods. Just these 3 points you remember, that is sufficient. What is that? So inward supplies, inputs and input services. Inputs and input services are than 5. Electricity, petrol, diesel, the high speed diesel, motor spirit, natural gas, TDR FSI, long term lease. Now in this, cement always should be purchased from a registered person. Otherwise you need to pay GST and RCM at 28%. Any other goods or services, so 80% should be from registered person. Suppose if there is any shortfall less than 80%, on that shortfall you need to pay GST under RCM at 18%. Capital goods should always be purchased from registered person. Otherwise you need to pay GST under RCM at what rate? At the rate applicable to capital goods. Then next 9.5, liability to pay GST on e-commerce operator in case of notified services. So notified service, housekeeping service, supplier should be unregistered. But what if the supplier is registered? It will not come under 9.5. So supplier only will pay GST. Then accommodation service also, supplier should be unregistered. What if the supplier is registered? So supplier only will pay GST. Then transportation of passengers by any motor vehicle, supplier registered unregistered. But we have one exception to this. What is that? Omnibus. One omnibus point is there. Transportation of passengers in a omnibus. Omnibus means what? Capacity greater than 6 passengers. If that is through omnibus by a company. So there is a company which is transporting the passengers through omnibus through e-commerce operator. Company only will pay GST. So if transportation is through omnibus by a company, then the company only will pay GST. 9.5 will not be applicable. Then eating food from a restaurant. Who will pay GST? Recipient like e-commerce operator will pay. Supplier may or may not be registered. But we have one exception here. What is that? If the restaurant is in a hotel, that hotel is having a tariff more than 7,500 rupees per day. That is like a 4-star or 5-star hotel. In that hotel, there is a restaurant. That restaurant is supplying food through Swiggy or Zomato. Swiggy or Zomato will not pay. The restaurant only will pay. So if the restaurant in the specified premises, that is in a hotel having a declared tariff greater than 7,500 per day, 9.5 will not be applicable. So liability to pay GST is on the supplier only. Then some important points. When e-commerce operator is liable to pay GST on above services, they are not required to deduct TCS. So TCS under section 52 and 9 subsection 5 are mutually exclusive. Wherever 9.5 comes, TCS will not be applicable. Otherwise, TCS will be applicable on e-commerce operator. Only in case of notified services, that is 9.5, e-commerce operator is liable to pay GST. In case of other supply of goods or services, who will pay GST? Supplier only will pay GST. Only for 9.5 services, e-commerce operator will pay. Every e-commerce operator liable to pay GST or liable to deduct TCS is compulsorily required to get registered. So remember, e-commerce operator is compulsorily required to get registered. Also, supplier of goods through e-commerce operator, if I am selling goods through e-commerce operator like Amazon or Flipkart, etc. So the seller who is selling goods through Amazon or Flipkart is compulsorily required to get registered, but we have a relaxation there. If the seller is making only intrastate supplies and he is getting a unique enrollment number, he is not required to compulsorily get registered. Again, I am repeating, if I am a seller, if I am selling goods through Amazon or Flipkart, I have to compulsorily register. But if I am making only intrastate supplies within the state and I am not making any interstate supplies, so then I can get a unique enrollment number without getting registration. I can supply through e-commerce operator. That is this amendment. And supply of notified service or other than notified service through e-commerce operator, they are required to get registered only when their aggregate turnover exceeds threshold limit for registration. Then next we have some summary of important circulars. So whether interstate movement of conveyances, when a conveyance is going from one state to another state between the distinct person, whether any GST payable on the conveyance? No. On conveyance we don't have to pay GST because that conveyance will be returned. Also same way, spare parts which are taken from one distinct person to another distinct person, we don't have to pay GST on the spare parts also. Then next one, when the agent is called as agent acting on behalf of principal. So if the invoice is raised by the agent in his name, or if the purchase invoice is the name of the agent, then the agent is acting on behalf of the principal. Then in case of printing activity, when it will come under supply of goods or supply of services, if paper is the goods and printing is a service, if paper constitutes principal supply, it is supply of goods. If printing constitutes principal supply, then it is supply of service. In case of books, brochures, flyers, etc., printing is a principal supply, not the paper ending, therefore it will be treated as supply of service. Whereas in case of tissue papers where the hotel logo is printed, their tissue paper is the principal supply, not the printing, so it will be treated as supply of goods. Then whether the activity of bus body building, again we need to classify based on principal supply. In bus body building they use the metal, materials, etc., that is goods, whereas fabrication and installation is the service. The principal supply is service, so bus body building will be treated as supply of service. Whether rethreading of tires, in case of rethreading of tires, you will give me the old tire on which I do the rethreading, it is supply of service. Suppose if I buy the old tire from you and do the rethreading and sell the rethreaded tire to you, then it will be treated as supply of goods. Then priority sector lending certificates. Generally priority sector lending certificates is between banks. One bank will be selling priority sector lending certificate to another bank. It will be treated as sale of goods and always chargeable to IGST under RCM. So means it's treated as deemed interstate supply. Whether artwork sent by the artist, when an artist is sending the artwork to the art gallery and the art gallery thereafter selling it to the customer. Only when art gallery is selling it to the customer, that is the date on which it is treated as sale in the hands of the artist. Then whether tenancy rights or pagadi system is chargeable to GST. Tenancy right, that is when I have a tenancy right to have the property as I have a property tenancy right, means I will only be the tenant of that property. When I transfer the tenancy right as a tenant, it will always be taxable in my hands. Whereas in the hands of the property owner, it will be taxable if the rent of that property is exempted, then the tenancy right also exempted. If the rent of that property is taxable, tenancy also taxable. But tenancy right, transfer of tenancy right, transfer of tenancy right always taxable in the hands of tenant, always taxable in the hands of tenant. Then next, GST on director remuneration, already we have seen. What if the director is an employee of the company? So which means TDS will be deducted under 192. So whenever director is getting remuneration from the company and the TDS is deductible under 192, then it will come under salary, so there is no GST. If the TDS is deducted under 194J, then whatever money received by the director is treated as professional remuneration, and on that GST will be applicable, and RCM, company or body corporate, is required to pay. That is this circular. Then whenever insurance company is giving no claim bonus to the insured, so from paying the premium, so that no claim bonus is treated as a deduction from the insurance premium. So therefore on net premium only GST will be computed. And next one, whether interest received by a delivery agent is chargeable to GST. Now interest is received by a delivery agent, whether invoice is raised by delivery agent or not, you need to see. If invoice is raised by delivery agent in his name, the interest is on account of delay in receipt of consideration, it will be taxable. If the invoice is raised by the principal, then the interest received by the delivery agent is only for giving the finance facility, and that interest received by delivery agent will be exempted. Then when a company is investing shares in the other company, so is that activity treated as supply? No. Investment activity is not treated as supply. So therefore holding shares by one company in the other company will not become supply, because transaction in securities. Securities are neither goods nor services. Then whenever food and beverages are sold by a cinema theater, so to the people, so along with the ticket, whether it will be treated as composite supply? Yes. So exhibition of film will be 28%. Sale of food and beverages will be 5%. If you go to the theater and buy the food and beverages separately, then the rate of GST for food and beverages will be 5% and theater will be 28%. As a part of the ticket itself, if they sell food and beverages, means like a complimentary. So along with the ticket, they are also giving you food and beverages as complimentary. Even on food and beverages, the rate of GST will be 28%, because the principal supply is exhibition of film. So that rate will be taken. So these are the various circulars we have. And the next area is value of supply. So value of supply, usually what should be taken as a value of supply? Transaction value will be taken as a value of supply. What is the transaction value? Price actually paid or payable for supply of goods or services. And if two conditions are satisfied, what are the two conditions? Supplier and recipient should not be related, and price must be the sole consideration. If any one condition is not satisfied, or both the conditions not satisfied, so then transaction value will not be taken, means the price involved in the transaction will not be taken. We need to determine the value as per rules. Usually as per rules, what should be taken? The open market value will be taken. Okay, value will be determined as per rules, and that rules is not applicable, but usually remember the market value, the fair market value or the open market value will be taken. So there is a supplier who is supplying some goods or services to the recipient, for which recipient will make some payment. That payment will be taken as the transaction value. And if the supplier incurs the expenditure and recovers the expenditure from the recipient, will it be included in the value? Yes, provided that expenditure is recovered by the supplier from the recipient before or at the time of supply. Suppose if the expenditure is after supply, that will not be included. If the expenditure is before or at the time of supply, then it will be included in the value. And next one, taxes, duties and cess by whatever name call other than GST should be included in the value, that is 15(2)(a). So for example, we have customs duty. While computing IGST, whether the customs duty should be included? Yes. While computing customs GST, whether we need to add the entertainment tax? Yes. All taxes, duties and cess by whatever name call you add, and finally only GST you will be computing. And next one, suppose if recipient is incurring expenditure on behalf of the supplier, actually that supplier should incur the expenditure, but recipient is incurring, means it's an indirect consideration to the supplier, so then it should be included. Recipient incurs expenditure on behalf of supplier, it should be included. What if recipient incurs the expenditure on his own account? That will not be included. Then next one, interest, late fee or penalty for delay in receipt of consideration. You have to pay money to me on time, you did not pay. So therefore, I am giving you extended credit period. For that extended period, I will collect some interest, late fee penalty, that should be included in the value. So first one, 15(2)(a). 15(2)(a) says taxes, duties and cess by whatever name call other than GST should be included in the value. And second one, 15(2)(b), any amount incurred by the recipient on behalf of the supplier should be included in the value. 15(2)(c), any expenditure incurred by the supplier and charged to recipient before at the time of delivery of goods or services to be included in the value. 15(2)(d), interest, late fee or penalty for delay in receipt of consideration. Then 15(2)(e) is subsidy. Subsidy should be divided into two. That is directly linked to the price, not directly linked to the price. Not directly linked to the price means it's a lump sum subsidy or a general subsidy. So means it will not be connected to our outward supply. That subsidy you ignore in the question. You don't have to bother. So because it will be, not considered in the value, it is treated as donations. It should be ignored. Whereas if it is directly linked to the price, directly linked to the price means what? So it is related to outward supply. For example, subsidy 2,000 rupees per unit sold or 2,000 rupees per service. So like that, if they are linking it to the outward supply, then it will be directly linked to the price. Sir, what if the question is silent? You consider the subsidy as directly linked to the price and you treat it accordingly. Okay. Now, directly into the price is again divided into two, from CGRSG or from others. If it is from CGRSG, to be excluded from value. If it is from others, to be included in the value. And suppose if the question is silent, consider the given price after reducing the subsidy amount given in the question. Means what? So whatever is the original price, we don't know. The price given in the question is silent. So the given price is after considering subsidy. Net of subsidy means what? So to arrive at the given price, there is some original price. They have already reduced the subsidy and they arrived at the given price. Okay. So now this subsidy is already reduced. Now given price is taken as a base. This given price we will take as a transaction value. Subsidy is reduced. It is from central government or state government. It is to be excluded and it is already excluded. So ignore. Suppose if the subsidy is from others, so it is to be included, but in the given price it is excluded. So we need to add. Just these two treatments you need to follow. Then next one, exclusion from value of supply, section 15 subsection 3, the exclusion is discount. So discount is excluded from supply, but the discount can be before or at the time of supply. If it is discount before the time of supply, like trade discount, it is always allowed as deduction. If the discount is given after supply, but the terms are agreed before at the time of supply, is it allowed as deduction? Yes. For that, supplier has to give one document called as credit note to the recipient, and the recipient should reverse the ITC. It is also allowed as deduction. What if the discount is given after supply, but the terms are not agreed before at the time of supply? It will not be allowed as deduction. Example, end of season sale discount, not allowed as deduction. So for example, first I gave a sale, I sold the goods for 1 lakh. And I have not agreed any discount terms. Later on I gave a 50% discount to you. So even though I collect only 50,000 from you, but I need to pay GST on 1 lakh because the post supply discount is not allowed as deduction as the terms are not agreed before the time of supply. Then whether GST is applicable on additional penal interest on overdue loan. So remember, in a EMI. So in a EMI, non-payment of EMI, we have to pay some interest. Interest payable, penal interest payable for non-payment of EMI. In the EMI, if the interest is taxable, penal interest also taxable. In the EMI, if the interest is exempted, penal interest is also exempted. Example, housing loan interest is exempted. So why housing loan EMI interest is exempted? Because interest on loans, advances, deposits is exempted. As interest on loans, advances, deposits is exempted, so the housing loan EMI interest is exempted. If you are missing a EMI, you have to pay penal interest. That penal interest is also exempted. Then suppose if credit card EMI is there, credit card EMI, the interest involved in credit card is taxable. So as credit card interest is taxable, so for non-repayment of credit card EMI, they will levy a penal interest. That penal interest is also taxable. What you need to remember, if the interest involved in the transaction is exempted, penal interest is also exempted. If the interest involved in the transaction is taxable, then penal interest is also taxable. Okay. So that is what? Hire purchase transaction. In hire purchase transaction, the interest is taxable, so penal interest also taxable. In hire purchase financing, in the EMI, the interest is exempted because it is on loans, advances, deposits, so penal interest is also exempted. Then no claim bonus, already we have discussed, it will be allowed as deduction because no claim bonus will be like a pre-supply discount. Before supply itself, they will be giving this discount. Then incentive, usually what happens, so in case of low value UPI transaction up to 2000 rupees, so government will be giving incentive to the companies like acquiring companies or banks, financial intermediaries. That's why they will not be charging any amount to the vendors. So there won't be any processing fee because they get an incentive. How this incentive should be treated? This incentive should be treated like subsidy from central government or state government. So it is considered in the nature of subsidy by central government, therefore not included in value. Then TCS. Under Income Tax Act, there is something called as TCS. So that will be collected by supplier from the recipient. For example, you are buying a car. Now the car dealer will be collecting TCS from you. Is the TCS to be included in the value? No. So TCS under Income Tax Act should not be included because basically TCS is an interim levy to know your source of income. That is not actually your tax on income. So TCS under Income Tax Act should not be included in the value. So car dealer selling car to you, he is collecting TCS 1%. Should that 1% be included in the value for computing GST? No. So TCS not to be included in the value. Then GST implications on debit note and credit note as per section 34. So who will be giving debit note and credit note? Supplier will be giving debit note or credit note to the recipient. When the debit note will be given, whenever there is a increase in the invoice value, debit note. Whenever there is a decrease in the invoice value, then it will be credit note. Both will be given by supplier to recipient only. And whenever recipient has to pay extra amount, debit note. Whenever recipient has to pay amount less than the invoice value, credit note. Okay. And is there a time limit for debit note? No time limit for debit note. Because of debit note, what will happen to the supplier? Supplier's liability will increase and the recipient can take ITC based on that. Based on credit note, what will happen to the supplier's liability? It will be reduced and the recipient has to reverse the ITC. If you don't have ITC, he need to add it to his liability. Is there a time limit for credit note? Yes. The time limit for credit note is 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. What are the cases? Like this time limit, we have same time limits. So time limit for availing ITC, time limit for issuance of credit note, time limit for rectification of GSTR1, time limit for rectification of GSTR3B return, time limit for rectification of GSTR8. In these 5 cases, the time limit is same, 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. Then the next area, invoice and time of supply. So section 31 talks about what is the due date of invoice. So due date of invoice in case of goods, 3 provisions you need to remember. Generally, what is the due date of invoice in case of goods? Normal cases, if supply involves movement of goods, at the time of removal. If supply does not involve movement of goods, at the time of delivery. For example, it so happens that, so you are placing the order with me and I have to deliver the goods to your home. Now the date on which I remove the goods from my location, that will be taken as the due date of invoice. Suppose if you are coming and collecting the goods and going, then on the day when I hand over the goods to you, that date will be taken as the due date of invoice. Supply involves movement of goods at the time of removal, supply does not involve movement of goods at the time of delivery. In case of continuous supply of goods, continuous supply of goods means there will be successive supply of goods for which the payments are settled on a periodical basis. So we need to see whether the payments are received based on account statement or irrespective of account statement. If the payments are received based on account statement, means I will give an account statement, based on that only you will pay, then the account statement date will be the due date of invoice. Ad hoc you have to pay some money irrespective of the account statement. So whenever you pay money to me, that date will be taken as the due date of invoice. So date of account statement issued or the payment received, as the case may be. Then sale on approval or on return basis. In sale on approval or on return basis, first I will hand over the goods to you and thereafter you will use it, and if you like it you will buy, otherwise you will return. Now in this case, 6 months from the date of removal or date of acceptance by view, whichever is earlier will be treated as the date of sale and I have to raise invoice at that time. So 6 months from the date of removal or date of supply, whichever is earlier. These 3 provisions in case of goods. In case of services, normal cases, if it is banking sector or insurance sector, time limit for issuance of invoice is 45 days from the date of completion. If it is other cases, 30 days from the date of completion. Then continuous supply of services, we need to check 3 points. So whether the installment date is ascertainable from the contract, then the due date of installment is the due date of invoice. What is a continuous supply of service? A service which takes more than 3 months to complete and involves periodic payment obligations is a continuous supply of service. Example, so insurance contract is a continuous supply of service, telecommunication postpaid is a continuous supply of service, and even construction is a continuous supply of service. So if in the construction contract the due date of installment is ascertainable, the due date of installment itself is taken as the due date of invoice. Suppose if the due date of installment is not ascertainable but the payment is linked to completion of an event, like upon completion of first floor you have to pay this much, second floor you have to pay this much, final you have to pay this much, like this. So means whenever that first floor is completed or second floor is completed, the date of completion will be taken as the due date of invoice. Nothing is there, then whenever you pay the installment amount, that date will be taken as the due date of invoice. Remember, in continuous supply of service, 2 conditions. First, the service should take more than 3 months to complete and it should involve periodic payment, mean installment, then only it will be called as a continuous supply of service. Otherwise it will be a normal service, 30 days or 45 days invoice will be applicable. Cessation of service means abruptly stopping the service is known as cessation of service, and when the invoice to be given, immediately after cessation the invoice needs to be given. Then time of supply in case of goods and services. So section 12 deals with time of supply in case of goods and section 13 deals with time of supply in case of services, and here the first provision is common for both goods and services. The liability to pay GST is determined on the basis of time of supply. Then next one, time of supply in case of FCM for goods is different and for service it is different. First, what is the time of supply in case of FCM for goods? In case of a person opting for composition scheme or specified actionable claims, we have 3 dates: due date of invoice, actual date of invoice, or date of payment, whichever is earlier will be taken. So these 3 dates for whom? In case of a person opting for composition scheme and specified actionable claims. So due date of invoice. Due date of invoice means when the invoice needs to be issued. Actual date of invoice, when the invoice is, due date of invoice when it should have been issued. Actual date of invoice when it is issued. and date of payment whichever is earlier. As date of payment is also one of the dates, so they need to pay GST on advances. Whereas others means other than those opting for composition scheme or other than specified actionable claims, it will be due date of invoice or actual date of invoice whichever is earlier. Means GST not payable on advances. Why GST not payable on advances? Suppose this month we receive the money, but we raise invoice in the next month, or due date of invoice also next month. So we don't have to pay GST this month, we need to pay GST only next month because time of supply is there. So two provisions you need to remember. For a person opting for composition scheme or specified actionable claims, due date of invoice, actual date of invoice, date of payment whichever is earlier. And for others, due date of invoice or actual date of invoice whichever is earlier. And also remember one point, that GST not payable on advances if date of payment is not there for time of supply. Then in case of services under FCM, you see service under FCM section 13 subsection 2. So if the invoice is given within the due date, then invoice date or payment date whichever is earlier. If invoice not given within due date, completion date or payment date whichever is earlier. What is the time limit within which invoice to be given? 30 days or 45 days. So within that time if you give whatever date you gave invoice or payment date whichever is earlier. If you miss to give the invoice by the due date, so take the completion date or payment date whichever is earlier. As payment is also one of the date, so GST payable on advances in case of service under FCM. Then in case of goods RCM, you see goods RCM, 3 dates we have. So date on which goods are received, date on which payment is made to supplier, and 31st date from the date of invoice. So this we need to see from the recipient point of view. Date on which goods are received, date on which payment is made to supplier, or 31st day from the date of invoice. But in case of services, this first date is not there. Date on which payment is made to supplier, instead of 31st day it will be taken as 61st day. Then in case of vouchers, then residual cases and addition to value by way of interest late fee, we don't have any difference in the provision between goods and services. The provisions are same. In case of vouchers, let it be goods or services. Check whether the voucher is identifiable voucher or non-identifiable voucher. Identifiable voucher means that voucher can be redeemed against a particular product or particular service, then it is identifiable voucher. So today itself I know against which product you are going to redeem. So the date of issuance of voucher will be taken as a time of supply. Whereas non-identifiable voucher, you will be redeeming against any product or service, so I don't know. So whenever you actually redeem, that is the time of supply. Identifiable voucher at the time of issuance of voucher, non-identifiable voucher at the time of redemption of voucher. And then in case of residual cases, so whether the person is required to file periodical return, yes, the due date of that return, otherwise whenever he pays GST, that will be taken. Suppose interest late fee penalty, always interest late fee penalty is taxable on what basis? Receipt basis. Only when we are actually receiving it, we need to pay GST. Then some additional points in this regard. In case of goods covered under FCM on advance, GST not payable, but in all other cases GST is payable on advances. Then up to 1000 rupees received beyond invoice. I have raised an invoice for some amount. Say for example 12,300 I raised invoice, but you have made a payment of 13,000 rupees. Now 700 rupees received in extra. So for the 700 rupees, either I can take invoice date. For the 700 I will give invoice in the future. So invoice date in future or payment date now, whichever is earlier, or I will raise invoice. So at the time itself I will pay GST. So I have two options. Either I can choose date of invoice or as per 13.2, that is invoice or payment whichever is earlier, supplier has option to choose. What is considered as the date of payment? From supplier point of view, date on which entry is made in the books or date of credit in the bank account whichever is earlier. From recipient point of view, date of entry in the books or date of debit in bank account whichever is earlier. Then in case of import of services from an associated enterprise, so there is a recipient in India, supplier outside India. Usually import of service RCM, date on which payment is made to supplier or 61st day from the date of invoice whichever is earlier. But between associated enterprise there won't be any invoice. So date on which payment is made to supplier or date of entry in the books of recipient whichever is earlier should be taken. Date of entry in the books of recipient or date of payment to supplier whichever is earlier. When goods are taken outside India for exhibition, but the goods are not brought back within 6 months, on expiry of 6 months we need to consider it as supply and we need to raise invoice because of sale on approval or on return basis. 6 months from the date of removal or date of acceptance whichever is earlier. So we have taken it, they have not returned, means it is deemed as supply, and as and when the goods are returned, you raise a credit note for cancelling this invoice. Then as per section 33, it is telling that tax component should always be shown separately in invoice. So whenever we are raising an invoice, in that invoice the tax component separately we need to show. So we should never give the invoice as inclusive of GST. We need to give the invoice as amount plus GST separately. Then various documents involved in GST. The first document is tax invoice. So tax invoice is given by So registered person who is making taxable supplies. And what is the time limit? Already we have seen the time limit. And who will be giving tax invoice to whom? If the supplier is registered, supplier will give the tax invoice to recipient. But if the supplier is unregistered, then recipient will give the tax invoice to the supplier in case of RCM. And next one, bill of supply. Who will give bill of supply? Registered person who is making exempted supplies, or a person coming under composition scheme. And supplier only will be giving it. Time limit same as due date of invoice. Invoice come bill of supply. Who will give? A registered person who is making both taxable and exempted supply in a single transaction to an unregistered person. Then they will be giving invoice come bill of supply. Supplier will be giving same as due date of invoice. But in case of low value supplies, low value supply means value of supply less than 200. Neither a tax invoice nor bill of supply is required. 3 conditions. It is a B2C supply. B2C means recipient is unregistered and recipient do not require tax invoice, but they need to prepare a consolidated invoice at the end of the day. So low value supplies, tax invoice as well as bill of supply not required. First condition, recipient is unregistered. Second condition, recipient do not require tax invoice. Third condition, a consolidated tax invoice is generated at the end of the day. But in case of multiplex theatres, even if the value of supply is less than 200, they need to give an invoice and e-ticket will be treated as invoice. And debit note, credit note already we have seen. So when it will be issued. And next we have revised tax invoice. When revised tax invoice will be given, so whenever a person is liable to get registered and he made application for registration and he got registration. So from the date he is liable to get registered till the date he got the registration certificate, he cannot recover the GST. So due to that reason, after registration, for the period from the date he is liable to get registration till the date he got the registration certificate, for that period he can give a revised tax invoice. When the revised tax invoice will be given after registration certificate, what is the time limit within which registration, they need to give revised tax invoice within 1 month from the date of registration, they need to give revised tax invoice. For example, a person is liable to get registered from 1/5, he is liable to get registered, and thereafter he got registration on 25/6 only he got registration. Now from 1/5 to 26 he is liable to register, but he not got registered. So he will get registration certificate only on 25/6. So he will be making outward supply. For that outward supply he cannot collect the GST. So to recover the GST he can give a revised tax invoice to his customers. When he can give revised tax invoice? After 25/6 within 1 month. Within 1 month he can give revised tax invoice after 25/6 for the outward supplies between which period? 1/5 to 25/6. That is called as revised tax invoice. But remember, revised tax invoice can be issued only if application for registration is made within 30 days. So because we have a effective date of registration, what will be taken as the effective date of registration? If applied for registration within 30 days, the date on which the person is liable to get registered is the effective date of registration. If not applied within 30 days, then the date on which they get the registration certificate. So if the application is not made within 30 days, revised tax invoice cannot be issued. Then next, receipt voucher. Who will be giving receipt voucher to whom? Supplier to recipient. When? Advance. Simple, advance. Whenever supplier collects advance from the recipient, supplier will be giving receipt voucher to the recipient immediately upon advance. Payment voucher, who will be giving to whom? Recipient to supplier in case of RCM. So recipient is making payment to supplier, at that time they will give payment voucher. Refund voucher, which case supplier has given a receipt voucher for collecting advance. Now the supply is cancelled, the advance is returned, then the supplier has to give the refund voucher to the recipient. And next, delivery challan. So delivery challan in case when there is a movement of goods without supply. Movement of goods without supply means goods sent on job work or goods taken from one place to another place within the same registered person. They have not got separate registration. So in all these cases, there is a movement of goods but without supply. In that case, that movement of goods should be under the cover of a delivery challan. Supplier should be giving that. Then next we have HSN code in invoice. So usually in case of goods, we need to enter HSN code, and that we have a relaxation. Suppose if the aggregate turnover during previous year does not exceed 5 crores, we need to enter only 4 digits, that too for B2B supplies. If the aggregate turnover during previous year exceeds 5 crores, whether it is B2B supply or B2C supply, we need to enter 6 digits. For services, it is called as service accounting code, that is always a 6-digit number. Then there is something called as e-invoice. What is e-invoice? Obtaining 3 things from the invoice registration portal for a normal invoice is known as e-invoice. That is invoice reference number, quick response code and digital signature from invoice registration portal is called as e-invoice. Whenever e-invoice is prepared, the physical copy of the invoice is not required. Usually we need to prepare the copy of invoice in triplicate and duplicate. So triplicate in case of goods, original for buyer, duplicate for transporter, and triplicate for assessee. Whereas in case of services, original for recipient, duplicate for supplier. But the physical copy of the invoice is not required where e-invoice is applicable. And type of transaction for which e-invoice is required, B2B transactions, outward supply whether covered under FCM or RCM, zero rated, credit notes and debit notes. When e-invoice is required, so whenever aggregate turnover of the registered person during any previous year from 2017-18, any previous year from 2017-18 exceeds 5 crores, then only e-invoice is required. When dynamic QR code in invoice is required, whenever the registered person's aggregate turnover in any previous year from 17-18 exceeds 5 crores, for B2C supplies, dynamic QR code is required. So, if the aggregate turnover during any previous year from 17-18 does not exceed 5 crores, for B2B, e-invoice not required, for B2C, dynamic QR code not required. B2B means sale to registered person, B2C means sale to unregistered person. Then, suppose if it exceeds 5 crores but does not exceed 500 crores, for B2B invoice required, for B2C dynamic QR code is not required because dynamic QR code limit is what? 500 crores. If the aggregate turnover during previous year exceeds 500 crores, for B2B invoice, for B2C dynamic QR code. Then, invoice should be in prescribed form, that is INV1. It is optional for a taxpayer whose aggregate turnover does not exceed 5 crores. Even though my aggregate turnover does not exceed 5 crores, so I can still generate the invoice. Once the invoice is prepared, this will automatically be populated in GSTR1 and e-way bill. And physical copy of invoice is not required in case where e-invoice is applicable. Okay. And previously this 5 crore limit was 10 crores. And now they have reduced this limit to 5 crores. For your attempt, it will be 5 crores only. And physical copy of invoice not applicable. QR code can be produced before the proper officer for verification whenever required. And next, what is this dynamic QR code? Dynamic QR code means we need to enter these details and prepare a QR code, and that QR code should be entered in the invoice. That is supplier GSTIN, UPI ID of the supplier, bank account and AFSC code of the supplier, invoice number and date, invoice amount with breakup of value and tax. For UPI ID of the supplier, we have an exception that if the payment is collected by e-commerce operator, so then the e-commerce operator UPI ID should be there. Bank account and FSC code, we have an exception not required if UPI ID is linked to the bank account. Invoice number and date, if it is a retail transaction, multiple counters are there, we don't have to enter the invoice number, just a unique number is sufficient. Invoice amount with breakup of value and tax. Remember, if the money is collected before preparing invoice, dynamic QR code is not required. If the money is collected after preparing invoice, only dynamic QR code is required. If part collected before, part collected after, only for the remaining amount we need to create the dynamic QR code. And exception to mentioning dynamic QR code invoice, if the payment is received before or at the time of generating invoice and cross reference of such payment received is mentioned in the invoice, then dynamic QR code not required. Another exception is supplier in India, recipient outside India. Place of supply is in India, it's not an export of service, but the consideration is received in convertible foreign exchange. The recipient outside India cannot scan and pay. So due to that reason, dynamic QR code is not required. Then, even though aggregate turnover exceeds 5 crores or 500 crores, in some case, e-invoice and dynamic QR code not required. What are the cases where e-invoice is not applicable? Remember the keyword biggest. B for what? Banking company. I for insurance company. G for goods transport agency. Another G for government department or local authority. E for exhibition of film in a multiplex theatre. S for SEZ unit, and T for transportation of passengers by any mode. In these cases, e-invoice is not required. Remember the keyword biggest. Then big toe. So in case of QR code, big toe. B for banking company, I for insurance company, G for GTA. But goods transport agency, then government department you remove. So you just remember big toe, BIGTOE. BIGTOE, banking company, insurance company, goods transport agency. Then T, transportation of passengers. Extra O we have here, OIDR services, and E for exhibition of film in multiplex. In these cases, even though turnover exceeds 500 crores, dynamic QR code not required. Now, suppose if there is a banking company is not required to give e-invoice. If they make any other service also, e-invoice not applicable. Yes. So that is the circular. So whether the exemption for mandatory registration generation of e-invoice available for the entity as a whole or only for certain suppliers? Entity as a whole. If they are not required to give e-invoice, means for any transaction they are not required to give e-invoice. So what is the e-invoice process? First, the taxpayer will prepare a normal invoice that will be converted into .json file, and thereafter it will be uploaded in the invoice registration portal. Invoice registration portal will do the deduplication check and generate three things: invoice reference number, digital signature and QR code. Thereafter it will be sent to the GST system and e-way system, and GSTR1 of the seller gets updated, GSTR2B of the buyer gets updated, and the buyer can view this invoice, and this invoice, even though supplier is required to give a e-invoice, but he gave a normal invoice, even though it comes in 2A, 2B of the recipient, he cannot take ITC. It's a very, very important point. If a supplier is required to give e-invoice, but not issued e-invoice and issued a normal invoice, then recipient cannot avail ITC, even though it reflects in 2A or 2B of the recipient. Then next one, we have input tax credit. So we'll take a small break and then we will continue with this. Okay, we'll start. The next area is input tax credit. So input tax credit, first we have various returns. GSTR1 is a statement containing the details of outward supplies. Who will be filing GSTR1? Every registered person. And based on the GSTR1 of the supplier, the input tax credit will be reflected in 2A and 2B of the recipient. So supplier will be filing GSTR1. Based on supplier GSTR1, the data of inward supplies will be reflected in 2A and 2B. The difference between 2A and 2B is that 2A is a static, it's a dynamic document. It will get updated automatically whenever GSTR1 is changed, whereas 2B is a static document, so it will not be changed. If the GSTR1 is filed by the due date, so those details only will be reflected in 2B. But for the purpose of availment of ITC, whether 2A ITC is relevant or 2B ITC is relevant, 2B ITC is only relevant. Then 3B is a consolidated document that contains the details of outward supplies, input tax credit and net GST payable as per section 39. So section 37 is GSTR1, 38 is GSTR2B and 39 is GSTR3B. The difference between 2A and 2B can be asked as a short note question. You need to write these points. So the type of document, GSTR2 is a dynamic document, but 2B is a static document, and TDS details, TCS details will not be there in 2A, will be reflected in 2A but not reflected in 2B. Details of invoices if GSTR1 filed after due date. If GSTR1 is filed after due date, will it be coming in 2A or not? Yes, but it will not be coming in 2B of this month, but it will be coming in the 2B of the next month. Then purpose, 2A is only for reference, but 2B is for the purpose of availment of ITC. And here we need to check how much ITC to be taken. This computation we need to keep in mind. First we need to see the supplier outward supplies reported in GSTR1 or IFF. IFF refers to invoice furnishing facility. Whenever the person is under QRMP, quarterly return monthly payment scheme, so they will be furnishing the details in invoice furnishing facility, and that details, if they file by the due date, who by the supplier, if they file by the due date, these details will be reflected in 2B of the recipient, and that ITC which is reflected in 2B of the recipient is known as matched ITC. To this matched ITC, we need to make some adjustments. Total 6 adjustments we need to make. That is known as self-assessed ITC availed in 3B. What is the ITC availed in 3B? First you need to take the matched ITC as per 2B, and 3 adjustments, even though it is coming in 2B, but you should not take ITC. Ineligible. What are they? Blocked ITC, or used for non-business purpose, or used for exempted supplies. The next 3 not reflected in 2B, but it is eligible, we can take ITC. What is that? Add GST paid under RCM, re-availment of ITC reversed earlier. So already we have reversed in the previous months and now we are re-availing it. Or ITC pertaining to the earlier tax period, not availed at that time, now we can take. So ITC not available in earlier period but reflected in 2B of that period, but we have not taken that time, so we have to take now. So we can take even though it is not coming in 2B of this month. And as per section 41, only matched ITC can be availed. Suppose if it is not at all coming in 2B except these 3, can we take extra ITC? No, we cannot take the extra ITC. Then we have reversal of ITC if supplier not filed 3B, section 41 read with rule 37A. Supplier filed the invoices in GSTR1 and GSTR1 is filed within the due date. Based on supplier GSTR1, the data is reflected in 2B of the recipient. Now 3B ITC has been taken by the recipient based on 2B. Now what happened? Supplier has not filed 3B by 30th September of the succeeding financial year. If supplier not filed 3B by September 30th of the next financial year, then recipient should reverse the ITC avail by 30th November of the succeeding financial year. So supplier should file GSTR 3B by September 30th of next financial year. If not, 2 months is there for the recipient to reverse the ITC, that is October and November. By November 30th, recipient should reverse the ITC. If recipient is not reversing the ITC by November 30th of next financial year, then they need to pay interest at the rate of 18% per annum from the date of utilization till the actual date of reversal. And suppose at a later point of time, if supplier filed 3B, can the recipient re-avail the ITC? Yes. So whatever ITC that is reversed by the recipient can be re-availed without any time limit, but the interest is gone in this case. So then next one, section 49. Section 41 talks about availment of ITC. Section 49 talks about the manner of utilization of ITC. In this we need to remember a few principles. The first principle is that there is no restriction with respect to IGST, which means IGST credit can be utilized for payment of any GST liability and any GST credit can be utilized for payment of IGST liability. Whereas between the other three, that is CGST, SGST and UTGST, respective credits only can be used for payment of respective liability and cross utilization is not allowed. Then second principle talks about the priority. I have IGST credit. First I need to use IGST credit for what? IGST liability. Thereafter between CGST, SGST in any manner and in any proportion. Then CGST credit first for CGST payable and then for IGST payable. SGST credit first for SGST payable and then for IGST payable. Then UTGST credit first for UTGST payable and then for IGST payable. So therefore, except this IGST credit, all other credits first for its liability and then for IGST. But IGST credit first for IGST, then for CGST or SGST, any manner, any proportion. So we need to ensure minimum cash outflow that should be maintained. And principle 3, before utilizing CGST and SGST credit, the credit of IGST should be exhausted. So completely the credit of IGST should be exhausted and then only we need to touch CGST and SGST credit. And so fourth principle is that when I have all the credits but I have to pay the IGST liability, first I need to use IGST credit, then CGST and then SGST or UTGST credit. Then IGST credit after utilizing for payment of IGST liability can be utilized for payment of CGST, SGST in any proportion. But depending upon how CGST, SGST liability is there, in that way you use it, that is better. So just follow the proportion of CGST, SGST liability, in that ratio you distribute it. And GST compensation cess also can be availed as ITC, but it can be utilized only for payment of GST compensation cess on outward supply. Then section 16 talks about condition for availment of ITC. So there are total 8 conditions. So only a registered person can avail the ITC, unregistered person cannot avail. And the inward supplies on which ITC to be availed should be used or intended to be used, in the course or furtherance of business. And recipient should be in possession of tax paid document. What are the various tax paid document? Tax invoice, debit note, input service distributor invoice or bill of entry. These are the various tax paid documents on which they can take ITC. And then recipient should be in possession of tax paid document, and then recipient should have actually received the goods or services. So if they have not received, for example, invoice is January but they have received the goods in February, they cannot take ITC in January, they can take ITC only in February. And supplier should have furnished the details of invoice in GSTR1, and that supplier should have paid the tax by September 30th of the next financial year. And recipient should file the returns. Which return? GSTR 3B for availing the ITC. And supplier who filed the GSTR 1, it should not be restricted in 2B of the recipient. So GST paid on inward supply should be reflected in GSTR 2B under which column? ITC available, and should not be restricted. So in this total 8 conditions, first 2 are basic conditions, that only a registered person can take ITC. The inward supply should be used or intended to be used in the course or furtherance of business. And next 3 condition from supplier point of view. Supplier should file GSTR1, he should pay GST by September 30th of next financial year, and his GSTR1 when he files, it should not come in 2B as ITC not available. Then next 3 conditions in the hands of the recipient. Recipient should be in possession of tax paid document, should have actually received the goods or services, and should file the GSTR 3B. Then next, input tax means what? Input tax means CGST, SGST or UTGST, and it also includes tax paid under reverse charge. So whatever GST that is paid under RCM can be availed as ITC if eligible, and GST paid under RCM should always be paid using the cash ledger, which means for payment of GST under RCM we should not use the credit ledger balance. So what is the way in which we compute the net GST payable? For computation of net GST payable, first we need to take gross GST payable under FCM. GST payable under FCM. We need to take GST payable under FCM. After taking FCM liability minus input tax credit. In this input tax credit, so we need to take even RCM paid or FCM paid. We would have paid on inward supply na, whether it is FCM or RCM, whatever inward supplies we have paid GST, that should be taken in input tax credit. Thereafter we need to add GST payable under RCM. So we need to add the GST payable under RCM last. Why? So because GST payable under RCM cannot be paid using input tax credit. So this is the treatment that you need to follow. First you need to take FCM liability minus input tax credit. In that input tax credit it also includes GST paid under RCM on inward supply. So once you adjust it, finally you need to again add GST paid under RCM. So GST paid under RCM has two treatments. One, it will be taken as ITC and adjusted against FCM liability, plus it should also be shown as separate liability because it should be paid in cash. It cannot be paid using the electronic credit ledger. Then next one, IGST paid on import of goods can also be taken as ITC, but input tax does not include tax paid under composition scheme, because first of all a person opting for composition scheme should not charge GST to us. Even if we charge GST to us, we cannot take ITC with respect to that. And then what are the contents of invoice for availing the ITC? So in the document minimum these details should be there, then it will be called as a valid invoice for availment of ITC. What are the minimum details? It should have description of goods or services, it should have the details of supplier and recipient, and value and GST and place of supply. So supplier and recipient GST, description, value, tax and place of supply. So these things should be there in an invoice, then it will be called as a valid invoice. Then inward supply means what? Inward supply means either inputs, input service or capital goods. Inputs means goods which are purchased and charged to P&L. Capital goods means goods which are purchased and capitalized in the books of the recipient. Then input service means any service which is received. Then there is a concept of deemed delivery. If goods are not received in my premises, but the goods are received in the third party premises, that is bill to ship to transaction. Invoice is raised to me, but the goods are received in some other place. So can I take ITC? Yes. As and when the goods are received in the shipping address, it is deemed that the billing address has received the goods or services and the billing address can take the ITC. So that is with respect to deemed delivery. And next, goods received in lots or installment, when the ITC can be availed only on receipt of last lot or installment. Reversal of ITC for non-payment of consideration to supplier. Suppose if the recipient has not made payment to supplier within 180 days from the date of invoice, so much of the ITC availed by the recipient needs to be reversed along with interest at the rate of 18% from the date of utilization till the date of payment or reversal. And however, interest is not payable if availed ITC is not utilized. What if within 180 days 60% is paid and 40% is not paid? Then we need to reverse the ITC proportionate to 40% only. Then the above proviso is not applicable to. So in these three cases, we don't have to bother about 180 days condition. Means even if the recipient has not made payment to supplier within 180 days, it is okay. What are those cases? Supply is covered under RCM, or supply is without consideration, or payment is made to third party on behalf of the supplier. So in these three cases, even though 180 days is not fulfilled, it is okay. That is 7(1)(c), supply without consideration, or supply covered under RCM, or 15(2)(b), payment is made to some other person on behalf of the supplier. Then next one, as and when the payment is made after 180 days, within 180 days we have not made payment to supplier, so we are reversing the ITC. Again, as and when we made payment to the supplier, can we re-avail the ITC? Yes, without any time limit, but the interest is lost. The interest is lost here. Then section 16 subsection 3 talks about depreciation. If the depreciation is computed on tax component, we purchase capital goods for 10 lakhs, GST 1,20,000. If the depreciation is computed on 11,20,000, can this 1,20,000 be taken as ITC? No. If the depreciation is computed on 10 lakhs, then this 1,20,000 can be taken as ITC. Then the time limit for availment of ITC 16(4) is same, that is 30th November of succeeding financial year or date of filing and return, whichever is earlier. And this time limit is not applicable in case of re-availment of ITC reversed earlier. Means first we are availing the ITC and we are reversing. Why we are reversing? Maybe we have not made payment to supplier within 180 days, or supplier not filed GST or 3B by September 30th, we are reversing the ITC. Again, for re-availing the ITC, we don't have any time limit. And in case of debit note, the time limit for availment of ITC depends upon the debit note date and not the invoice date. Next, apportionment of credit. Apportionment of credit here is that I have purchased some inward supply which is used exclusively in taxable outward supply. Can I take ITC? Yes. I have purchased some inward supply used for exclusively taxable outward or business, I can take ITC. If I have purchased some inward supply used exclusively in exempted or non-business, can I take ITC on the inward supplies? No. If the inward supplies is used for both taxable and exempted, can I take ITC? Yes. Proportionate ITC. How much proportionate ITC? Total ITC into taxable turnover divided by total turnover. And then inward supply used for both business and non-business purpose. Can I take ITC? Yes. Proportionate to what? Proportionate to business purpose. For example, 30% used for business, 70% for non-business. How much credit I can take? 30% credit I can take. And zero rated supplies will be treated as taxable supplies for ITC, because when our outward supply is zero rated, we may pay GST or we may not pay GST, depends upon the option that we follow. So option 1 pay GST, option 2 don't pay GST, it is up to us. But on the inward supply, can we take ITC? Yes. So therefore, for ITC purpose, the zero rated supplies will be treated as taxable for availment of ITC. Then what are treated as exempted supplies? So there are some outward supplies which are treated as exempted, even though it is not exempted actually, but it should be treated as exempted so that we cannot enjoy the ITC on inward supply. What are they? First three meaning of exempted, that is notified as exempted, nil rated, non-taxable. Then next we have supply covered under RCM. Actually supply covered under RCM, recipient will pay GST, but for the supplier it will be treated as exempted supply. Then sale of land, sale of building, sale of securities and supply of warehoused goods. These four transactions, even though it is excluded from supply, sale of land, sale of building where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier, even sale of securities and supply of warehoused goods under customs, these four activities are actually excluded from supply, but for ITC purpose it should be treated as exempted supply. What should be taken as a value? In case of land and building, you take the stamp duty value. In case of securities, you take 1% of sale value of securities. In case of supply of warehoused goods, you take the sale value, whatever is the sale value of that. Then there is one transaction, actually two transactions, even though it is exempted, but we should treat it as taxable. What are they? Generally it is exempted for payment of GST, but for ITC purpose it should be treated as taxable. What are they? Interest on loans, advances, deposits, usually exempted, but for ITC purpose it should be treated as taxable for a person other than bank, financial institution, NBFC. And then sale of duty credit scrips. Actually sale of duty credit scrips is exempted, but for ITC purpose it should be treated as taxable. These are the two transactions. So interest income, interest on loans, advances, deposits and sale of duty credit scrips, generally they are exempted for payment of GST, but while doing ITC, proportionate formula. What is the proportionate formula? Total ITC into taxable turnover divided by total turnover. There we need to classify it under taxable. The next point, generally if purchased goods are distributed as gifts or free samples, it's a blocked ITC. However, if the gifts or free samples constitute supply, we can take ITC. Example, employer purchased a mobile phone for 50,000, exactly like 40,000, and he gave it as a gift to his employee. Is that gift supply or not a supply? Not a supply, because the value of gift does not exceed 50,000. So can the employer take ITC on the mobile purchase? No. Suppose if the mobile value is 70,000 and he gave it as a gift to the employee, is it supply under 71C? Yes. As the value of gift exceeds 50,000. Now can the employer take ITC on the gift purchase? Yes, he can take ITC. So means if the purchased product is given as gifts or free samples, if it becomes supply, then he can take ITC on the gift purchase, otherwise he cannot take ITC. Then next we have 17 subsection 4, special provision for availment of ITC by banking company, financial institution, NBFC. So for banking company, financial institution and NBFC, they have two options. Option 1, they can take the proportionate ITC. What is the proportionate ITC method? Total ITC into taxable turnover divided by total turnover, or 50% of the eligible ITC, which means total ITC into 50% they can take. And in case of option 2, exclusively used for non-business and blocked credits, ITC should not be availed, but in all other cases we need to take 50% of the remaining ITC. Means what? If inward supply is exclusively used for taxable, if inward supply is exclusively for exempted, everything we need to take 50% in option 2. Then in case of option 2, 50% restriction shall not apply to inward supply from a distinct person. So whenever one bank is purchasing from another bank any services, so in that case 50% we don't have to reduce, full credit is available, and they have to exercise this option once in the beginning of the financial year, and that option exercised in the beginning of the financial year will be applicable throughout the financial year. Then we have some blocked credits. So blocked credits means ineligible ITC. Even though it is used for business purpose, we cannot take ITC. We have three block credits: motor vehicle block credit, and construction related block credit, and other blocked credits. So first one, motor vehicle related block credit. Motor vehicle is divided into three: for transportation of persons, vessels and aircrafts, and others. Other motor vehicles always eligible for ITC, but for transportation of persons, capacity does not exceed 13 or capacity exceed 13. Capacity exceed 13 also always eligible for ITC, we don't have any restriction. But the restriction is only in capacity not exceeding 13. It is a block credit, but in three exceptional cases we can take ITC. What is that? If it is used for further supply, if it is used in the business of transportation of passengers, if it is used in driving schools, ITC can be taken. In all other cases, ITC not available. Same way, vessels and aircrafts also block credit, but we have 4 exceptions. First 3 exceptions are same, that is further supply, used in the business of transportation of passengers, driving schools, and extra use for transportation of goods. ITC available, all other case ITC not available. Then we have 4 services: repair and maintenance services, authorized service station services, then insurance services, and hiring, renting and leasing of motor vehicles. These 4 services in relation to motor vehicles, vessels and aircrafts. If the motor vehicle, vessel and aircraft is eligible for ITC, on these 4 services also ITC can be taken. If the motor vehicle is not eligible for ITC, on these 4 services ITC cannot be availed. Then some key points while determining the capacity. Here capacity does not exceed 13 is there. That 13 is including driver seat or excluding driver seat? Including the driver seat. What is the meaning of further supply? Because we have exception further supply. If it is for further supply, we can take ITC. Further supply means either sale of motor vehicles or renting of motor vehicles. I am buying and selling motor vehicles. Can I take ITC? Yes. I am buying a motor vehicle and giving it on renting. Can I take ITC? Yes, I can take. Further supply includes purchase and sale of motor vehicles or motor vehicles used in the business of renting, hiring or leasing. Then repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. There is an insurance company which insures the motor vehicle, and when the motor vehicle met with an accident, the insurance company will make the payment. Can they take ITC on that repair expenses? Yes. Then hiring, renting and leasing of motor vehicles, generally it is a blocked credit. But if the motor vehicle is eligible for ITC, hiring, renting, leasing is eligible for ITC. But what if hiring, renting and leasing of motor vehicles is under a statutory obligation? They can take ITC. So for example, car purchased by a company for transporting its employees is a block credit. They cannot take ITC. So if they take the car on rent also, they cannot take ITC. But if the car they need to take on rent because government has mandated that they need to provide cab facility to the employees, then it will be under statutory obligation, they can take ITC. Ambulance and caravan are not motor vehicles for transportation of persons, means it will come under other motor vehicles, so ITC will be available. Then next we have construction related block credit. So that is any service received, works contract or any goods purchased in relation to construction of an immovable property, ITC not available. 3 inward supply: works contract, any service received or goods for construction of immovable property. For that 3 exceptions are there. What are the 3 exceptions? Suppose if these 3 are received by a builder for providing the output service of construction, can the builder take ITC? Yes. The restriction is only for the owner of the property. Also, if this expenditure is charged to P&L, can they take ITC? Yes. Or suppose if this expenditure is for construction of a plant and machinery, can they take ITC? Yes. But plant and machinery excludes telecommunication towers and pipelines laid outside the factory gate. Now, next one, other blocked credits. Other blocked credits we have membership of a club, health and fitness center. So it is a block credit. So a membership of a club, health and fitness center. What about membership of an association eligible for ITC? Membership of a club, health and fitness center is block credit. However, if it is under a statutory obligation, can they take ITC if it is incurred by employer to employee? Yes. Next one, travel benefits extended to employees on vacation. What if it is under a statutory obligation? They can take ITC. Then imports like inward supplies of non-resident taxable person. Non-resident taxable person is a person who come from outside India to India and is not having any physical place of business in India. Generally on his inward supplies he cannot take ITC. Exception is import of goods by NRTP. Then food and beverages, outdoor catering related to food. Beauty treatment, cosmetic and plastic surgery. So hair transplantation related to beauty. Then insurance, life insurance and health insurance. So these are block credits, but we have 3 exceptions. What are the block credits? Related to food, food and beverages, outdoor catering, related to beauty treatment, cosmetic surgery, plastic surgery, hair transplantation related to insurance, health insurance and life insurance. But 3 exceptions are there. If inward supply, outward supply in the same category, they can take ITC. If inward supply is used as a part of outward supply, they can take ITC, or if it is under a statutory obligation, they can take ITC. Then balance, suppose if you are purchasing from a person opting for composition scheme, it's a block credit. If purchased goods are used for personal consumption, it is block credit. If purchased goods are lost, stolen, destroyed or written off, it is block credit. Or if the purchased goods are used as CSR obligation, corporate social responsibility obligation, that's an amendment now, so then also it is a blocked credit. So these are various block credits. Then we have section 18, input tax credit in special cases. 18.1 talks about availment of ITC on closing stock. In which case we can take ITC on closing stock? Total 4 situations. First situation, you are liable to get registered and you made application for registration within 30 days. Second, you voluntarily got registered. Third, you are a registered person migrated from composition scheme to normal scheme. 4, you are a registered person whose outward supply is exempted, now became taxable. In these 4 cases, you can take ITC on closing stock. In the first 2 cases, you can take ITC only on inputs held in stock, inputs in the form of WIP in stock, inputs in the form of FG in stock. But on capital goods, you cannot take. But in case of next 2 cases, inputs in stock, inputs in WIP in stock, inputs in FG in stock, even on capital goods you can take. And in the first 2 cases, matching is not required. In the second 2 cases, matching required. Means in the first 2 cases, it need not come in 2B. But in the second 2 cases, it should come in 2B. On which date? In case of first situation, you need to see the closing stock immediately before the date you are liable to get registered. In the second case, immediately before the date you got the registration certificate. In the third case, immediately before the date of migration from composition scheme to normal scheme. In the fourth case, immediately before the date of conversion from exempted supplies to taxable supplies. And what is the time limit? So all these goods, that is inputs and capital goods, should have been purchased within 1 year prior to the closing stock date. And ITC with respect to GST paid on inputs can be taken, but for capital goods we need to adjust. What is that adjustment we need to do? We need to reduce depreciation. What is the depreciation? 5% for every quarter or part thereof from the date of purchase till the date of conversion. So we need to reduce 5% for every quarter or part thereof from the date of purchase till the date of conversion. And here for every quarter or part thereof means, for example, Jan 25th to April 6th. How many quarters? Jan 25th to April 6th. How many quarters? 1 quarter or 2 quarters? 2 quarters. Because Jan, Feb, March is 1 quarter. In April, even if few days are there, that should be taken as 1 quarter. Then they need to file an electronic declaration for taking ITC on closing stock, that is form GST ITC1, and that they should make within 30 days or such extended time by the commissioner from the date of eligibility of availment of ITC under 18.1. And this declaration should be certified by a practicing CRCMA if the claim of ITC exceeds how much? 2 lakh rupees. Then transfer of ITC. 18.3 talks about transfer of ITC when there is a transfer of business with specific provision for transfer of liabilities. Means all assets and liabilities should be transferred. Then whatever is the unutilized ITC in the electronic rate ledger of the transferor will be transferred to the electronic rate ledger of the transferee. For that, the transferor should file one form. What is that form? ITC-02. And they need to get a certificate from CACMA, and the CACMA should prove that the transfer of business is with specific provision for transfer of liabilities. In case of demerger, what will happen? In case of demerger, credit will be transferred to the new entities in the ratio of net assets, whether ITC is availed or not on that assets. For example, AB Limited is getting split into A Limited and B Limited. Now see the assets of A Limited and B Limited. In that ratio, the ITC will be transferred from AB Limited to A Limited and B Limited. And transfer or change in ownership also includes transfer or change in ownership on account of death of sole proprietor. Say there is a death of sole proprietor and his son has taken over the business. Now the son is required to get a new registration, and the son should cancel the registration of his father, and the unutilized ITC from the father can be transferred to the son. And when a single registration is getting converted into multiple registrations, so far within the state I have a single registration. Now for multiple places of business I have an option now whether to have a single registration or multiple registration. Say within Tamil Nadu I have 4 places of business. For these 4 places of business I have a single registration. Now I am getting into separate registration. Now so far whatever ITC that was there in the single registration will be transferred to the separate registration based on the assets ratio of the separate registration. For that the form will be ITC 2A, and this ITC 2A need not be certified by CA or CMA. Then next we have 18 subsection 4 read with 29 subsection 5, reversal of ITC on closing stock. When there will be reversal of ITC on closing stock, opposite of 18(1)(c) 1D. What is 18(1)(c) 1D? Registered person from composition scheme to normal scheme. So opposite is what? Normal scheme to composition scheme. Then opposite of 18(1)(d), what is that? Exempted supplies to taxable. So opposite is what? Taxable to exempted. So normal scheme to composition scheme, taxable to exempted, or cancellation of registration. Whenever these three things happen, either whenever you are going into composition scheme, or your taxable supplies become exempted, or you are cancelling your registration, you need to reverse the ITC on closing stock. What is the closing stock? Input as such held in stock, input in the form of WIP, input in the form of FG. How much ever ITC you avail, that much you need to reverse. But in case of capital goods, how much you need to reverse in case of capital goods? While availing the ITC, total GST paid minus 5% for every quarter or part thereof. But while reversing, it is different. It is total ITC divided by 60 months into balance life. You don't follow quarterly model here. So it is total ITC availed divided by 60 months. Life of the capital goods is 60 months into whatever is the balance life. For example, you use the capital goods for 24 months. And the balance life is 36 months. Out of 60 months, 24 minus if you do balance life is 36 months. So total ITC divided by 60 into balance 36 months. You need to reverse the ITC on capital goods. Then additional points, inputs and capital goods can be purchased anytime on which ITC is availed. If ITC not availed, then reversal not arise. But in case of 18(1), what we have seen, the inputs and capital goods should be purchased within 1 year prior. But in this case of reversal, we don't have to buy within 1 year, we can buy any time. If capital goods are purchased before 5 years and ITC availed, then reversal shall not arise. Why reversal shall not arise? Divided by 60, balance life is 0. So anything into 0 will be 0. 5 years over here, when 5 years is over, there is no balance life. 60 months means 5 years. So ITC availed divided by 60 months, balance life will be 0. So we don't have to reverse anything. If invoice pertaining to such capital goods is not available, then what we need to do? So we need to take the market value as on the closing stock date, and that market value should be certified by a CA or CMA. And all these details of ITC reverse should be reported in ITC 3. And if there is any balance in ITC, after reversal, the balance shall be lapsed. Suppose if there is a shortfall, for example, they need to reverse ITC on this closing stock 1,50,000, but they have only ITC 1 lakh. So from 1 lakh they will adjust 1,50,000, remaining 50,000 they will be paying. What if they have ITC balance of 3 lakhs and 1,50,000 only they need to reverse? So they will adjust, remaining 1,50,000 will be lapsed. So that is this. If there is any balance in ITC after reversal, it will be lapsed. If there is any shortfall, that has to be paid. And the computation we need to make separately for CGST, SGST, IGST. Then last section, section 18 subsection 6, this is I am purchasing some capital goods. On purchase of that capital goods, I have availed the ITC and that capital goods are sold. Then what is the treatment? So I need to take ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of supply, or GST on sale value, whichever is higher. For example, I purchase the capital goods on say 1/10/2022 and this is purchase date. This is purchased date, and thereafter I sold the capital goods on 25/11/2023 sale date. Now what we need to do is that, what is the value of the purchased capital goods? 10 lakhs excluding GST at 18%. Now what is the sale value? The sale value is 6 lakhs excluding GST at 18%. Now what I need to do is that, first I need to take ITC avail. What is the ITC avail? 1,80,000 minus 5% for every quarter or part thereof. 1/10/2022 to 25/11/2023. 1/10 October. So October, November, December 1 quarter. So then in next year till November means 4 quarters. So therefore 5 quarters is there. 5 quarters into 5%, that will be 25%. I need to reduce. So 1,80,000 minus 25%. So do the calculation. 1,80,000 minus 25%, 1,35,000, or B, GST on sale value. What is the sale value? 6 lakhs into 18%, that will be 1,08,000, whichever is higher. Which is higher? So therefore 1,35,000 is the GST payable. This is how we need to do. So GST ITC availed minus 5% for every quarter or part thereof from the date of invoice till the date of supply, or GST payable on the value of the capital goods, whichever is higher. Okay. And in case of sale of molds and dies, then refractory bricks, jigs and fixtures as scrap. Okay, you don't have to follow this ARB, whichever is higher, just you take GST payable on sale value. So this is an exception to 18.6. And first of all, when 18.6 is applicable, you purchase a capital goods on which ITC is available, then only 18.6 will be applicable. What if ITC not available on purchase of capital goods? Then you will not follow this normal section 15. Section 15 says what? Take the sale value, on that you pay the GST. Then we have a circular on replacement of parts during warranty period. I just gave the summary related to this circular. So remember, reversal of ITC by manufacturer shall not arise if such replacement of part is without consideration. Sir, I am entering into contract and I sold one machinery to you. I need to replace the parts during warranty period. But for replacement of that parts, I will purchase a part. Can I take ITC on the part purchased? Yes. We don't have any restriction. We can take ITC on the parts purchased, even though I am not charging anything for the part replaced during warranty period. If any consideration is charged with respect to such replacement, suppose some money I am collecting, then it is supply under 71A and GST payable on such consideration, then also reversal of ITC shall not arise. Amount paid towards additional warranty taxable at the rate applicable to the product for which warranty is taken. So suppose I am collecting some extra amount towards additional warranty. What is the rate of GST for this additional warranty? Whether the warranty is given, additional warranty is given at the time of sale of product or separately. If the additional warranty is given at the time of sale of product, then the rate applicable to the product should be taken. For example, you are buying a refrigerator and normal warranty 2 years. If you pay 5,000 extra, you will get an extra 3-year warranty. For this 5,000, what is the rate of GST? Whether the 5,000 is paid at the time of sale or separately. At the time of sale means take the rate applicable to refrigerator. Separately means you take the separate rate applicable to the warranty, that is general rate 18% should be taken. So amount paid towards additional warranty taxable at the rate applicable for the product for which warranty is taken, provided amount paid at the time of purchase of product. If the additional warranty is taken separately, then it will be taxable at what rate? General rate 18%. Then we are moving on to exemptions in GST. So in that exemptions, so just concentrate and listen. So all these exemptions, to the extent possible, these exemptions under GST, you revise it multiple times, because one day before the exam also you need to revise and go. Because in exam, it will be very simple. By the time you see the question, automatically it will strike that it is exempted or not. Don't by heart. You cannot by heart also. So you need to just understand these exemptions and revise as many times as you can. So first we have agriculture related services. In agriculture related services, the first exemption is any service provided in relation to agriculture or agricultural produce. You are carrying out agriculture, or there is some agricultural produce. For that, if I provide any service like harvesting service or supply of farm labor or seed testing, soil testing, like that, any service in relation to agriculture or agricultural produce is exempted. What is the meaning of agriculture? Agriculture means cultivation of plants and rearing of all life forms of animals. So for what purpose? For food, fiber, fuel, raw material or any other similar produce. Agricultural produce means what? Agricultural produce means the primary produce out of agriculture on which no processing is done, or some processing as is usually done by a cultivator, which does not alter its essential characteristics. So paddy is an agricultural produce, but rice is not an agricultural produce. Why? Because rice is processed and that process is not done by the cultivator. But in case of mango, raw mango is agricultural produce. Mango fruit is also agricultural produce, because that process is usually carried out by the cultivator, which does not alter its essential characteristics. So in case of rice, as rice is not an agricultural produce, they have given separately the exemption for rice. In case of rice, only 4 activities are exempted. What are they? Loading, unloading, packing and storage. What about agricultural produce? These 4 activities, not only these 4 activities, all activities for agricultural produce is exempted. As rice is not agricultural produce, separately this is given. Then artificial insemination of livestock, through artificial process, through injections, when the reproduction happens, that injections, artificial insemination is exempted. Then service by way of storage or warehousing of cereals and pulses. What about storage of agricultural produce? That's already covered in the first point. So it is only cereals and pulses and minor forest produce. The cereals and pulses and minor forest produce is not agricultural produce, even though its storage will be exempted. But warehousing of fruits and vegetables and other agricultural produce is covered in one above, that is any service in relation to agriculture or agricultural produce. So these are the various exemptions. Then the second one is pension services. When it comes to pension services, remember only 2 pension schemes, the money collected is exempted. What are the 2 pension schemes? Atal Pension Yojana or any state government operated pension fund. Under these 2 pension schemes, the money collected will be exempted. Then banking and other financial services. So transaction in money, the first exemption that you need to remember is interest on loans, advances, deposits is exempted. So there is a transaction in money without consideration. It is neither goods nor services. If the transaction in money is for a consideration, then it will be treated as service. Suppose if that consideration is by way of interest or discount, it is exempted. If it is any other consideration, including interest on credit card, it will be taxable. So whether interest on loan is taxable or exempted, exempted. Interest on FD, exempted. But interest on credit card will be taxable. Apart from that, other charges, NEFT, RTGS charges, debit card, credit card charges, minimum balance non-penalties charges, like that, all these charges will be taxable. Then second point, services provided by a banking company to basic savings deposit account holders under Pradhana Mantri Jan Dhan Yojana. So some accounts are opened, basic savings schemes, and for them if any service is provided, that is exempted. And next one, forex transactions, foreign exchange transactions which is taking place between banks, between forex dealers, between banks and forex dealers will be exempted. Whereas between bank or forex dealer and the customer, then it will be taxable under FCM. We don't have RCM. What is FCM, RCM? You don't have to remember, because already you know what are the list of services which are covered under RCM. Then services provided by acquiring bank. So there is an acquiring bank which do the settlement of transaction, card transaction. Example, whenever we go to a vendor, we make a card transaction. So the settlement bank will debit the money into our bank account and will be crediting into the vendor account. For doing this, they will collect a processing charges. If the transaction amount is up to 2000 rupees, there will be processing fees, but on that processing fee, GST will be exempted. So remember, GST on processing charges for a transaction up to 2000 is exempted. Then this point we already know, services provided by a business facilitator, business correspondent, agent of business facilitator or agent of business correspondent in rural area. If they are working in rural area, that is exempted. And there is an intermediary of financial service located in a multi-service SEZ in India. They are providing service to their customers outside India and in relation to currency other than Indian rupees. Now whatever money that they receive will be exempted. So multi-service SEZ in India is in gift city. So if there is an intermediary in India who is providing service to their customers outside India, so that service is exempted. Then next one we have healthcare services. Healthcare service only two exemptions, that is healthcare service by a clinical establishment, authorized medical practitioner or paramedics including ambulance service is exempted, and healthcare service in relation to animals or birds is exempted, only these two. Now what is the meaning of healthcare service? Healthcare services means any service pre-treatment, before treatment, diagnosis, treatment, post-treatment care for what? Any disease, illness, injury, pregnancy in any recognized system of medicine, and it includes transportation and ambulance. So transportation and ambulance, whether as a part of healthcare or separately also, it will be exempted, but it should be transportation of patient only in the ambulance, and but does not include cosmetic surgery, plastic surgery and hair transplantation will not be treated as healthcare services. But if these three are carried out to restore the anatomy of body parts affected due to congenital defects, that is by birth or during the growth stage or injury or trauma, if they carry out plastic surgery, hair transplantation or cosmetic surgery, that will come under healthcare services. Healthcare services provided by a clinical establishment. Clinical establishment means hospitals, nursing homes, etc. will come under clinical establishment. Authorized medical practitioner means doctor, MBBS degree and registered with the medical council, and paramedics means nurse, lab technician, physiotherapist who assist the doctors. All these people's services will be exempted. Then healthcare service in relation to animals or birds means veterinary clinic services. But related to room charges, for room charges we have one special point. What is that? Suppose if a hospital is collecting room charges, if it is ICU charges, any ICU charges, that will be exempted irrespective of the amount. If it is other room charges, that other room charges we need to check how much is the charges per day. If the charges per day does not exceed 5000 rupees per day, then it will be exempted. If the charges exceeds 5000 per day, then entirely it will be taxable. Then CBIC circulars we have related to this, renting of room to inpatients in hospitals apart from that 5000 per day. Then food supplied to inpatients is part of healthcare service and it is exempted. What if the food is supplied to outpatients? Who is outpatient? Those who come for consulting. Who is inpatient? Those who are admitted. Food sold to outpatients will be taxable. We don't have any exemption. Service provided by consulting doctor to hospital. So one hospital, there will be one consulting doctor. That consulting doctor gets money from the hospital, that is exempted. Hospital collecting the money from the patient is also exempted. Then services by way of ART or IVF for infertility treatment. These are infertility treatments that is also coming under health services, because infertility is an abnormality. To cure that abnormality, they will provide this IVF treatment, that is exempted. Then there is a rehab professional. This rehab professional is not an authorized medical practitioner but a psychology expert. They will be working in medical establishments or educational institutions. Let it be government or private, it is exempted. But if they are working in rehab centers, if it is a government or trust operated rehab center, then only it is exempted. If it is a private rehab center, then it will be taxable. Then next we have entry tickets. Following entry tickets are exempted. Irrespective of the ticket price, some entry tickets are exempted. What are they? Entry to, so total we have, so 3 things related to animals. What are the 3 things related to animals? National, that is tiger reserve, zoo and wildlife sanctuary. These 3 things related to animals. Then 3 places, that is museum, national park and entry to protected monuments. These 6 only you remember. So tiger reserve, wildlife sanctuary, zoo, and then museum, national park and entry to protected monuments. And these 2 are sporting events which was already held. And then 9 entry tickets are exempted if the ticket price does not exceed 500 rupees. So in that 4 related to performance, that is dance, music, concert and theatrical performance. And 4 events, circus, award function, then pageant and sporting event. And then 1 activity, that is planetarium, like 1 place, that is planetarium. These are the 9 entry tickets, that is dance, music, concert, theatrical performance. And theatrical performance includes drama, stage shows, etc. Even stand-up comedy show also will come under theatrical performance. Then 4 events, that is circus, award function, then pageant, that is beauty show, and then sporting event, and finally planetarium. These 9 entry tickets if the ticket price does not exceed 500 rupees per person. Then services by specified organizations. What are those specified organizations? ESIC, EPFO. ESIC full form Employee State Insurance Corporation. EPFO Employee Provident Fund Organization, that is any amount collected by these people is exempted. ESIC, EPFO, NCCCD, National Center for Cold Chain Development. Foreign Diplomatic Mission in India, that is UN organization, embassies or consulates. CMPFO, Coal-Mine Provident Fund Organization, and NPS Trust, National Pension System Trust. Any amount collected by these organizations is exempted. Then insurance services, already we have seen just now, National Pension System Trust, they will collect some money towards insurance premium, that is exempted. Any amount collected by NPS is exempted. Even if they collect by way of insurance also, it will be exempted. Then next, there is a group life insurance collected by Army, Navy, Air Force, Coastal Guard and Central Armed Police Forces. That insurance premium collected is exempted. Then services of general insurance business. So there is an insurance company providing general insurance services under government notified schemes. How do you know it is a government notified schemes? These are targeted to agriculture and farmers, below poverty line, women and infants. Then it is exempted. One more point, Nirmaya Health Insurance is also exempted. Then next one, there is a insurance company which is providing life insurance under government notified schemes. How do you know it is a government notified scheme? The scheme will be ending with the word Yojana, then it is a government notified scheme. And micro life insurance having sum assured as 2 lakh rupees, maximum sum assured as 2 lakh rupees. So not all micro life insurance is exempted. First it should be a micro life insurance and the sum assured should not exceed 2 lakh rupees. Then insurance service provided to government, any insurance, life insurance or general insurance. Then apart from this, these 5 insurances, its reinsurance is also exempted. If the main insurance is exempted, its reinsurance is also exempted. Then services provided by business facilitator or correspondent in insurance rural area. So insurance agent working in rural area, the commission received by him is exempted. Then next one, charitable and religious service. There is a charitable trust under 12A or 12AB of Income Tax Act. They are providing charitable activities. What are those charitable activities? Public health, advancement of religion, spirituality, yoga. First one is public health. And second, advancement of spirituality, religion, yoga. All Baba Swamijis. Then educational programs to orphans, physically, mentally traumatized persons or prisoners or persons over 65 years residing in rural area. And fourth one, environmental preservation. So these 4 activities are only charitable activities. Any money collected by the charitable trust will be exempted for this. Then there is a old age home. That old age home is operated by central government, state government or charitable trust under 12A or 12AB to its residents against a consideration of 25,000 per month. So to old people, they should be providing old age home. Who is considered as old people? 60 years or more are old people. For that, up to 25,000 rupees per month, then it is exempted. Beyond 25,000, entirely it will be taxable. Then services by a person by way of conduct of religious ceremony, like this purohit, priest, etc., money collected is exempted. Then there is a specified organization providing religious pilgrimage. First, it should be a specified organization providing religious pilgrimage, then it is exempted. So what is considered as religious pilgrimage? Kailash, Manas Sarovar and Hajj Yatra. Then education services exempted. In that education services, first point, there is an education institution which is providing entrance examination, collecting entrance exam fees. So education institution collecting fees by way of conduct of entrance examination is exempted. And here that education institution need not be an approved education institution. Even there is an examination board which is just conducting the exams and giving the result. Even that examination board is also treated as education institution. So that is this. Central and state education boards are treated as education institution for the limited purpose of conducting the entrance exam. Therefore, NBE or National Testing Agency, which will conduct IIT, JEE and NEET exam, is also education institution, and the services provided by them is exempted. Then next one, amount paid to training providers under Deen Dayal Upadhyaya Gramina Kausal Yojana, wherein under this DDUGKY scheme, volunteers will go to the rural area and provide the training, for which they will get some money from government, that is exempted. Any service provided by National Skill Development Corporation or Sector Skill Council or assessment agent or training partner, so any course offered by them, they will provide lot of skill development courses, that skill courses will be exempted. Then service provided by education institution, this is by education institution to its students, faculty and staff, any service, any service. What is an education institution? Category 1 up to 12th standard, category 2, so education as a part of curriculum for obtaining a qualification recognized by law, and category 3 approved occasional education. Then suppose if they are collecting money as application fee or prospecting fee from the students, prospective students, or from the school leaving students, they are collecting transfer certificate fee or migration certificate fee, even that is also exempted. Yes, application fee for entrance or fee charged for issuing eligibility certificate or fee collected for issuing migration certificate to ex-students is also exempted. So by any name, whether it is from the students or prospective students or from the ex-students, if they collect, that will be exempted. Then services provided to education institution. Don't get confused. Usually in exam we get confused between by and to. So by means education institution is the supplier. To means education institution is the recipient. So one person is providing services to the education institution. In that case, transportation of students, faculty and staff, catering, security and housekeeping. Remember, this security and housekeeping should be within premises. This security and housekeeping should be within premises. Within premises. So these 4 services provided to category 1 institution is only exempted. Transportation, then security and housekeeping within premises, catering services. Whereas admission to or conduct of examination, all 3 categories it will be exempted. Category 1, category 2, category 3. Whereas online periodicals and journals, only for category 2 it is exempted. So these are the exemptions that we have with respect to services provided to education institution. And next one, suppose if there is an Anganwadi school will come under category 1 education institution. So any catering service provided to Anganwadi school will be exempted, because catering service provided to category 1 institution is exempted. Then training in recreational activities relating to arts and culture. So arts and culture means like Bharatanatyam or dance or music, etc. It should be only by an individual, then only it will be exempted. Whereas training in sports should be by a trust, then only it will be exempted. Then next, services by assessment bodies under skill development initiative. Under skill development initiative, some assessment bodies are created by the government for the purpose of reviewing the curriculum, and they will be given some money. The money collected by these assessment bodies is exempted. Then services provided by government. So with respect to services provided by government, only 4 activities of government is covered under supply. What are they? Department of Post, transportation of goods or passengers, so airport or port services, and services to business entities. All other activities of the government is excluded from supply. In case of Department of Post, we have 3 exemptions. All other cases it will be taxable. What are the 3 exemptions? Postcard, inland letter or envelope weighing less than 10 grams. All other cases taxable. Transportation of goods or passengers, we have a separate chart. Airport or port service always taxable. For services provided to business entities, already we discussed in liability to pay GST, 14 specific exemptions and 2 general exemptions. Then services provided to government. We are discussing services provided to government. So here only government, not government authority or government entity, it is only government. So there is a government, that is central government, state government or local authority, there is government. Government is required to do some activity as per the constitution. Now they are outsourcing that activities to us. Now when we provide services to the government, if it is a pure labor service, it is exempted. If it is a composite supply of goods and services, then also it will be exempted if the value of goods does not exceed 25% of the total, then it is exempted. For example, government is required to do the solid waste management, cleaning, and for which they outsourced it to me. We are providing solid waste management service, it's a pure service, it is exempted. Suppose if it is laying down road, in the road if the value of goods exceeds 25% of the total, it will be taxable. If the value does not exceed 25% of the, that is if the value of goods does not exceed 25% of the total, it will be exempted. But remember, first condition you need to see is that that is an activity which the government is required to do as per constitution. They are outsourcing it to another person. If it is a pure service, it is exempted. If it is a composite supply of goods and service, check the value of goods. If the value of goods out of total is less than or equals to 25%, then also exempted. Then government includes public works department. Then composite supply by way of milling of wheat into wheat flour. So government is procuring wheat flour and for distribution it in the public distribution system, ration shops. Now in the wheat flour, what is the value of goods? Goods is wheat. Wheat is only high value. So therefore it will be coming under exemption or not? No exemption, because the value of goods involved is more than 25%. Then next one, this is an amendment, services provided to government authority. The first point what we have seen is not applicable to government authority or government entity, it is only to government. Whereas the second point is services to government authority. What services provided to government authority is exempted? Only these 5 activities: water supply, public health, sanitation conservancy, solid waste management. Solid waste management means cleaning activity. Sanitation conservancy means pesticides, gases, etc. Slum improvement and upgradation. Only these 5 activities provided to government authorities exempted: water supply, public health, sanitation conservancy, solid waste management, slum improvement and upgradation. Then any training program for which greater than or equals to 75% of the total expenditure is borne by central government, state government or local union territory is exempted. Means there is a training program for which 75% or more expenditure is paid by government and remaining amount is paid by the student. Now the entire training program is exempted. Then suppose if it is scholarship for students with disabilities where the total expenditure is borne by government, then it will be exempted. Then we have a CBIC circular, services procured by Indian Army which does not perform any functions listed in Article 243G or H of the Constitution are not covered under above exemption. So because basically Indian Army is not required to do any activities as per the Constitution. Then look into the next one, renting. Renting services, in case of renting of movable property, already we have seen 4 exemptions. So renting of motor vehicle that can carry more than 12 passengers to a state road transport undertaking, renting of motor vehicle that can carry more than 12 passengers, electric motor vehicle to a local authority, renting of motor vehicle to a GTA, renting of bus to a person who provides transportation service to education institution up to 12th standard or equivalent, category 2. So these 4 exempted. For movable property, building already we know the exemption. What is the exemption for residential property? Residential property given to an unregistered person is exempted. Residential property to a registered individual for his family stay is also exempted. Then land. So renting of land. Upfront charges in case of long-term lease. So we are giving the land on lease. So that lease is for a period 30 years or more. 30 years or more. And for which we are collecting some upfront charges. So this land is industrial land or development of infrastructure for finance business by state government industrial development corporation. The charges collected is exempted. Then next one, second renting is renting of precincts of a religious place meant for general public. So there is a place meant for general public, precincts of the place like a temple, etc. that is registered as a trust. They are giving it for accommodation. So how much the charges should be per day so that it is exempted? Less than 1000 rupees per day. Suppose if they are giving for marriage or any hall, etc. then how much the charges should be per day? Less than 10,000 per day, not less than or equals to, less than. Suppose if it is for shop, how much it should be? Less than 10,000 per month. So less than 10,000 rupees per day, less than 10,000 per day, less than 10,000 per month, then it is exempted. Then next, sports services. In case of sports services, already we have seen sponsorship of a recognized sporting event is exempted. What is a recognized sports body? You can see below. Recognized sports body means National Sports Federation, Inter-University Sports Board, Paralympic Committee, Indian Olympic Association, Central Civil Services, Culture and Sports Board, and Panchayat Sports Board. These are the 6 sports bodies which are recognized sports bodies, and any sponsorship money collected by them will be exempted. Other cases it will be taxable, and we need to see recipient body, corporate or firm, it is RCM, otherwise it will be FCM. For example, BCCI is a recognized sports body. They collect sponsorship money from a body, corporate or firm or sole proprietor, that will be exempted. Whereas IPL is not a recognized sports body. They are collecting money from a body, corporate or firm, it will be taxable under RCM, body, corporate or firm will pay. If they collect money from a sole proprietor, it will be covered under FCM. So liability to pay GST is on the supplier. Then services provided by individual as a player, referee, umpire, coach or team manager to recognize sports body is exempted. Who are they? Player, referee, umpire, coach, team manager to recognize sports body exempted. Apart from these people, if others are providing services, that will be taxable, like curators, commentators, etc., that will be taxable. That too, they should provide service only to a recognized sports body. What if they provide service to unrecognized sports body? That will always be taxable. Then service provided by one recognized sports body to another recognized sports body is also exempted. There is one recognized sports body which is providing services to another recognized sports body. For example, BCCI providing services to Indian Hockey Federation, that will be exempted. Then next, services by unincorporated body or non-profit entity. There is an unincorporated body or a non-profit entity providing services to its members and they are collecting some money. Suppose if it is a trade union, association of traders, exempted. Suppose if that service itself is exempted, no need to pay GST. Suppose if it is a resident welfare association, how much is exempted? Per month, if they are collecting up to 7,500 rupees per member, it is exempted. Suppose if it is an agricultural, industrial, labor organization or association, entirely exempted. So apart from these 4, any other association, if they are collecting up to 1,000 rupees per annum per member, not per month, per annum, then it is exempted. Beyond this 1,000 rupees means entirely taxable. Then in this regard, there is one circular. So usually electricity charges recovered by the resident welfare association from its owners. Suppose if they are recovering on an actual basis, means electricity bill is in the name of the member and that bill is paid by the association and recovered from the member, it will not be included in the value. Suppose if the bill is in the name of the association and the association is recovering it from the members on actual basis, then also it will not form value. Suppose if they are apportioning it between the members and because of it they get some profit also, then it will be included in the value entirely and they need to pay GST on that. Means while counting the 7,500, we need to add this. Okay. Then suppose if it exceeds 7,500 per month per member, entirely it will be taxable. Then transportation of passengers. For transportation of passengers, first for railways, you just remember exemption. So remaining and all will be taxable. So transportation of passengers, railways, 2 exemptions. What are the 2 exemptions for railways? Other than AC or first class is exempted. Other than AC or first class is exempted, means general ticket, sleeper ticket, etc. exempted. Then metro, mono, tramway will be exempted. Remaining and all will be taxable. Then for airways, airways also 2 exemption. Starting point or ending point is in northeastern states or Bagdogra in West Bengal in economy class. Or consideration received for viability gap funding up to 3 years from the date of commencement of operations, these 2. Then in case of waterways, again 2 exemptions. Inland waterways fully exempted. Coastal waters means seaways between place in India, only specified goods. What are the specified goods? For GTA, what are the specified goods? The same specified goods. So but here we are talking about passengers. So passengers, everything will be exempted. Coastal waters within India other than for tourism purpose. So inland waters passengers fully exempted, coastal waters other than tourism purpose, but it should be within India. Then for roadways we have 3 exemptions. Non-AC contract carriage, non-AC contract carriage other than tourism or hire, non-AC stage carriage, metered cab or auto rickshaw, these 3 are exempted. So this simple chart you need to remember for exemptions, and all other cases transportation of passengers will be taxable. Same way transportation of goods, and what are northeastern states I have given here. And one more point, generally in case of roadways, non-AC stage carriage, non-AC contract carriage other than tourism or hire or metered cab or auto rickshaw is exempted. Suppose if it is through e-commerce operator, then it will be taxable. Generally auto is exempted, but if it is Ola auto or Uber auto, it will be taxable. Then transportation of goods. For transportation of goods by railways, only one exemption, that is specified goods. And airways outside India to India is only exempted. Then waterways, two exemptions, inland waters, coastal waters, specified goods. And roadways other than GTR courier agency, everything is exempted. So small trucks, if they transport goods, that will be exempted other than GTA or courier agency. Now this specified goods point comes in three places. Transportation of specified goods is exempted in three places. One is railways, another is coastal waters between India, and GTA. What are those specified goods? Same list of specified goods, that is agricultural produce, food grains including flours, pulses, milk and salt, organic manure, newspapers and magazines, defense and military equipments, relief materials for natural and man-made disasters. Then when it comes to GTA, so we already saw these three exemptions that we have, and GTA has two options. Either they can go for FCM or RCM. In case of FCM, again GST 12% with ITC, 5% without ITC. RCM always 5%. They need to select this option in the financial year, and they need to decide it between 1st January to 31st March of the previous year. And amount collected for transportation of passengers in private ferry in coastal waters. Generally transportation of passengers in coastal waters other than tourism purpose is exempted. So should it be by government or private also? Either government or private, it will be the same. Then next one, you see there is a owner of the vehicle who is giving a non-AC vehicle to a person requiring the vehicle for transportation. So like a renting, okay. But how it is rented? Operated on a predetermined route based on a predetermined schedule. Predetermined route based on a predetermined schedule means what? That is, so you have to pick the person here, here, here and drop them like that. Predetermined schedule, predetermined route. Then it will be treated as contract carriage other than tourism or hire. Non-AC contract carriage is exempted. Then suppose if the vehicle is at the disposal of the recipient, you are taking the vehicle, it is with you only for a particular voyage or journey, 3 days, 4 days trip, then it will be called as contract carriage for hire or tourism, it will be taxable. Suppose if it is for a period of time, 1 month, 2 months, 6 months like that, if you are taking it on rental basis, then it will be called as renting of motor vehicle and it will be taxable. In case of renting of motor vehicle, we have FCM as well as RCM. Contract carriage we have only FCM, but renting of motor vehicle we have FCM, RCM. Three conditions: RCM, supplier other than body corporate, recipient body corporate, rate of GST 5% RCM, all other cases it will be FCM. Then construction services. In case of construction services, construction of an individual house irrespective of the floor area or cost, not as a part of complex, is exempted. But remember, only construction of individual house is exempted. If it is repairs of individual house, it will be taxable. And construction or repair or renovation, construction, repair, renovation or alteration of project. Which project? Housing for All Mission or Pradhan Mantri Awas Yojana. But for individual house, only construction is exempted. For this project, both construction, repair and renovation is exempted. Then whenever we are charging some amount towards the flat, so whenever we are selling the flat, we not only sell the flat, but we also sell the land below that flat. So in that case, we don't have to pay GST on the full value. 1/3 of the flat value will be excluded towards UDS, undivided share of land. 1/3 of the gross value of flat is exempted towards land or undivided share of land when gross value includes value of land. Then this TDR, FSI and long term lease, we have seen the exemption. What is that exemption? Value of inward supply into 18%, floor area of the residential units booked before completion certificate divided by total floor area. For example, we already discussed this example. For example, the value of inward supply of TDR FSI is 10 lakhs, excluding GST 1,80,000. So 1,80,000. What is the formula? 1,80,000 into numerator, residential units, carpet area of residential units booked before completion certificate, 28,000 square feet, divided by total carpet area, 50,000 square feet. So how much is exempted? 1,80,000 into what by what? 28 divided by 50 will be exempted. So remaining they need to pay GST under RCM. Then So previously annuity, that is charges, toll charges payable by way of annuity was exempted. Now toll charges payable by way of annuity will be taxable. These advocate services already we have discussed. What are the exemptions? And next one, exemptions under IGST Act. See this, first point, sir, if supplier of service and recipient of service both are outside India, all activities will be exempted. Okay. So, but this point you omit now. This is not relevant. This is not relevant. All services are exempted if both supplier and recipient of service is located outside India. Previously, transportation of goods by vessel outside India to India, like that we had one point, but that is also not relevant now. All service exempted if supplier of service is outside India and recipient of service is located outside India. Then there is an Indian tour operator who is providing tour operator service to a foreign tourist wholly outside India, that will be exempted. What if the tour is partly in India, partly outside India? Then proportionately it is exempted. How much it is exempted? Total consideration into number of days the tour conducted outside India divided by total number of days, or total consideration into 50%, whichever is lower is exempted. While taking the number of days, if it is more than or equals to 12 hours, you take it as full day. If it is less than 12 hours, you take it as half day. Then fourth point, there is an intermediary, that is a broker, who is connecting a seller outside India, buyer outside India. This broker gets a brokerage, that brokerage is exempted. So intermediary getting money for transaction made to seller outside India and buyer outside India. Then next one, miscellaneous exempted services. I am transferring the business as a going concern, slum sale, etc., for which I get some consideration, that is exempted. Supply of service associated with transit cargo to Nepal and Bhutan. I am taking a cargo to Nepal and Bhutan. For the transportation charges or loading charges, unloading charges, everything will be exempted. Service by way of collecting or providing news by independent journalists, Press Trust of India or United News of India is exempted. Then services of public libraries. So public libraries will be giving lending, for which they get some lending fees, that is exempted. And there is an organizer who is organizing a business exhibition, where the business exhibition is held outside India. So that is exempted. What if the business exhibition is in India? Then it will be taxable. Then service by way of public conveniences, like public toilet. For the public toilet, whatever money that is collected is exempted. Then toll charges, usually for using highways we need to pay toll charges, that will be exempted. And even overloading charges. So sometimes when we carry the huge goods, overloading charges or higher toll charges for not having FASTag is also exempted. Then there is a performance artist. That performance artist is performing before the audience. So in music, dance or theatre, in folk or classical genre, and if they are getting consideration up to 1,50,000 per performance, then it will be exempted, but the exemption is not available if they are acting as a brand ambassador. Then this point we have seen, training in arts or culture should be only by an individual, sports should be by a trust. Then satellite launch services provided by any person. Previously this Indian Space Research Organization, Antrix Corporation was there, but by any person. So that is an amendment. Satellite launch services provided by any person will be exempted. Then liquidated damages, what is the treatment? Liquidated damages means consideration for tolerating an act. So when a contract got breached, the person who breaches the contract will pay to the other person some amount called as damages. So that is called as liquidated damages. See this. When a contract has been broken, the party which suffers such breach is entitled to receive from the other party compensation for any loss or damage caused to him. So that particular amount, if it is a mere compensation, so to compensate the loss or damage or injury, that will not be treated as consideration. You just connect that here. That will not be treated as consideration and not chargeable. Suppose if it is specified in the contract, but the charges are in the nature of penalizing a person to discourage such act. Sir, suppose if it is mere compensation not arising in the contract, it is not consideration. Even if it is specified in the contract, but the objective is not to earn money, but to discourage a person from doing it, like traffic fine and penalty, check dishonor charges, etc. So example, traffic fines, then check dishonor charges, these are all like not treated as consideration and not taxable. Any other amount will be treated as consideration and taxability depends upon principal supply. For example, ticket cancellation charges, railway ticket cancellation charges. If it is a AC ticket, as AC ticket is taxable, the AC ticket cancellation charges also taxable. Whereas in case of sleeper class ticket is exempted. So cancellation charges for sleeper class ticket is also exempted. That is this. So this is about exemptions under GST. So look into the next area, that is composition scheme. Composition scheme is given under section 10 of CGST Act. We have two types of composition scheme. One is composition scheme under section 10 subsection 1 and composition scheme under section 10 subsection 2A. To whom composition scheme under 10(1) is applicable? To a manufacturer or trader or supply of food service provider. Whereas to whom 10(2)A will be applicable? Manufacturer, trader or any service provider. Now 10(1) is also applicable to any other service provider, but with a limit. What is that limit? Up to 10% of turnover during previous year or 5 lakhs, whichever is higher. However, they can provide, that is being a manufacturer, trader and supply of food service provider. So they can provide service, any service up to 10% of turnover during previous year or 5 lakhs, whichever is higher. But this restriction is not there for 10(2)A. 10(2)A, manufacturer, trader, service provider, for any amount they can go for 10(2)A. But when 10(1) will be applicable, if their aggregate turnover during the previous year does not exceed 1.5 crores, in case of 8 states, it will be 75 lakhs. What are those 8 states? MMTN, USAM. Manipur, Mizoram, Tripura, Nagaland, Uttarakhand, Sikkim, Arunachal Pradesh and Meghalaya. Then next, when composition scheme under 10(2)A will be applicable, if aggregate turnover during previous year does not exceed 50 lakhs, then 10(2)A will be applicable. What is the benefit of reduced rates? So if they are under composition scheme 10(1), so being a manufacturer, the rate of GST is 1% on what turnover? Total turnover. If they are a trader, 1% on taxable turnover. If they are food supplier, then 5% on total turnover. So say this, 1% on total turnover in case of manufacturer, 5% on total turnover in case of food service provider, 1% on taxable turnover in case of trader or services up to the 10% limit. Okay. Whereas under 10(2)A, the rate will be always 6% on total turnover. Current year limit for reduced rates. So previous year, if it does not exceed 1.5 crores or 75 lakhs, current year they can go for composition scheme. Current year also they should ensure that they are not crossing 1.5 crores or 75 lakhs. In case of 10(2)A, 50 lakhs. Then difference in conditions. So S9 RCM, they cannot go for composition scheme. What is this S9 RCM? S for service provider other than supply of food or beyond 10% limit, they cannot go for composition scheme 10(1). N for non-resident taxable person cannot go. Then I for a person who is making interstate supply of goods or services cannot go for composition scheme. Another N, non-taxable supplies. E for supply of services through e-commerce operator. Sir, can supplier of goods through e-commerce operator go for composition scheme? Yes. But supplier of services through e-commerce operator not possible. That's an amendment. Then R, RCM under 9(4), not paid on stock. So then C for casual taxable person, M for manufacturer of notified goods. What are those notified goods? Ice cream, edible ice, pan masala, tobacco and tobacco products, aerated waters, bricks and roofing tiles. Then they cannot go for composition scheme. Can a trader of these goods go for composition scheme? Yes. So these are the restrictions for 10(1). Whether we need to check this for previous year or current year? Current year. Current year only we should not make interstate supplies. Can previous year we can make interstate supplies? Yes. Current year we should not make interstate supplies, non-taxable supplies, etc. Now, in case of 10(2)A, it is 9 RCM. That is yes, because any service provider can go for 10(2)A. So 9 RCM. This is the difference in the condition. Then next, disadvantage of composition scheme. Person opting for composition scheme cannot avail ITC on their inward supplies, and even they cannot charge composite tax to the customers. And what is the document that they will be giving? Tax invoice or bill of supply? Bill of supply. Then next one, what is the meaning of aggregate turnover? So generally what should be taken as the aggregate turnover? normal meaning of aggregate turnover with some adjustments. Generally, aggregate turnover is taxable supply, exempted supply, non-taxable supply, zero rated supply. It excludes inward supply under RCM, and even it excludes CGST, SGST, etc. Now, two more adjustments you remember for aggregate turnover. Interest on loans, advances, deposits will not be taken, and even pre-registration turnover, before you are getting registered, you have some turnover that will be included in the aggregate turnover. Then, interest income will not be considered for calculating aggregate turnover as well as turnover in a state. Then person opting for composition scheme can provide service up to 10% of turnover during previous year or 5 lakhs, whichever is higher. And again, while computing this 10%, also interest on loans, advances, deposits should not be taken. And what is the rate applicable for this 10% services? The rate applicable to trader. What is the rate applicable to the trader? 1% of taxable turnover. And other procedural aspects, suppose if the person is already registered, they need to apply in CMP2 before commencement of the financial year. Suppose if they are already registered. Suppose if they are not already registered, now only they are getting registered, at the time of registration itself they can come into the composition scheme. But if they are already registered, they need to wait till beginning of the financial year, and then only they can come into composition scheme by applying in CMP2. But not already registered, now only they are getting registered. So then apply in GST REG1 and select composition scheme anytime during the financial year. And they need to display composition taxable person in every notice signboard displayed at the principal place of business and every additional place of business. And what is the return that they need to file? They need to file a quarterly return. In what form? CMP 8. By when? By 18th of the month following every quarter. And they need to pay GST. GST payable on advances, because we have seen. So, composition scheme person is required to pay GST based on time of supply, due date of invoice, actual date of invoice, or date of payment, whichever is earlier. So, they need to pay GST on advances. So, what they need to do? First, they need to see what is the value of bill of supply during current quarter, plus advances received in the current quarter for which supplies will be made in future, minus advances already received in the past quarter for which bills are raised in the current quarter, because that advance already taxed, that should be removed. So, value as per bill of supply during current quarter plus advances received during current quarter pertaining to next quarter minus advances received during the previous quarter pertaining to current quarter. And they need to file an annual return in GSTR4 by 30th April of the succeeding financial year. Then, the validity of the composition scheme, if all conditions are satisfied, the option remain valid. If the conditions are not satisfied, they need to pay tax as a normal taxpayer, issue a tax invoice for taxable supply, and they need to exit from the scheme. What is the time limit for exit from the scheme? Within 7 days, they need to exit from the scheme when the conditions are breached, and they need to file one form, that is CMP4. Voluntarily also, whenever they want to exit from the scheme, they can exit by filing CMP4. And proper officer, suppose if the taxpayer is not eligible or contravened the rules but continued in the composition scheme, officer will give a notice in CMP5. They need to give reply to the notice within CMP6 within 15 days. Thereafter, within 30 days, either officer will allow them to continue in the composition scheme or deny the composition scheme. And next, these are the various forms. Whenever they enter into composition scheme, so then they need to reverse the ITC on closing stock. So therefore, ITC 3. These two will be one combo. And whenever they exit from the composition scheme, they go for regular scheme, which means they can avail ITC on closing stock. So ITC 1 needs to be filed. And CMP 5, 6, 7, 8. Then denial of composition scheme will be prospective or retrospective, either prospective or retrospective, but not before the date of breach. For example, one date we have breached the conditions. Thereafter, we continued in the composition scheme. Now, officer is denying the composition scheme. Either it can be prospective with effect from today, or it can be retrospective, but not before the date we committed the breach. Then, meaning of various turnovers. In composition scheme, we will come across these 3 turnovers. Aggregate turnover for determining eligibility for composition scheme, or turnover for determining 10% limit of services, and turnover for payment of GST under composition scheme. Aggregate turnover for what? If the previous year aggregate turnover does not exceed the limit, we can go for composition scheme for deciding the eligibility. Then turnover for computing 10% limit, we can provide service up to 10% of turnover during previous year or 5 lakhs, whichever is higher. Then turnover for payment of GST under composition scheme, current year. So, aggregate turnover previous year, turnover for 10% previous year, but turnover for payment of GST under composition scheme current year. Now, what will be taken as the aggregate turnover? It should be computed on all India basis, but turnover will never be all India, turnover will be state wise, that is the difference. So, highlight this. So, aggregate turnover is on all India basis, but this turnover will be state wise. And so, for payment of GST, we need to take current year turnover. Then, what should be taken in aggregate turnover? So, taxable supplies will be coming exempted, interest on loans advances will not be taken, non-taxable supplies will be coming, exports will come, interstate supply will come, inward supply under RCM will not come, taxes will be excluded, pre-registration turnover included. Now, from aggregate turnover to turnover for determining 10% limit, what is the difference? So, the difference is that, so aggregate turnover is on all India basis, but turnover for computing 10% limit is state wise, rest of the thing is same, ditto, copy paste. Then what is the difference between turnover for computing 10% limit and turnover for payment of GST under composition scheme? That is for previous year and this is for current year. And next one, so non-taxable supplies should not be there, interstate supplies and exports should not be there. If they are having, then they are disqualified from composition scheme. And one more difference is that pre-registration turnover should be excluded, because before registration they don't have liability, so only when they register their liability shall arise. So pre-registration turnover should be excluded. What is the meaning of not applicable? Not applicable means these supplies cannot be made during the current year, and if made, the person is disqualified from the composition scheme. So this is about composition scheme, and we'll take a break. So, and lunch break, and thereafter we will continue with the remaining aspects. Okay, so we'll start with registration. So far we have seen composition scheme up to composition scheme. The next area is registration. In this registration, total we have 9 sections. Section 22 talks about when a person is required to get registered. Section 23, exemption from registration. Section 24, compulsory registration. So when a person is required to get registered as per 22, whenever their aggregate turnover exceeds threshold limit. What is the threshold limit? Suppose if you are doing business in MMTN, Manipur, Mizoram, Tripura, Nagaland, any state, so then the applicable limit will be 10 lakhs for both goods and services. Suppose if you are doing business in U-Stamp, that is Uttarakhand, Sikkim, Telangana, Arunachal Pradesh, Meghalaya and Puducherry, then the limit will be 20 lakhs for both goods and services. For all other remaining states, if you are exclusively engaged in supply of goods, it will be 40 lakhs, otherwise the limit will be 20 lakhs. So aggregate turnover we need to compute on an all India basis and not state wise, and the limit of 40 lakhs is applicable only in case of exclusive supply of goods. If a person is supplying both goods and services or services, then the limit of 20 lakhs or 10 lakhs is only applicable. Suppose if you are doing business from multiple states, then what you should remember? So whether one of the state is a special category state and taxable supplies are made from that state, so then the limit will be 10 lakhs. Suppose if none of the states is in MMT and U-Stamp, and if you are exclusively engaged in supply of goods, then it will be 40 lakhs. Suppose if you are doing business in U-Stamp, then the limit will be 20 lakhs only. So therefore, so you need to remember total 6 points. First is if you are doing business in a single state, and if that single state is in MMTN, the applicable limit will be 10 lakhs. If that single state is in U-Stamp, the applicable limit will be 20 lakhs. Suppose if it is other state, exclusive supply of goods 40 lakhs, other cases it will be 20 lakhs. Then in case you are doing business in multiple states, one of the state is in MMTN and taxable supplies are made from that state, then it will be 10 lakhs. None of the state is in MMTN U-Stamp and you are exclusively engaged in supply of goods 40 lakhs, in the remaining cases balancing figure it will be 20 lakhs. So the limit of 40 lakhs is not applicable in the following cases: if a person is voluntarily getting registered, or those who are compulsorily required to get registered under 24, or person making supply of ice cream, edible ice, pan masala, tobacco and tobacco products, bricks and roofing tiles. This list of goods we have even in composition scheme, but the difference from there to here is that their manufacturer of notified goods cannot opt for composition scheme. Here supplier of these goods, supplier can be manufacturer or trader, will not get 40 lakhs limit. Also there we have aerated waters, here we don't have that aerated waters, and the remaining goods will be the same. Then, so as and when aggregate turnover exceeds the threshold limit in a financial year, so as discussed above, the person is liable to get registered as per 22 subsection 1. As per 23, a person is exempted from registration if they are exclusively engaged in making exempted supplies, including non-taxable supplies, means they are making only exempted supplies or non-taxable supplies, or they are an agriculturist, they are engaged in supply out of cultivation of land. So means they will not be doing anything. Whatever cultivation of land they get, if they are selling only that, they are not required to get registered. If they are exclusively engaged in RCM supplies, for example, advocates outward supply is fully covered under RCM, so advocate is not required to get registered. So then if a person is making both exempted and taxable supply, then the above exemption is not available. Then next one, person who makes supply of goods through e-commerce operator is generally compulsorily required to get registered, but we have seen some relaxation. So that is an amendment. What is that? So if a person is making only intrastate supply, he should not make interstate supply. So a person making supply of goods through e-commerce operator whose aggregate turnover does not exceed threshold limit is not required to get registered. However, they should ensure the following conditions. What is that? They should not make interstate supplies, they should not make supplies through e-commerce operator in the other state, and they should have a valid permanent account number, state, and on portal they need to get a validation and obtain a unique enrollment number. So no supply shall be made through ECO unless the person is granted unique enrollment number. Condition number 1, they should not make interstate supplies. Condition number 2, they should not make supplies in the other state through e-commerce operator. They should have a valid permanent account number, and they should obtain a unique enrollment number from the portal, and that unique enrollment number should be updated with the e-commerce operator. And once their aggregate turnover exceeds threshold limit, they will get a normal registration, and this enrollment number cease to be invalid. Then next, compulsory registration we have in 22 as well as in 24, but the difference in compulsory registration 22 is that, so they can make application for cancellation if their aggregate turnover falls below threshold limit. But in case of 24, if a person is covered under compulsory registration, they can never make application for cancellation of registration. Irrespective of threshold limit, they are liable to get registered. Now, what are the 3 cases of compulsory registration in 22? If they are already registered under the earlier indirect tax regime, they should also be registered under GST, transfer of business, or transfer pursuant to scheme of amalgamation, merger or demerger. But in these 3 cases, they need to compulsorily register, but if their aggregate turnover falls below threshold limit, they can make application for cancellation of registration. Whereas section 24 compulsory registration, I creations, I for interstate supply of goods, not services, only interstate supply of goods other than handicrafts. C for casual taxable person other than handicrafts. Casual taxable person means a person who is coming from other state to this state and is not having any physical place of business in this state. And then recipient who is liable to pay GST under RCM is also compulsorily required to get registered. Then e-commerce operator liable to pay GST under 9(5), that is the HATE, housekeeping service, accommodation service, transportation of passengers, and eating food from restaurant. And e-commerce operator liable to deduct TCS. You can simply remember e-commerce operator is compulsorily required to get registered. Then A, agent making supply on behalf of the principal. So then T for TDS deductor. I for input service distributor, that is the head office which takes the credit and distributes the credit to the branch offices. That head office should get registered compulsorily. O for OIDR supplier. So located outside India and making supply to non-taxable online recipient in India, that supplier is liable to pay GST, so they need to compulsorily get registered. And N for non-resident taxable person who come from outside India to India, not having any physical place of business in India. Then yes, supplier of goods through e-commerce operator, any supplier who is making supply of goods through e-commerce operator other than those making only intrastate supplies. So these people are compulsorily required to get registered. Now, if a person is exempted from registration, for example, I am making outward supplies and it is covered under RCM, so I am exempted from registration. I have some inward supply on which I need to pay GST under RCM. Am I compulsorily required to get registered? No. Once a person is exempted from registration, they are exempted from registration even though they are covered under 24, which means section 23 overrides section 22 as well as section 24. Same way, section 24 overrides section 22. Even though my aggregate turnover does not exceed threshold limit, if I am covered under 24, I am compulsorily required to get registered. So the priority is what? First you need to see 23. If you are exempted from registration, you are exempted from registration. That's it. Then don't refer anything else. If you are not exempted from registration, then you need to check 24 compulsory registration. If you are not coming there also, then only other cases. If your aggregate turnover exceeds threshold limit, you need to register. Then section 25 talks about procedure for registration. In this procedure, you need to remember these 6 forms: REG1 application for registration, REG2 acknowledgement, REG3 notice, and REG4 reply to the notice. Thereafter, once you give reply, either they will be rejecting the application in REG5 or they will give certificate of registration in REG6. And the time limit in all these cases is 7 working days. So once you make the application for registration, what is the time limit within which you need to make application for registration? Within 30 days from the date you are liable to get registered, you need to make application for registration. REG1 to REG2, once you make application, you will get acknowledgement immediately. Then within 7 working days, either you will get a notice or you will get a certificate of registration. So from application, either you will get a notice or you will get certificate of registration within 7 working days. So that is this REG1 to REG3 or REG1 to REG6, 7 working days. Suppose if you get a notice, thereafter you need to give reply to the notice, and that reply to be given within 7 working days. So REG3 to REG4 will be 7 working days. Once you give reply to the notice, thereafter either rejection of application or certificate of registration should be within 7 working days. So REG3 to REG4 to REG5 or 6 will be within 7 working days. Then at the time of making application for registration, we don't have to furnish the bank details. We can furnish the bank details at a later point of time also. There is an amendment here, and that time limit is 30 days. Previously it was 45 days. Now they have amended it to 30 days from the date of registration or date of filing GSTR1, whichever is earlier. Previously it was 45 days and the due date of filing GSTR3B, whichever is earlier, but they have made it as 30 days from the date of registration or date of filing GSTR1. It's not due date of filing GSTR1, date of filing GSTR1, whichever is earlier. And this provision is not applicable for those who are required to deduct TDS or TCS, which means that they need to give the bank details at the time of registration itself. But all others, they can give bank details at a later point of time. And this above registration procedure is not applicable to not you. So that you need to remember what is that not you. So not you is N for NRTP, O for OIDR supplier, T for TDS TCS deductor, U for UIN holder. For these people, this registration procedure is not applicable. Then every person who is making application for registration has the option to choose Aadhaar authentication or not. Suppose if they choose the Aadhaar authentication, they need to complete the authentication within 15 days from the date of submission of application form. And date of authentication or 15 days, whichever is earlier, will be deemed to be the date of submission of application. Suppose if they have opted for Aadhaar authentication, the day when they complete the authentication is the date of application. If they are not completing within 15 days, so then on expiry of 15 days, it is deemed that the application is made without Aadhaar authentication. Now, physical verification shall be conducted within 30 days. Suppose if we are making application without authentication, or we made application with authentication but authentication not completed within 15 days, then in that case they will do the physical verification. That physical verification will be taking 30 days to grant the registration certificate. So shall be conducted within 30 days of submission of application, and that is 15 days from part B if the authentication is not done. And applicability of Aadhaar authentication, to whom authentication is applicable and not applicable. If you are an individual or sole proprietor, if you are citizen of India, then it is applicable. If you are not a citizen of India, then it is not applicable. HUF, only Karta is required to undergo authentication, but other members not required to undergo. Firm or LLP, only authorized or managing partner is required to undergo, and others not required, other partners not required. Company or body corporate or any other entity, only authorized signatory is required to undergo authentication, and other members not required to undergo authentication. In case of government, central government, state government department, local authority, statutory body or PSU, not required to undergo authentication. Even UIN holder is also not required to undergo authentication. So total 9 people not required to undergo authentication, not a citizen of India, members other than Karta of HUF, partners other than managing or authorized partners, members other than authorized signatory. First 4 points. Next 4 points, government and its family, central government and state government, local authority, statutory body and public sector undertaking, and finally UIN holder. So even after getting registration also, they are not required to undergo authentication. Then time limit for uploading the details of physical verification. So there is an amendment related to this. So once the physical verification is completed, what is the time limit within which the report should be submitted in the portal? Suppose if the physical verification is conducted after the grant of registration, they granted the registration and thereafter they are doing the physical verification, then within a period of 15 working days from the date of such verification, they need to upload the report in the portal. Who? The proper officer. Suppose if the proper officer is doing physical verification before the grant of registration, what is the time limit within which physical verification should be done? Within 30 days from the date we submitted the application. So at least 5 days before, 30 days. So at least 5 days, 5 working days prior to the completion of specified period. What is the completion of specified period? 30 days. So they need to upload the report of the physical verification. Then there is something called as deemed registration. That is, you are making application for registration without authentication. Then they need to grant the registration within 30 days from the date of submission of application, otherwise deemed registration. Suppose you make application with authentication, but you have not completed authentication within 15 days, then also an expiry of 15 days within 30 days, if they are not granting registration, then it is deemed registration. Suppose you made application with authentication and authentication completed within 15 days, but they gave a notice and you gave a reply to the notice. Thereafter, within 7 working days, if they are not granting registration, then it is deemed to be granted. Suppose you make application with authentication and completed authentication, and so they are not granting registration within 7 working days from the date of authentication, then also registration deemed to be granted. Suppose you completed the authentication within 15 days, but based on risk parameters, officer wanted to conduct physical verification, then within 30 days, wherever physical verification, 30 days time limit should be taken. In case no physical verification, 7 working days. So 30 days from the date of application, then it will be deemed to be granted. So what are the 3 cases where physical verification is required? If you make application without authentication, or you made application with authentication but not completed within 15 days, or you made application but you completed authentication but officer wanted to take physical verification based on risk parameters. In these 3 cases, there is physical verification required and 30 days is the time limit for that. Then the time limit for making application for registration, if you are CTP, NRTP, at least 5 days before commencement of business you need to make application. In all other cases, within 30 days from the date you are liable to get registered. Then section 27 talks about special provisions for CTP, NRTP. CTP, NRTP should compulsorily get registered, and the registration granted to them is a temporary registration, and the validity will be maximum 90 days. It can be extended for a further period of 90 days on sufficient cause being shown, and therefore you need to remember up to 90 days plus up to 90 days, means it is not always 90 days. Suppose if they are asking 60 days, if 60 days only it will be given. If they are asking 120 days, only 90 days will be given. And for the period for which they are operating as CTP and RTP, they need to deposit advance tax. What is that advance tax? They need to estimate their gross liability and estimate their input tax credit, estimated liability, net tax liability, they need to deposit as advance tax. Suppose if they are asking for any extension, for that extended period also they need to deposit the advance tax. Whatever advance tax that is deposited will be credited in their electronic cash ledger, and it will be adjusted towards their actual liability. If there is any excess balance, that will be refunded to them. If there is any shortfall, that they are required to pay. And the distinguishing points CTP and NRTP is that CTP, a person who occasionally undertakes transaction involving supply of goods or service in the course or furtherance of business, so in a state where he has no fixed place of business. But NRTP also occasionally undertakes transaction involving supply of goods or services in a place where there is no fixed place of business in India. So that is the difference. Means CTP come from other state to this state, NRTP come from outside India to India. And CTP undertakes a transaction in the course or furtherance of business, but NRTP no such requirement. CTP will be getting registration using his permanent account number, but NRTP will not have a permanent account number, so using their passport, so they will be getting the registration. And application form for registration for CTP is REG1 and NRTP is REG9, and CTP will file the regular returns GSTR1, GSTR3B, but NRTP will file GSTR5. Then the amendment in registration, section 28. Section 28 says that whenever there is a change in particulars initially submitted, so we need to go for amendment in registration. But remember, if there is any change that leads to change in permanent account number, so then we need to go for new registration only, and we cannot go for amendment in registration. Apart from change in permanent account number, any other change, we can go for amendment in registration. Here we have 2 things, core field and non-core field. What are considered as core field? Change in name, change in address, and change in top management is core field. Whereas other changes is non-core field. Non-core field, we don't need any approval from the commissioner, automatically it will be updated in the portal. But change in core field, change in name, change in address, and change in top management requires the approval of the proper officer. And usually there will be prospective amendment, but retrospective amendment is possible only with the order of the commissioner. Change in constitution resulting in change in permanent account number requires cancellation of old registration and obtaining new registration. And what is the procedure? So we have REG 14 is the application for amendment in registration, and the time limit is within 15 days of such change. And REG 3, suppose we make application, what is the time limit for making application for amendment in registration? 15 days. And once we make application, officer, if he has any queries, he will give a notice in REG 3, and within 15 working days he will be giving notice. So usually within 15 days we need to submit the application, but they will give within 15 working days. they will be giving within 15 working days. And after they give the notice, we need to give reply. Usually what is the time limit for giving reply? 7 working days in REG 4. Once we give reply in REG 5, so they will be rejecting the application if they are not satisfied within 7 working days. If they are satisfied, they will grant the registration. Then cancellation of registration, section 29. So total 8 situations, there will be cancellation of registration. First 3 cases, either application can be made by the registered person or suo motu proper officer can initiate cancellation. What are the 3 cases? If there is any transfer or discontinuance of business or change in constitution of business or the taxable person no longer liable to be registered, in these 3 cases, either application can be made by the registered person or officer can cancel. What is that? Transfer or discontinuance, no longer liable to be registered, change in constitution. Change in constitution means what? Change in permanent account number. Then other authentication is required for making application for cancellation of registration. Then in the remaining 5 cases, proper officer suo motu will initiate cancellation. When? If there is any contravention of the provisions of act or rules, or you are under composition scheme but you have not filed annual return within 3 months after the due date, or you are under normal scheme, you have not filed return for consecutive 6 months or 3 quarters, or registration obtained by fraud, or you voluntarily obtain registration and not commence business within 6 months. So in these 5 cases, suo motu cancellation by officer. Even TDS TCS deductor also can make application for cancellation. Now what is the meaning of contravention of provisions of the act or rules? So that we have 7 points. So wrong address means you are not doing business from the place where you have obtained registration. Wrong invoice, you have not given the correct invoice, you have mentioned incorrect particulars in the invoice. Or wrong ITC, you avail ITC in contravention of section 16. So wrong address, wrong invoice, wrong ITC. Or you have violated the anti-profiteering provisions. You should have passed on the benefit to the consumer by way of reducing the price because of the reduction in rate of tax, but you did not do that. That is anti-profiteering. Or you have not furnished the bank details within the specified time, 30 days from the date of registration or date of filing first return, GSTR1, whichever is earlier. You have not submitted the bank details. Or you have not paid 1% of your liability through cash ledger, even though your monthly turnover exceeds 50 lakhs. That is rule 86B. These 3 violations. That is 6th point. And 7 is, if your liability in GSTR1 is greater than 3B for 1 or more tax periods, or ITC in 3B greater than 2B for 1 or more tax periods. Means in GSTR1 you showed more liability, but you paid less liability in 3B. Or you have availed more ITC in 3B than the ITC in 2B. These are the 7 cases or 7 contravention of the provisions that leads to cancellation of registration. Then suspension of registration. Whenever proper officer initiate cancellation of registration, they may suspend the registration, or whenever we make application for cancellation, they may suspend the registration. So suspension of registration, suppose if you make application for cancellation from the date you selected in the application or from the date of submission of application, whichever is later, pending the completion of cancellation proceedings, your registration will be suspended. Suppose if proper officer initiates cancellation, they will specify the date. From that date till the conclusion of cancellation proceedings, our registration will be suspended. What is the consequences during the suspension of registration? For our outward supplies, we cannot collect the GST by issuing tax invoice. For our inward supplies, we cannot avail the ITC. So the suspension of registration, so during that period, can we file the returns for the period before the date of suspension? Yes. For example, you got a notice for non-filing of returns. Suspension is initiated. From the date suspension is initiated till the conclusion of cancellation proceedings, you can file the returns of the prior period, but you cannot file returns of the suspension period. So if you file the returns, automatically the suspension will be revoked and you will continue in the registration. Then revocation of cancellation of registration. Say proper officer cancelled our registration. If they have cancelled our registration, we can make application for revocation of cancellation. What is the time limit for making application for revocation of cancellation? Within 90 days, and it can be extended for a further period of 180 days. So it's 90 days plus 180 days by commissioner or joint commissioner or additional commissioner. And before filing the application for revocation of cancellation, all the pending returns needs to be filed. And if the proper officer is satisfied, yes, within 30 days, they will pass the revocation order. If the proper officer is not satisfied, they will give a notice in REG 23 and within 30 days, and thereafter within 7 working days, we need to give reply in REG 24. Thereafter within 30 days, either they will revoke the cancellation order or they will reject the application. And Even other authentication is required for making application for revocation of cancellation of registration. So for making application of cancellation of registration, for making application for revocation of cancellation, other authentication is necessary. So these are the points, important points for registration. Then the next one, payment process. In payment process, we have total 2 sections, section 49 which talks about various ledgers, and section 50 which talks about interest on account of delay in payment of tax or wrong availment and utilization of ITC. Section 49 says that every registered person, GST portal will maintain 3 ledgers. What are those 3 ledgers? Electronic liability ledger, electronic credit ledger, and electronic cash ledger. And whatever balance that is there in the electronic credit ledger can be used only for payment of tax dues, but it cannot be used for payment of interest, penalty, fee and others. So the dues of a registered person will be T, tax dues; I, interest on account of delay in payment of tax; P, penalty for contravention of provisions; fee, late fee for delay in filing returns or any other amount. But the balance in credit ledger only for tax dues. But the balance in cash ledger can be used for payment of tax dues as well as other dues. And how money will come into the credit ledger? Whenever they avail the ITC through GSTR 3B or ITC 1, 2 or 2A, so they will be getting ITC 1 is availment of ITC and closing stock, ITC 2 transfer of business, ITC 2A single registration getting separated into multiple registration or any refund. So whatever money that comes into credit ledger is used for payment of liability. Then how money will come into cash ledger? Whenever we make a deposit through payment challan or TDS, TCS deducted or refunds, and that will be used for payment of liability. Usually electronic liability ledger will be PMT1, credit ledger will be PMT2 and cash ledger will be PMT5. And for deposit we use PMT6 challan. Balance in the credit ledger or cash ledger after payment of the interest, penalty, etc., we may be able to get as a refund. Suppose if there is any discrepancies in the balances in this ledger, we need to communicate the discrepancy to the portal through PMT4. And special points with respect to cash ledger. What are the various modes of deposit into the cash ledger? PMT6, total 6 modes we have. Either we can deposit through internet banking, debit card or credit card, NEFT, RTGS, then over the counter cash deposit. But over the counter cash deposit is up to how much? 10,000 rupees per tax period, then UPI and IMPS. These are the 6 modes of deposit. Then when the payment is debited in our bank account but not reflected in the electronic cash ledger, then we need to make a complaint to the portal, and that complaint will be made in PMT7. So PMT4 is for communication of discrepancy. PMT7 is for payment debited in our bank account but not reflected. Then for transfer of balances between minor heads and major heads. So in the electronic cash ledger, there will be CGST, SGST or UTGST, IGST and cess, 4 major heads. And 5 minor heads will be tax, interest, penalty, fee and others. In order to shift the balance between one head to another head, we use PMT9. And balance available in electronic cash ledger can be transferred between distinct person, not credit ledger balance. Cash ledger balance can be transferred between distinct person. For that also we use PMT9, but we should ensure that transferor is not having any unpaid liability. So then special points on electronic credit ledger. So whatever balance that is there in the credit ledger, we can get it as a refund only in 2 cases. One is zero rated supply, export of goods or service supply to SEZ, or inverted tax structure. What is inverted tax structure? The tax rate on outward supply is less than the tax rate on inward supply. Means my output will be 5%, my input will be 18%. That is inverted tax structure, then also I will get the refund. So only in these 2 cases we will get refund from the electronic credit ledger. Refund to the original sources ledger, that is whenever we have made the payment of liability from both credit ledger and cash ledger. Suppose some excess payment is being made, in the ratio in which we have made the payment from credit ledger and cash ledger, in the same ratio it will be credited or refunded. For example, for the month of July 2023, in GSTR 3B, we have made a liability of 20 lakhs. 20 lakhs is our liability. But this 20 lakhs we paid using electronic credit ledger 15 lakhs and we paid using electronic cash ledger 5 lakhs. So this is how we have made the payment. Now in this 20 lakhs there is some excess paid. Excess GST paid is 1,20,000. Now we will get the refund. How we will get the refund? Out of this 1,20,000 we will be getting the refund. How we will get the refund? So proportionate to credit ledger, proportionate to cash ledger. So refund will go to electronic credit ledger and bank account. Okay, so to what extent it will go to electronic credit ledger? Refund will go to electronic credit ledger. 1,20,000 into 15 divided by 20 will go to electronic credit ledger, because what is the ratio in which the payment is made using credit ledger and cash ledger? 15:5. So 1,20,000 into 15 by 20 will go to the credit ledger. How much is that? 1,20,000 into 15 divided by 20, that will be 90,000 will go to electronic credit ledger, and 1,50,000 into 5 by 20, 1,20,000 into 5 by 20, that is 30,000 will go into the bank account, because that proportion is paid using the cash ledger. This is known as refund to the source ledger, that is this. So where the registered person has claimed refund of any amount paid as tax, wrongly paid, any amount wrongly paid or paid in excess, then if found admissible for refund, proportionate amount debited from credit ledger shall be recredited to credit ledger. For that they will pass an order in PMT 3. Then PMT 3A is there, that is by mistake we have claimed excess refund. So that excess refund from the credit ledger, when the registered person claimed the erroneous refund of ITC, upon payment of such refund along with interest and penalty, the proper officer will pass an order in PMT 3A for recredit into electronic credit ledger. Then whatever balance that is there in electronic credit ledger can be used only for payment of tax, but cannot be used for payment of interest, penalty, others. Also we know that. And balance in credit ledger can be used only for payment of GST under FCM. So RCM liability cannot be paid using credit ledger. And balance available in credit ledger may be restricted for utilization by the proper officer. Accordingly, we have two rules, Rule 86A and Rule 86B. Rule 86A says that in 5 situations, whatever credit that is there in our credit ledger will be suspended for a maximum period of 1 year. What are those 5 cases? We have availed ITC against an invoice and issued by a supplier. Supplier is not in existence or not doing business from the place where they have obtained registration. Second, recipient is not in existence or not doing business from the place where they have obtained registration. Or we have availed ITC without receipt of goods. Or invoice is missing, or supplier has not paid GST to government. So these are the 5 cases. If these 5 things happen, then officer will disallow the credit in our credit ledger maximum for 1 year, and after 1 year, if it is a genuine credit, it will be given back to us and we can utilize for payment of liability, otherwise it will be permanently suspended. Then Rule 86B talks about usage of 99% of the liability from the credit ledger and 1% of your liability you have to pay through cash ledger. So if your turnover in a month exceeds 50 lakhs, you have to pay 1% of your liability through cash ledger, even though you have sufficient balance in the credit ledger. What is the meaning of turnover? Generally turnover, while calculating monthly turnover 50 lakhs, we should take only taxable turnover. So 0 rated, exempted turnover, taxes and non-taxable should be taken, which means turnover is only taxable turnover. And these provisions are not applicable to government and its family members, that is central government or state government department, PSU, local authority, statutory body. Also, if such person or proprietor or karta or managing director or any of its 2 partners has deposited more than 1 lakh as income tax in the 2 preceding financial years, 86B not applicable, or they have received a refund of unutilized ITC more than 1 lakh in the preceding financial year, 86B not applicable. If they paid greater than 1% of their total liability through cash ledger, means during the current year, already from April to this month, they have paid more than 1% of their liability through cash ledger. So for this month, they don't have to pay anything through cash ledger. So this is about 86B. Then the next section, section 50, interest on account of delay in payment of tax. In 3 situations, this interest will be applicable. There is a delay in filing 3B. When there is a delay in filing 3B, so then interest will be computed, because there is a delay in filing 3B means there is a delay in payment of tax. Interest will be computed at the rate of 18% from the first date after due date till the actual date of payment. And this interest is computed on gross liability or net liability? Only on the net liability. Net liability means what? Gross liability under FCM minus input tax credit plus GST payable under RCM. So on that net liability, interest will be computed. So till which date the interest will be computed? Till the date of payment. What is the date of payment? Either actual date of filing 3B. Then second situation is invoice not reported in GSTR1 and 3B of a month. In a particular month, we have not reported the invoice, but we paid that liability in another month. Now interest will be at the rate of 18% from the first date after due date till the actual date of payment. and this interest is computed on what liability? Net liability or gross liability? On gross liability, that is total amount, even though we paid partly through credit ledger, partly through cash ledger. And what will be the date of payment? Either filing of 3B, or you can also make payment through DRC3. Then third situation is ITC wrongly availed and utilized. In that case, interest will be at the rate of 18% from the date of utilization till the date of reversal, and it will be computed only on the utilized amount of ITC. How to compute the utilized amount of ITC? That month in which the balance in ITC falls below the wrongly availed ITC. So the extent to which the balance in ITC falls below availed ITC. And date of utilization means what? Actual date of 3B or due date of 3B, whichever is earlier, with respect to the month in which balance in ITC falls below wrongly availed ITC. And there is one clarification, that is, suppose if there is a balance in ITC, should we see headwise or should we see all the heads together? We should see all the heads together. For example, we have wrongly availed IGST. Don't see only IGST head, see all the heads, CGST, SGST, IGST. Together, if you are maintaining that much of balance, that is okay. So in case where IGST credit has been wrongly availed and subsequently reversed on a certain date, there will not be any interest if during the period starting from the date of availment up to such reversal, the balance in ITC under the heads taken together has never fallen below the wrongly availed ITC of IGST. But what if there is GST compensation cess? Don't take GST compensation cess head. GST compensation cess head should be taken separately, because GST compensation cess credit can be utilized only for payment of GST compensation cess. So credit of compensation cess available in cash ledger cannot be taken into account while considering the balance of electronic credit ledger for the purpose of calculation of interest. So here this ECL means electronic credit ledger, okay, it's not electronic cash ledger, because ITC information will not be in electronic cash ledger, it will be electronic credit ledger. Then the next area is returns under GST. So there are various returns. GSTR1 is a return to be filed by every registered person containing the details of outward supplies by a person other than those opting for QRMP. It will be 11th of the month following every month. Whereas for those who are under QRMP, what is the full form of QRMP? Quarterly return, monthly payment. They need to file returns on a quarterly basis by 13th of the month following every quarter. Whereas IFF, invoice furnishing facility. So in case of QRMP scheme, so for first 2 months in the quarter, they need to file invoice furnishing facility. So this will be 13th of the month following every month in the first 2 months of the quarter. GSTR 3B is a summary return that contains the details of outward supplies and input tax credit. If QRMP is opted, what is the time limit? 20th of the month following every month. If QRMP is not opted, 22nd of the month following every month for notified states, and for other states it will be 24th of the month following every month. So actually it is 22nd of the month following every quarter and 24th of the month following every quarter. And when it will be 22nd for notified states. So you remember GMCA and below. What is GMCA and below? Gujarat, Madhya Pradesh, Chhattisgarh and Andhra Pradesh, and states below that. So it will be 22nd of the month following every quarter. For other states it is 24th of the month following every quarter. Then CMP 8 is a return that is to be filed by a person opting for composition scheme by 18th of the month following every quarter. GSTR 4 is an annual return to be filed by a person opting for composition scheme by 30th April of succeeding financial year. GSTR 5 is NRTP, non-resident taxable person, 13th of the month following every month, or they will not get a permanent registration now. So 7 days from expiry of registration, whichever is earlier. GSTR 5A is a return to be filed by OIDR supplier located outside India. So it is like a GSTR 3B return 20th of the month following every month. GSTR 6 is by input service distributor by 13th of the month following every month. GSTR 7 talks about TDS, GSTR 8 TCS. These two returns to be filed by 10th of the month following every month. GSTR 9 and 9B is an annual return to be filed by a normal person. 9 is a normal person, 9B is e-commerce operator by 31st December of the next financial year. But remember, only if aggregate turnover during a financial year, previous year, exceeds 2 crores, then only annual return is applicable. Otherwise, annual return is not applicable. There is something called as GSTR 9C, reconciliation statement. that is also by 31st December, but it is applicable only for a person whose turnover exceeds 5 crores in the financial year. GSTR 10 is a final return. That final return needs to be filed within 3 months from the date of cancellation, or B, order of cancellation. A is 3 months from the date of cancellation, B is order of cancellation, whichever is later, not whichever is earlier, whichever is later. GSTR 11 is a return filed by UIN holder for making application of refund. UIN holder is, so that is UN embassy or consulate, etc. Their outward supply is exempted. On their inward supply, so they cannot take ITC, but they can get the refund. For claiming refund, they will be given a status called as UIN holder. They need to file GSTR 11 at the time of making refund claim. Then some special points on return. There is a sequential filing of returns, which means that without filing GSTR 1 of the month, you cannot file the 3B of that month. Without filing 3B of the previous month, you cannot file the GSTR 1 of the subsequent month. You understood? So like that we have a sequential filing of returns. Then government, on the recommendations of GST Council, allow a person to file one GSTR 1 even if GSTR 1 not filed for prior periods. In the following cases, even though supplier declared the details of outward supplies in GSTR 1, but ITC will be restricted in 2B. So what are the cases where ITC is restricted in 2B as per section 38? Suppose if the supplier is a newly registered business, or supplier has filed GSTR 1 but not filed 3B, or supplier liability in GSTR 1 is greater than his 3B, or supplier has availed ITC in his 3B more than his 2B, or supplier has received demand notices for non-payment of taxes, or supplier default in payment of 1% of their liability through cash ledger. So in these cases, even though they are filing GSTR 1 reporting invoices, but in our 2B, it will come as ITC not available, we cannot take that ITC. Then communication of discrepancies and recovery mechanism 88C and 88D. So what is that 88C? When 88C will be applicable? First we will see 88C. So whenever our liability in GSTR 1 is greater than liability in GSTR 3B, which means we have reported more liability in GSTR 1 but paid a lesser amount in 3B. So then in that case 88C will be applicable. So we will get a notice in DRC 1B, either uploaded in the portal or it will be made available to us in email, and we need to respond to that within 7 days. In GST DRC 1B, what are the options? Either pay the difference or explain the difference, or partly pay and partly explain the difference. Suppose if you are not responding, what they will do? They will initiate recovery under section 79 and they will recover the money from us. And what is the impact of filing of returns? We cannot, till the time we make payment of this difference, we cannot file GSTR 1. As we cannot file GSTR 1, we cannot file 3B. As we cannot file 1 and 3B for 2 consecutive tax periods, we cannot generate e-way bill, and even on, this is one of the reasons for suspension of registration. Then 88D is there, which says that whenever we are availing ITC in our 3B more than our 2B, ITC claimed in 3B is greater than 2B, then we will get a notice in 1C, and that will be uploaded in portal. We need to respond within 7 days. DRC 1C, and either pay the difference or explain the difference, or partial payment and explain the difference, same, and they will give a notice again for recovery. Here also same, other things are same. That is, we are not allowed to file GSTR 1 till the time we pay the difference. Even 3B not possible, e-way bill will be blocked, and this will lead to suspension of registration. So 88C and 88D, more or less it is the same with respect to slight changes. Then next, who are not required to file GSTR 1 or GSTR 3B? Remember tonic. So in the tonic T square, T for TDS deductor, TCS deductor. Then because they will be filing GSTR 7 and GSTR 8, then O for OIDR supplier because they will be filing GSTR 5A, then NRTP because they will file GSTR 5, I for input service distributor because they will file GSTR 6, and C for composition scheme taxpayer because they will be filing CMP 8. Then who are not required to file annual return? CAG tonic, that is persons whose books of accounts are subject to audit by CAG, Comptroller Auditor General. T, TDS deductor. So but TCS deductor will be required to file annual return. GSTR 9B, e-commerce operator. O for OIDR supplier, same. N for non-resident taxable person, same. I for input service distributor, same. But C is not composition scheme, because composition scheme is required to file annual return in GSTR 4 by 30th April of succeeding financial year. So here C is the casual taxable person. Then we can file returns through SMS, GSTR 1, GSTR 3B and CMP 8. These 3 returns we can file through SMS if all the entries in the return are nil. And first return is immediately after registration, we need to file the first return, and that first return should contain the details from the date we are liable to get registered till the end of the month for which we are filing the return. Then notice for return defaulter, section 46, whenever you are required to file returns but you have not filed the returns, we will get a notice in GSTR 3A. Once we get the notice in GSTR 3A, within 15 days of such notice, we need to file the returns. Then QRMP scheme. So QRMP scheme is applicable to whom? A person whose aggregate turnover during the previous year does not exceed 5 crores. What they will do, they will file returns on a quarterly basis. GSTR 1 on a quarterly basis by when? 13th of the month following every quarter. GSTR 3B by 22nd or 24th of the month following every quarter. And they will pay tax on a monthly basis. So that they have two methods. Either they can pay under self-assessment method or they can pay under fixed sum method. So self-assessment method or fixed sum method, they have to pay tax by 25th of the month following every quarter for the first and second month. What about third month? Anyhow, for all these 3 months, they will file a 3B by 22nd or 24th of the month following every quarter. And B2B invoices, that is whenever they are filing return GSTR 1 on a quarterly basis, the recipient will be able to take ITC on a quarterly basis due to that reason. So they can file a IFF, invoice furnishing facility, reporting the details of B2B supplies. So that is optional. And whenever they file it on a monthly basis for first and second month. Why about third month? Anyhow, for all these 3 months they will file a GSTR 1. So first and second month they need to file IFF, and that will be reflected in 2B of the recipient. So recipient can take the ITC. And QRMP scheme is GST invoice. GST invoice means what? Suppose if I have 4 registrations, with respect to each registration I can decide whether to go for QRMP or to go for the normal. Not like composition scheme. Composition scheme is like all in, all out. All the registrations will be in composition scheme or all registrations will be out of composition scheme. Then time frame to opt in. So within 1 month after commencement of the quarter and 2 months before commencement of the quarter, they need to decide. For example, April is the commencement of the quarter, April 1st. So 2 months before means, 1st February, and 1 month after means 30th April. They need to decide for going for QRMP for the first quarter, like that. So 1 month after commencement of quarter and 2 months before commencement of quarter. What is the condition to opt in? The last return must be furnished, means whatever monthly returns that should be furnished, then only you can go for quarterly return. GSTR 1 are availing IFF facility. Either you can file GSTR 1 on a quarterly basis or monthly. For first month and second month you can file IFF by 13th of the month following every month. Whatever details that you have entered in IFF need not be re-entered in GSTR 1, otherwise all 3 months data you need to enter in GSTR 1. But when you are filing IFF, ensure that you are not uploading the details of invoices more than 50 lakhs in each month. Then you have 2 methods, fixed sum method and self-assessment method. In self-assessment method, you will compute how much is your actual liability, that is gross liability minus ITC, that is your self-assessment. Whereas in fixed sum method, you will take the previous quarter 3B and 35% of that liability you will pay as the liability for first month and second month. Whereas if the previous 3B is monthly, 100% of that monthly liability you will pay for the first month and second month. Any change in the manner of filing 3B? No, normally we will file 3B. Compulsory opt-out. Whenever your aggregate turnover in the financial year exceeds 5 crores, you will compulsorily coming out of QRMP. And levy of late fees, there is a late fee that will be payable. So for delay in GSTR 1, GSTR 3B, but for IFF there is no late fee. Also for delay in payment also there is no late fee. And there is something called as interest on account of short payment or non-payment under QRMP. Suppose if you are under fixed sum method, you have to pay first month and second month liability by 25th of next month. If you miss that, you need to pay interest at the rate of 18% from 26th of next month till the date of payment. Suppose if your actual liability is more than fixed sum month liability, are you required to pay any interest on the difference? No. Under fixed sum method, you are not required to pay any interest if that interest is paid by due date of 3B. That is, if the difference is paid by due date of 3B, you don't have to pay the interest. Suppose if 3B liability, that is for the quarter, you have to file the 3B by 22nd or 24th. If there is any delay, then interest will be applicable at 18% per annum from 23rd or 25th. Suppose if due date is 22nd, from 23rd. If the due date is 24th, from 25th. Till the actual date of filing 3B, you need to pay the interest. Whereas in self-assessment method also, first interest and last interest is same, but extra we have the second interest. What is that? So if there is any difference in your actual liability minus self-assessment liability, on the difference you need to pay interest at the rate of 18% per annum from 26th of the next month till the date of payment. This is the extra interest that we have on the difference amount. Then last, late fee for delay in filing return, section 47. For GSTR1 and GSTR3B, what is the late fee? If it is nil return, 10 rupees per day subject to maximum 250 under each act. This is under CGST Act. The same late fee is payable under SGST Act, but we don't have to pay late fee under IGST Act. Suppose if your aggregate turnover, so it is other than nil return. If it is other than nil return, we have to pay a late fee of 25 rupees per day, and maximum will be different. If aggregate turnover during previous year does not exceed 1.5 crores, 1000. If aggregate turnover during previous year exceeds 1.5 crores but does not exceed 5 crores, 2500. If aggregate turnover during previous year exceed 5 crores, then the maximum will be 5000. Then GSTR 5, 5A and GSTR 6, nil return other than nil return same, 10 rupees per day, 25 rupees per day, but the maximum we don't have any slabs, always 5000. For 1 and 3B, what is the slab? Aggregate turnover during previous year exceeds 5 crores, 5000. Aggregate turnover during previous year exceeds 1.5 but does not exceed 5, 2500. If it does not exceed 1.5 crores, 1000. Then GSTR 7 and GSTR 8. 7 is a TDS return, 8 is a TCS return. For 7, it will be 25 rupees per day subject to maximum 1000. So TDS return is required to be filed by government, but TCS return is required to be filed by private. For private person, 100 rupees per day subject to maximum 5000. So there is a difference in the late fee. For TDS, 25 rupees per day subject to maximum 1000. TCS 100 rupees per day subject to maximum 5000. GSTR 4 is a return to be filed, annual return to be filed by a person opting for composition scheme. Who can opt for composition scheme? If their aggregate turnover does not exceed 1.5 crores during previous year. If their aggregate turnover does not exceed 1.5 crores, what is the maximum late fee? 1000. So nil return 10 rupees per day subject to maximum 250. Other than nil return 25 rupees per day subject to maximum 1000. Then annual return, what is the late fee? If their aggregate turnover during previous year does not exceed 5 crores, 25 per day subject to maximum 0.02%, 0.02%. If their aggregate turnover exceed 5 but does not exceed 20, double 50 rupees per day, but the maximum is same, 0.02%. Suppose if the aggregate turnover during previous year exceeds 20 crores, again, so double 100 rupees per day subject to maximum 0.25, not 0.02, 0.25% of the turnover. So this you need to remember. And an equal amount of late fee is also payable under SGST Act, but we don't have late fee under IGST Act. Then rectification of GSTR1 and GSTR3B, we can rectify the details submitted already in GSTR1 and 3B by 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. But remember, the rectification is not possible if it is identified by the department. Voluntarily by the taxpayer only they can do rectification. If it is identified by department, they cannot do rectification. Even we don't have the concept of revision of returns like income tax. Then how to report the details of outward supplies in GSTR1? If it is B2B supplies, always we need to report invoice wise. If it is B2C supplies, we need to check whether it is interstate supplies or intrastate supplies. If it is intrastate supplies, always consolidated. So B2B always invoice wise, B2C intrastate always consolidated, B2C interstate. Now we need to see what is the value of invoice. If the invoice value is more than 250,000 per invoice, we have to report invoice wise. If the invoice value does not exceed 250,000 per invoice, then we need to do state wise consolidation. So this is about returns under GST. Then look into the next area, e-way bill. So e-way bill is to be generated before movement of the goods. So before causing movement of the goods, e-way bill is a document to be generated by the person who is causing movement of the goods, and e-way bill is not applicable in case of exempted goods, only in case of taxable goods. And what should be the value for which e-way bill is applicable? If the value of goods including GST, not excluding GST, including GST does not exceed 50,000, we don't have to generate e-way bill. However, in case of job work and handicrafts, even if the value does not exceed 50,000, e-way bill is required. But for others only we need to check that 50,000 limit. And e-way bill will have two parts. Part A contains the GST and details of supplier and recipient, document number and reason for transportation. So all the invoice details will be there in part A, and part B contains the vehicle details, that is transport details. And what is the validity of e-way bill? Once e-way bill is generated, the validity will be 1 day for every 20 kilometers or part thereof if it is over dimensional cargo or multi-mode transportation where one leg of the journey is by waterways. Over dimensional means the length of the vehicle is big, or multi-mode means one up to some distance by roadways, thereafter railways, thereafter waterways, then in that case it will be 1 day for every 20 kilometers or part thereof. In all other cases, the validity of the e-way bill will be 1 day for every 200 kilometers or part thereof. For example, 480 kilometers is the distance. What is the validity if it is other than over dimensional cargo? So 1 day for every 200 kilometers. So 480, first 200 kilometers 1 day, next 200 kilometers second day, remaining 80 kilometers third day. So 3 days will be taken as the validity, and the validity should always be counted from the midnight of the day in which e-way bill is generated to the midnight of the next day as 1 day. For example, if today morning e-way bill is generated, today midnight to tomorrow midnight will be 1 day, tomorrow midnight to day after tomorrow midnight will be second day, like that it will be counted. So always e-way bill expires by midnight. So it should be renewed within 8 hours from its expiry. Validity counted from the midnight of the day in which e-way bill is generated. The validity of e-way bill may be extended within 8 hours from the time of its expiry. Then we have some FAQs on e-way bill. When e-way bill is not required, so if you are transporting the goods by non-motorized vehicle, bullock cart, horse cart, etc., that do not require e-way bill. Goods transported from the customs port, airport or land customs station, so that will be within the control of customs, so even that do not require e-way bill. And transit cargo transported to Nepal and Bhutan, goods are unloaded in India but it is going to Nepal and Bhutan, that do not require e-way bill. Movement of goods for Ministry of Defence, then empty cargo containers are being transported, then consignor transporting goods to or from between place of business and a weighbridge for a weighment at a distance of 20 kilometers. So from the factory to the weighbridge within 20 kilometers, if they are transporting the goods, that do not require e-way bill. Then goods being transported by rail belonging to government, and some states may specify some goods as exempted from e-way bill, and some goods are specified by central government also, that is LPG for household and non-domestic exempted category, that is gas cylinders, that red color gas cylinders. Then kerosene oil sold in ration shops, postal baggage, natural or cultured pearls. Then jewelry also do not require e-way bill, but if it is a imitation jewelry, that requires e-way bill. And used personal and household effects, so like used household goods, we are relocating house from one location to another location, that do not require e-way bill. Whether e-way bill is required if movement of goods is not for supply, whether the movement is for supply or not for supply, e-way bill is required. Whether the 50,000 limit is for taxable goods or exempted goods, that is for both, like taxable goods. If you have both taxable and exempted, take out the exempted goods, see the value of taxable goods. If it exceeds 50,000, then only e-way bill is required. While computing the invoice value, whether GST to be included or excluded, GST to be included. And who will generate e-way bill? If the supplier is registered, supplier will generate e-way bill. If the supplier is unregistered and the recipient is registered, recipient will generate e-way bill. What if both supplier and recipient are unregistered? The transporter will generate e-way bill, or alternatively either supplier or recipient by enrolling as citizen of India can generate e-way bill. Then suppose if the person supplier has not generated e-way bill because the value of the consignment is less than 50,000, you are the transporter, you are transporting goods like this belonging to 10 different people. So each and every person not generate e-way bill because the value is less than 50, but cumulatively if you put all those goods in your truck, the value of the goods exceeds 50,000, whether you need to generate e-way bill? Yes. For each consignment you need to generate separate e-way bill, plus consolidating all these things, one consolidated e-way bill also should be generated by the transporter. Then next, blocking of e-way bill. If you are not filing, suppose for example, if I am not filing returns for 2 consecutive tax periods, if I am not filing GSTR1, 3B or CMP8 for 2 consecutive tax periods, then my e-way bill will be blocked for my outward supplies. But for my inward supply, e-way bill can be generated. For my outward supply, it will be blocked. Neither me nor my recipient nor any other person can generate the e-way bill. So e-way bill generation facility is blocked only with respect to outward movement of goods by a registered person who has not filed returns as above. However, e-way bill can be generated in respect of inward supplies of that person. Then other points, in case of bill to ship to transactions, in bill to ship to transaction there will be 2 supplies, one between original supplier and the billing address, another between billing address and the shipping address. In that case only one e-way bill is sufficient, we don't need 2 e-way bills. Multi-vehicle updation is possible in e-way bill. Up to some distance in one vehicle, thereafter in another vehicle, we can update the vehicle details in part B, not necessary that we need to generate a new e-way bill. Part B should be updated within 15 days from updation of part A, and e-way bill should be accepted by the recipient within 72 hours of its generation or delivery of goods, whichever is earlier. And who can update part B? Either supplier, recipient or transporter. And if there is, and also remember, once e-way bill is generated, it can be cancelled within 24 hours of its generation. If there is any movement of goods, if it is taxable goods and covered under supply, invoice plus e-way bill is required. If it is without supply, delivery challan plus e-way bill. Suppose if it is exempted goods, so e-way bill not required. But if it is under supply, bill of supply is to be taken, without supply, delivery challan, only that document is required. So these provisions are the important provisions. One more point, e-way bill generated can be cancelled. E-way bill generated can be cancelled within 24 hours of its generation. Within 24 hours of its generation, once the e-way bill is generated, it can be cancelled. Rule 42. What does Rule 42 talks about? I have some inward supplies which are commonly used for taxable and exempted. What is the manner of availment and reversal of ITC? For the purpose of this Rule 42, you need to follow a particular procedure. So in this procedure, we need to know the meaning of certain terms. First, we need to know T. What does T refers to? T refers to total ITC, that is total GST paid on inward supplies. So you can just put the numbers over there so that you will understand what it is about. The total GST paid on inward supplies is 4 lakhs. The total GST paid on inward supplies is 4 lakhs. And this 4 lakhs we should segregate into 4, that is inward supplies used for non-business purpose. Inward supply is for non-business purpose. Can we take ITC? No. While discussing section 41 read with rule 37A, what is that we have seen? Self-assessed ITC, I told you. In that self-assessed ITC, what is the discussion I have been making? So, matched ITC, and 3 things, even though comes in 2B, we should not take. What are those 3 things? So, inward supplies which are used for non-business purpose, exempted supplies and blocked ITC, we should not take, correct? Even though it is coming in 2B. Say for example, non-business purpose is 50,000 and inward supply used for exempted supplies is 75,000 and inward supplies which are blocked credit is 25,000. Now this 50 plus 75 plus 25, can we take ITC or we cannot take ITC? We should not take ITC. Now based on this, you tell me what is ITC availed in GSTR 3B. What is ITC availed in GSTR 3B? 4 lakhs minus 50,000 minus 75,000 minus 25,000. So therefore this will be 1,50,000 you take out. So 1,50,000 if you are taking out. So what is the remaining amount that is left? 2,50,000. This 2,50,000 is what? ITC availed. 2,50,000 is called as ITC availed. Okay, understood up to this? What is the first step or first process? First T. T minus T1, T2, T3. What is T1, T2, T3? Non-business, exempted, blocked ITC. Remaining ITC we will take in 3B, 2,50,000. Now this 2,50,000 can we enjoy fully? No. Why we should not enjoy fully? Because this 2,50,000 we don't know fully used for taxable or what. So we cannot enjoy it. Okay, but we have availed it. We have availed it. Out of this 2,50,000, how much is used for taxable purpose? 2 lakhs. So can we enjoy this 2 lakhs fully? Yes. Yes. Now what is a common credit? What is a common credit? 50,000. How we got common credit? 2,50,000 minus 2 lakhs, which you could not segregate in these 4 places, is known as common credit. So the common credit is 50,000. This 50,000 we can arrive in 2 ways. Number 1, you take 4 lakhs. From 4 lakhs, you reduce everything. That is 50,000, 75,000, 25,000 and 2 lakhs. So the remaining is 50. Either you do this way or you take. So 2,50,000 is the ITC avail. From that ITC avail, you separate fully used for taxable, that is 2 lakhs. So the remaining is also common credit, 50,000 rupees. Now this common credit you cannot enjoy fully. So proportionate to exempted, you need to reverse. So that's what we did in this question. So what we did is that first we have taken the ITC. After ITC avail, we reduce the proportionate reversal. Proportionate reversal, how we calculated? Common ITC into exempted by total. So common ITC into exempted by total we need to reduce. Say for example, so common ITC is 50,000 into exempted turnover is 10 lakhs and the total turnover is 25 lakhs. This is what we have taken. So 10 divided by 25. How much is the ITC that we will reverse? 50,000 into 10 divided by 25. 50,000 into 10 divided by 25. How much? 20,000 we need to reduce. So means this 20,000 we cannot enjoy as ITC. Then common credit with respect to non-business purpose. So 50,000 into 5%. So that will be how much? 2,500. So 2,500 we need to reduce. Now this is what we need to do. So remember, first we need to take T. T refers to total ITC on inward supplies. It is total GST paid on inward supplies minus T1, T2, T3. T1 non-business, T2 exempted, T3 blocked. These three we should not take. These three we should not take. So how much we should take in the GSTR 3B, ITC availed in GSTR 3B? 2,50,000. So 2,50,000 is the ITC availed in GSTR 3B. Now after availing this, now you need to do the computation of common ITC. How we will get the common ITC? From this ITC avail you take out exclusive list for taxable and business purpose, that is 2 lakhs. If you take out, so remaining 50,000 is the common ITC. This 50,000 proportionate to exempted. So into 10 divided by 25. What is this 10 and 25? 10 is exempted turnover, 25 is total turnover, that you need to check in the question. Okay. Then we will be getting 20,000. Then the common ITC attributable to non-business purpose, because if you are using partly for business and partly for non-business, you can take proportionate ITC. So non-business purpose is 5%. So 2,500. Now how much we need to reduce? From the availed ITC, how much we need to reduce? 22,500 we need to reduce. So 2,50,000 minus 22,500, what is the balance that will be net eligible ITC for set off? 2,22,000, 27,500 will be the net eligible ITC for set off. So this is how we need to arrive at the answer. So you need to remember the format T. That is total GST paid on inward supplies. While reading the question itself, you put T1, T2, T3, T4 properly. In the solved workbook, already I have given few questions related to that along with the QR code. So you try that questions. Okay. So first you need to take T. T is total GST paid on inward supplies minus T1, that is inward supply used for non-business, minus T2, inward supply used for exempted, minus T3, blocked ITC. The balance is known as C1. What is C1? ITC availed in GSTR 3B minus T4, fully used for taxable purpose, that is 2 lakhs in this case. So 2,50,000 minus 2 lakhs, common ITC 50,000. Next we have D1, common ITC attributable to exempted, that is C2, common credit into E by F, exempted divided by total. Then common credit attributable to non-business purpose, C2 into 5%. Okay, but why sir 5% only? Because you don't know how much is exactly used for business and how much is for non-business. If you know exactly how much is business, how much is non-business, that you will divide in the T1, T4 stage itself. For example, 1/3 non-business, 2/3 business, means 1/3 you will put in non-business T1 and 2/3 you will put it in T4. So it will not come in common credit. If it is not coming in common credit itself, you don't do into 5%. Okay, and here 5% of the total common credit. If we have 10 invoices in the common credit, in the 10 invoices, only one invoice is used for partly business, partly non-business, but all these 10 invoices into 5% we need to do. So it is not only that particular purchase or inward supply used for business and non-business, we need to multiply 5%. Total common credit we need to multiply 5%. Why is it so, sir? Because that is a ad hoc assumption that we are taking. If you don't want that 5% to happen, then you ascertain how much is used for business and non-business, that you segregate in the beginning stage itself, that is T1 and T4 stage itself. So this is how you need to arrive at the answer. Then here C3 will be computed separately for CGST, SGST, means this computation whenever in exam you do it separately for CGST, SGST and IGST, and then this computation majorly this is our focus, D1 and D2. So this is the ITC availed, this is the ITC reversed. So this D1 and D2, so we will do on month, every month we will do this computation. Again at the end of the financial year, we need to do this computation once again, and we need to compare it between month on month versus D1 and D2 compute at the end of the year. Say this, D1 and D2 compute for the whole year by taking exempted turnover and aggregate turnover for the whole year. For example, D1 and D2 that we have computed month on month, so that is called as provisional D1 and D2. Say the provisional D1 and D2 which is computed every month, so the total is 15 lakhs. And final D1 and D2, this final D1 and D2 that we are computing at the end of the financial year is say 12 lakhs. Means how much we have reversed? This 15 lakhs is already reversed. This 15 lakhs is already reversed, whereas this 12 lakhs is to be reversed. This 12 lakhs is to be reversed. Now already reversed 15 lakhs, but actually you need to reverse only 12 lakhs. What is the excess reversed? Excess reversed is 3 lakhs, and this 3 lakhs can be availed as ITC. You understood? Availed as ITC. And when we will do this computation, say this computation we will do from April 2023 to March 2024, we do provisional D1, D2. Every month we will do. Whereas this final D1 and D2 is there na? This final D1 and D2 we do it by 31st March 2024. At the end of the year we will do. And the excess reverse we will arrive. And that excess reverse we will avail as ITC by 30th September, not November. Usually the time limit for availment of ITC is 30th November of the next financial year. But in this case it is 30th September of next financial year, that is 2024. By 30th September 2024, we should avail this ITC. Not return of September, any return, but that return should have been filed by 30th September of the next financial year. So because what happens is that in MCQ, we will think time limit for availment of ITC 30th November. They will give 30th September, 30th November, 31st October and some other date. We will think time limit is 30th November only and we will select 30th November. But in this place it is not 30th November, it is 30th September. Okay, say this. D1 and D2 will be computed for the whole year by taking exempted turnover and aggregate turnover for the whole year. If this amount is more than the amount already added, so actually we have seen the next point. If this amount is less than the amount added to output tax liability every month, the additional amount has to be claimed back as credit in the return of any month till September of the succeeding financial year. Then next, suppose if it is like reverse, what if the provisional amount, the provisional D1 and D2, the provisional D1 plus D2 is say 15 lakhs. This 15 lakhs is already reversed, whereas the final D1 and D2, this final D1 and D2 that will be like say 18 lakhs, this is to be reversed. So this computation we are doing from April 2023 to March 2024, and this computation we will do by 31st March 2024. And now what is the shortfall? Shortfall in reversal. Shortfall in reversal is 3 lakhs. Okay, and this 3 lakh shortfall in reversal we need to reverse. Why we need to reverse? Actually we should have reversed 18 lakhs, but how much we already reversed is 15 lakhs, so the 3 lakhs should be reversed. By when? So it should be reversed by September of the succeeding financial year, same date. It should be reversed by 30th September 2024, but here along with interest. When we reversed excess, we will not get interest and all. Don't expect interest from government. So you are getting this ITC itself, that itself is greater. But when there is a shortfall, you need to pay along with interest at the rate of 18% per annum from 1st April 2024, because we should do this computation by when? March. So they are asking us to do the interest computation from 1st April 2024 till the date of reversal. And in many places they use the word reversal or payment interchangeably. Both are same. If you have balance in ITC, you will reverse. If you don't have balance in ITC, you will make the payment. Okay. So that is this. So here what they are telling, you see. So if the amount already added to output tax liability, if this amount is more than the amount already added to output tax liability, so we need to do it till September of succeeding financial year along with interest at 18% from 1st April of succeeding financial year till the date of payment. Again here we need to do reversal by September. What if we are not doing it by September? Then recovery will be made. So in this case, if you are not availing ITC by 30th September, it will be lapsed. Whereas in the second case, second example what we have discussed, if you are not reversing by 30th September, what will happen? They will initiate recovery. When they initiate recovery, even they will levy the penalty also. Okay, that is with respect to this. Then this is about rule 42. Then rule 43. Is it necessary to remember all the sections? Not required, but I don't know what is your objective. Your objective is 40 marks, not required. If your objective is 40 marks, really not required. So just this revision lectures will help you. You don't have to remember any section number or rule number, etc. and all. Just happily go to the exam. You will definitely get 40, 45, etc. and all. So you don't have to remember. But what is your objective? Depending upon that objective, it will be. So no student will read indirect taxes with the objective of 40 to 45. So because there are other subjects as well, so called as DT and IBS, etc. and all, and which are not actually bankable subjects and all. So due to that reason, IDT, if you are targeting 80 plus only, so you will be on a safer side, so that aggregate problem will not happen. For that reason only, even though it is a throat pain for me, I am repeating it 1000 times. So the same point, okay. So like by mistake that number may come in the exam and you will write it, okay. So say this, rule 43. Rule 42 is the manner of availment in case of inputs and input services. So this is a process you need to follow. Just because my name is THARUN'S, I did not keep T and all. Law itself they gave T. I did not keep, okay, because one student messaged me, why sir T? Because your name is THARUN'S. R also you can give na. Arey yaar, this T, T1, T2 I did not give here. It's a coincidence my name matches here, you understood. So but actually this is given in the law itself. So even in exam also you should write this only, T, T1, T2, T3. Then rule 43, manner of availment of ITC with respect to capital goods. What does it say? So I have capital goods which is used for taxable or business purpose. Can I enjoy ITC on this capital goods? Yes, no restriction, we can enjoy it because it is used for taxable and business purpose. Okay, I have some capital goods which are purchased and used for exempted or non-business purpose. Can I take ITC on these capital goods? No, you should not take ITC on these capital goods because your outward supply is exempted or non-business. Okay, I have purchased some capital goods which is partly used for taxable or business and partly for exempted or non-business. Can I take ITC? Yes. Take ITC, but conditions apply. This ITC is not enjoyable fully. So you have to reverse it over a period of next 60 months. For example, you purchase this capital goods, you can write the numbers over there, 10 lakhs excluding GST at 12%. So this is the value of the capital goods that you have purchased, 10 lakhs excluding GST at 12%. So what is the ITC? What is the ITC? 1,20,000 is the ITC. Now this 1,20,000 what you should do? Can you enjoy the ITC? Yes. Avail the ITC. 1,20,000 you avail ITC on the month of purchase itself. This month you purchase, this month itself you take the ITC. But you are using it for both taxable and exempted. So for the next 60 months, you need to do the reversal. So what is the monthly ITC? 1,20,000 divided by 60. So that will be how much? 2,000 rupees is the monthly ITC. Sir, should we take 60 only? That is usual assumption which is given in the law. The law says up to 60 months. which means you can take 48 months also, 36 months also, but go by the question. If the question says 36 months, you take 36 months. If the question says 48 months, you take 48 months. If there is no information in the question, you take 60 months. Okay. So 60 months should be taken standard as per the assumption. But if there is a lesser period given in the question also, you can take that lesser period. Otherwise, you take 60 months. So the monthly ITC will be 2000 rupees. Now, what you should do with this monthly ITC? You should reverse. Proportionate to what? Exempted to total. Exempted to total of that month, every month. Say for example, first month 2000 into exempted turnover say 10 divided by total turnover say 25. So 2000 into 10 by 25, how much? 300? 800. 800 rupees you need to reduce. 800 rupees you need to reduce from where? 1,20,000. 1,20,000 is the availed ITC na? Minus 800 rupees. That much only, sir. No, this for month 1. Like that we need to do for 60 months. Okay. And 800 rupees you need to compute interest. How much you reversed? 800. But this 800 is out of this 1,20,000 already availed. So you need to compute interest at what rate? 18%. From when? From the date of availment. Usually interest we need to compute from the date of utilization till the date of reversal or payment. Everywhere, correct? But in rule 43, we need to do it from the date of availment. Usually on account of interest in ITC, you should compute it from the date of utilization till the date of reversal. In this place alone, we need to do it from the date of availment till the date of reversal, because it is specifically given in rule 43 like this. Due to that reason only we are doing this. So the above amount to be added to output tax liability for every month for the next 60 months along with interest at 18%. So this 800 into 18% into number of months. Number of months we have divided by 60. Number of months divided by 12. For example, if this is pertaining to third month, if it is pertaining to third month, first month you avail the ITC. So first month to second month to third month, that is 2 months we need to compute interest. Okay, means for 60th month, sir, 59 months we need to compute interest into 59 divided by 12, 18% per annum over the period. Date of availment first month, date of reversal is 60th month. So which means for 59 months we need to do the interest computation. Then this procedure is not applicable from when? During the 60 months, any 1 month, the asset is sold. Then the asset itself is not there. Why I should do the reversal? I don't have to do the reversal. Or the asset got converted into capital goods 1. The asset got converted into capital goods 1. Means it is used only for taxable. So again, don't do the reversal. Okay. That is what I have given note. The above procedure is not required from the month in which capital goods are sold. Why? Because GST anyhow you are paying under 18 subsection 6. So what is this 18 subsection 6? Whenever capital goods are purchased on which ITC has been availed and that capital goods are sold or disposed. Now you need to apply 18.6. What does 18.6 says? GST payable will be highest of the following. A. ITC availed minus 5% depreciation for every quarter or part thereof. From when to when? From the date of purchase till the date of sale, or GST on sale value, whichever is higher. Anyhow, I am going to pay the GST on this, which is higher of what? Unutilized ITC. How we got unutilized ITC? ITC availed minus 5% for every quarter. From when to when? Date of purchase till the date of sale. For example, you used for 2 years, boss. You used for 2 years and you are selling it. So let's see what will happen in this case. Say 1st April 2020 you purchase capital goods and you purchase capital goods for 10 lakhs excluding GST at 12%. Okay. Now you are using it. What is the life of the capital goods? Life of the capital goods is what? 60 months or 5 years. So that is what? 31/3/2025. This is the life of the capital goods, correct? Now what happened somewhere after 2 years? So that is 31/3/2022. Okay. So you are selling the capital goods, sale of capital goods, sale of capital goods for 6 lakhs, 6 lakhs excluding GST at 12%. You tell me what would have happened in this case. And this is common capital goods. This is common capital goods, common capital goods. 1/4/2020 itself, ITC availed, correct? How much is the ITC availed on 1/4/2020 itself? 1,20,000. Now, from 1/4/2020 to 31/3/2022, how many months? 24 months, 2 years. What we would have done in these 2 years? So, monthly reversal, correct? Monthly reversal. Now, you are selling the capital goods. When you sell the capital goods, at this stage itself, GST payable under section 18 subsection 6. What is it? GST payable under 18 subsection 6? ITC avail minus 5% for every quarter or part thereof from the date of purchase till the date of disposal. That is 24 months means how many quarters? 8 quarters. 2 years here, 1 full 4 quarters here, 2 fulls means 8 quarters, correct or not? So 1,20,000 minus 8 quarters into 5%. Okay, how much that comes to? 8 5s are 40. 1,20,000 minus 40%. 72,000 or B. So what is the sale value of the capital good? 6 lakhs into 12%. That is 72,000. So exactly it is the same. So I will just change here instead of 6 lakhs. So CG, sale of capital goods for 6,50,000 excluding GST at 12%. So that will come to 78,000. So whichever is higher, not lower, 6 lakhs into 12%, sorry, 6,50,000 into 12%, 78,000, whichever is higher. So which is higher? That is 78,000 is the GST payable. So you are paying, actually 24 months you reverse, and here at this stage you are paying 78,000. You got it? Now for the remaining life, what is the remaining life? 36 months. For this 36 months, whether monthly reversal required or monthly reversal not required? Huh? Not required. Monthly reversal not required. Why monthly reversal not required? Because already you paid the GST here at the time of sale of this capital goods. You got it? So somehow my intuition says that this concept will be tested. So this concept might be tested. So in the forthcoming exam for May 24, because quite a long time they didn't touch on capital goods. On inputs and all they have been testing, but not on capital goods. So merging these two concepts, they can check a question on 18.6 as well as on monthly reversal. Then next, another point we will see. So look into the next below discussion. There are two situations, initial purchase CG1 and at a later point of time CG2, and another case is initial purchase CG3 and at a later point of time CG2. Okay, and here one query, whether we need to take this as calendar quarters or 3 months should be counted as 1 quarter, calendar quarters. Calendar quarters means what? So it's like any one day in that quarter, you should take it as a full quarter. For example, instead of 31/3/2022, if it is 4/4/2022, then automatically it will become 9 quarters. How it will become 9 quarters? In the next quarter, see up to 31/3/2022, 8 quarters here, part thereof. Now in April few days came na, so that should also be counted as 1 quarter. You understood? So therefore be careful while doing the quarter computation. Everywhere, actually only one place there was a difference. Duty drawback alone, we should count 3 months as 1 quarter. Like say for example 15th January means, how we will count quarter is 15th January to 15th April, 1 quarter. Like that we used to count. Where? In duty drawback. But now duty drawback chapter is removed. So everywhere in GST and customs we have calendar concept only, calendar quarter only. So 15th January means it should 15th January to 15th April. How many quarters? 2 quarters. How 2 quarters? Jan, Feb, March 1 quarter, April few days are there, that will be counted as 1 quarter. Got it? So everywhere in GST and customs it will be calendar quarter only. Now, so look into this initial purchase CG1 and later point of time CG2. CG1 means what? It is used fully for taxable, and at a later point of time it is used for common. Now what will happen in this case? So the logic is simple, that is I purchase the capital goods. So on 1/4/2020, and the life of the capital goods is 31/3/2025. So the life is 5 years or 60 months. Now somewhere on 31/3/2022, that is 24 months, 24 months and 36 months. Initially I purchased it and used it for taxable. Okay, initially I purchased it and used it for taxable. So 10 lakhs is the worth of capital goods excluding GST at 12%, and it is used for taxable. Now what happened on 31/3/2022 is that I am not selling. In the previous example I took for sale. Now I am changing the situation. I am not selling, but I started using it for common. Used for taxable and exempted. Used for taxable and exempted. Now what will happen in this case? So 1/4/2020 itself, ITC availed or not availed? ITC availed. Why ITC availed? At that time we have purchased and used it for what purpose? Taxable. So we would have availed ITC at that time itself. How much is the ITC availed at that time? 1,20,000 itself we have taken ITC at that time. And for 24 months we are using it for taxable. Whether any reversal required for this 24 months? No. Reversal not required. Why reversal not required? Because you are using it only for taxable purpose. Now from 31/3/2022 till 31/3/2025, for 36 months, whether reversal required or not? Yes. Why reversal required? Because we are using it for both taxable and exempted. So monthly reversal required. Monthly reversal is required. And when you do the monthly reversal, how much we will take as ITC? So we will avail the ITC now. At the time already availed or not availed? Already availed. So whether we will avail the ITC? No, we will not avail any ITC. So at this stage, ITC not availed. Why ITC not availed? Because already we have taken in the beginning. Now don't take any ITC. Just consider as common ITC. 1,20,000, whatever is there, 1,20,000, consider as common ITC. Don't do anything else. Just consider it as common ITC. For the next 36 months, we will do the monthly reversal. That's it. Got it? So initial purchase we are using it for CG1, taxable. So ITC already availed at the time of purchase, so no need to avail common credit. No need to avail common credit. Just consider it as common credit. And what is the monthly ITC? Same, no change. Original ITC divided by 60, because the life of the capital goods cannot be more than 60 months. Now proportionate reversal from the date of conversion for the balance useful life. So what is the balance useful life here? 36 months. For 36 months we need to do the reversal, monthly reversal required. Then another situation, initial purchase CG3 and at a later point of time CG2. Now same scenario, but there is a change here. What is that change? That is 1/4/2020. I purchased the capital goods, and the life of the capital goods is what? 31/3/2025. And I purchased capital goods for 10 lakhs excluding GST at 12% and used only for exempted. And what will be the life of the capital goods? So 5 years. Now somewhere on 31/3/2022, that is for 24 months. Okay. After 24 months, I started using it for, used for both taxable and exempted. Used for both taxable and exempted. Now, you tell me whether ITC would have been availed at the time of purchase. No. Why not availed? Because it was used only for exempted. That's what we have seen. If capital goods are purchased and used only for exempted, we should not take ITC. So we have not taken ITC. Here ITC not availed. So ITC not availed at the time of purchase. But are we supposed to take the ITC now? Yes. Why we are supposed to take the ITC now? Because we have not taken at the time. Now you are using it for both taxable and exempted. So ITC availed. How much is the ITC that will be availed? 1,20,000. You avail now. But last 24 months you are using it for what? Exempted. Now can you enjoy the ITC for this period? This 1,20,000 you should have taken 1/4/2020, but you are taking it now. But this 1,20,000 contains the component of 24 months, yes or no? So this 24 months you used it for what? Exempted, which means you should not enjoy the ITC. So therefore ITC reversal, this is for the past period. For the past karma, we are reversing it now. You understood? So ITC reversal. How much is the ITC reversal? 1,20,000 into 5% into how many quarters? 8 quarters. So please do the calculation. 1,20,000 into 40%. That is 48,000. Now you are availing the ITC 1,20,000. Sir, should I avail 1,20,000 or I should avail 1,20,000 minus 48, 72,000. How much I should avail? Avail 1,20,000. Thereafter you reverse for the past period. You understood? And then you consider it as common ITC. Consider as common ITC, and for the next 36 months. For the next 36 months, you need to do the monthly reversal. Monthly reversal required. Sir, why should I do, sir? This is for the future karma. You understood? Past sin, wipe off fully. Future sins, as and when you do, you wipe off. You understood? So monthly reversal over the next 36 months. Last 24 months, now itself you reverse. Okay. So 2 reversals will come. But in the previous situation, only 1 reversal. Why? Because for the past 24 months, you did only good deeds. You understood? You don't have to wipe off anything. So full good deeds, taxable only you did. Only future you are going to commit some sins. For that only you need to do the reversal. You understood or not? But here, past also bad, future also bad. So therefore, first clear the past fully. So that's what 24 months you are fully reversing. Then for the remaining 36 months, month on month you do the reversal. You got it? That is about this. So ITC not availed at the time of purchase. So we are availing it now. What is that? Original GST paid. Ineligible ITC to be reversed. For the period it was used for exempted. Past. Used for exempted. How much? GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And monthly ITC, same, proportionate reversal for the balance life. So this is about capital goods, 3 special cases. So these 3 special cases can definitely be tested, possible. So these are the 3 special cases. First special case we saw was that common capital goods, at a later point of time we sold it. Next one, initial purchase for taxable and then used for common. Then initially purchased for exempted and used for common. These 3 can be tested. Next, section 19 talks about job work provisions. So section 19 should be read with section 143 of CGST Act. What does it say? So I am sending the inputs or capital goods for the job work, and at the time when the inputs or capital goods are sent for the job work, I don't have to reverse any ITC on that. Normally I can send. But from the job worker's place, the inputs are capital goods. The processed goods or the capital goods should be brought back. What is the time limit within which it should be brought back? Processed goods should be brought back within 1 year. And capital goods should be brought back within 3 years. This 1 year can be extended for a further period of 1 year. 1 year. And the capital goods can be extended. 3 years can be extended for a further period of 2 years. Remember, 1 plus 1 year, 3 plus 2 years. So processed goods should be brought back within 1 year and capital goods should be brought back within 3 years. And capital goods or inputs. First we will see inputs. Inputs to be received within 1 year, which is sent directly from the principal's place of business, and if it is not received within the time, it will be deemed as supply on the date of receipt by the job worker. For example, I am sending the goods to the job worker. You are the job worker. I should have got the goods back from your place within 1 year. You did not send me. Then on expiry of 1 year, it will be deemed as supply in my hands. So means 1 year back itself it was supply. Now I will come to know that it is supply. Now I have to pay GST. So logically I need to pay even GST. For example, 1/4/2023, I sent you inputs here and you should send me the processed goods by what time? 31st March 2024. You have not sent. As you have not sent, so 1 year time limit is over. Further it can be extended for a further period of 1 year by the commissioner. Commission is not giving extension. Now it will be treated as sale in my hands. On which date? On which date it is treated as sale in my hands? 1/4/2023, 1 year backwards, and I have to pay GST now. Now means which date I am in? 1/4/2024. You got it? And I have to pay GST pertaining to which month? 1 year before. Means I have to pay interest for last 1 year. That is the additional burden that I will be having. You got it? And this GST I will recover from you. Got it? Because of your mistake only now I have paid. So I will recover it from you. Now what happens? You have returned the goods to me after this 1 year. Now in that case, whatever ITC that I have, whatever GST that I have paid, I will reavail as ITC. No. It will be treated as new sale made by the job worker to the principal. You got it? So section 143 basically puts the time limit. What is the time limit? The goods should have been brought back to the principal's place within 1 year plus 1 year in case of processed goods, and capital goods should be 3 years plus 2 years. If 143 breached, then what will happen? Section 19 will come into picture. That is deemed fiction. What is a deemed fiction? It will be deemed as supply. On which date it will be deemed as supply? On the date of dispatch to the job worker. Okay. Now see this. ITC not required to be reversed by principal when goods are sent on job work, and such goods should be sent under the cover of a delivery challan and e-way bill. Yes, because goods sent on job work is not a supply at the time when we are sending it for job work. So as it is not a supply, the document that is required is delivery challan, and e-way bill always required in case of goods sent on job work. Even if goods are directly received by job worker, ITC can be availed by principal. How ITC can be availed by principal? Bill to ship to transactions. When the goods are received by the job worker, the invoice will be raised to the principal. The day on which job worker has received the goods, it is deemed that the principal has received the goods and the principal can take ITC with respect to that. And see these additional points. Job worker can avail ITC with respect to inputs or input services used for job work. So job worker also will do some process na, so he can take ITC on that. If the processed goods or capital goods are returned by the job worker after 1 year or 3 years, then it will be treated as new supply by the job worker and chargeable to GST. And as you pay GST, you can recover that from me and I can take ITC with respect to that. The period of 1 year in case of processed goods and 3 years for capital goods on sufficient cost being shown be extended by the commissioner for a further period not exceeding 1 year or 2 years respectively. And what if job worker is not registered? There is one condition here. If the job worker is not registered, the principal should show job worker's place as the principal's additional place of business. That is one point. If job worker is not registered, principal should declare job worker's place as principal's additional place of business, and jurisdictional commissioner should be intimated about the job work contract, and processed goods may be brought back to principal's place, or it can be sold or exported from the job worker's place directly. And every principal who is sending the goods on job work and receiving it from the job work, they need to file one form. What is that? ITC 4. ITC 4. This ITC 4 will be filed on a yearly basis if the aggregate turnover of the principal during previous year does not exceed 5 crores. 5 crores. It does not exceed 5 crores annually. By when? 25th April. So financial year get over by 31st, na? So 25th of April. Suppose If the aggregate turnover exceeds 5 crores, then it will be 2 times half yearly. Half yearly by 25th of the month following every half year. So first half year is what? April to September by 25th October, and the second half year is what? October to March by 25th of April. So this is about section 19 read with section 143. Okay, and we have this input service distributor. So we'll take a break, and then we will complete this. Okay, we'll start. So there is one query, 10cc bikes ITC available? Yes, actually ITC available for 10cc bikes, because 10cc bikes will not come under motor vehicles, and as it is not motor vehicles, we don't have any blocked credit. So which means it will be like used in the course or furtherance of business, and ITC is available. So that is about that. Then next, input service distributor, section 20 and section 21 of CGST Act. Basically input service distributor is like a head office. That head office will receive the services and distribute the credit with respect to these services to the branches which are having the same permanent account number as that of the head office. So basically head office will receive the tax invoices with respect to input service. Remember, only input service. Inputs and capital goods credit cannot be distributed this way, only input services. And this ISD, input service distributor, distribute the credit to its branches having the same permanent account number, and this ISD is required to get a separate registration, even though that company is already having, that is each and every branch is having a separate registration. Even then for ISD they need to get a separate registration and distribute the ITC. And here there is one important condition. ISD is say in Tamil Nadu. ISD is in Tamil Nadu and the branch is also in Tamil Nadu. Then CGST credit will be distributed as CGST, SGST as SGST, IGST as IGST. Whereas with respect to registrations in other states, say branch 1, this is branch 1 and this is branch 2 and this is branch 3. Now with respect to branch 2 and 3, so 3 is in Andhra Pradesh. With respect to branch 1, CGST will be distributed as CGST, SGST as SGST, IGST as IGST. With respect to branch 2, CGST, SGST as well as IGST, everything will be distributed as IGST only. Okay, so the ISD which is in Tamil Nadu, with respect to branch 2 and branch 3, with respect to these two branches, CGST or SGST or IGST distributed as what? IGST, distributed as IGST. Whereas to branch 1, CGST or SGST or IGST distributed as CGST, SGST or IGST accordingly. So that is what I have given below. CGST and SGST distribute as CGST, SGST for the unit in the same state of ISD. So ISD is in Tamil Nadu, whereas branch 1 is also in Tamil Nadu. So credit will be distributed in the same manner, same name, and distributed as IGST if the unit is in the different state than that of ISD. So suppose if the unit is in different state than that of ISD, then everything will be distributed as IGST only. Then suppose if the service is attributable only to one branch, entire credit will be distributed to that branch only. If the service is attributable to more than one branch, it will be distributed to those 2 branches or 3 branches in the ratio of its turnover. So input service attributable to one unit, entirely distributed to that unit. Input service attributable to 2 or more units, such 2 or more units we will distribute the ITC in what ratio? Turnover ratio. Suppose if the input service is attributable to all units, ITC will be distributed to all units which are operational based on the turnover ratio. Now turnover, whether we need to take current year or previous year turnover, we need to take previous year turnover or the last quarter based on the availability. Then how this should be distributed? The ITC should be distributed on a monthly basis, not on a quarterly basis. And for distribution of this ITC, one return needs to be filed, that is GSTR 6 by 13th of the month following every month. And excess distributed ITC can be recovered by issuing a ISD credit note. For example, this ISD has distributed to branch 1 some excess ITC, and to branch 2 and branch 3 there is a shortfall. Now what they can do, excess they distributed now, to reduce that excess distribution, so this ISD can give a credit note to branch 1. That's what they are telling. Excess distributed ITC can be recovered by issuing ISD credit note. Now for branch 2 and branch 3 there is a shortfall. For distributing that shortfall, they can give a ISD invoice. And distributed credit should not exceed the credit available for distribution. Suppose if the ITC available with ISD is 5 lakhs, then while distributing it to these 3, the total should not be more than 5 lakhs, means excess credit should not be distributed. If the ISD has distributed excess credit to any one recipient, the excess can be recovered from the recipient with interest. For example, they should distribute 3 lakhs, 3 lakhs and 3 lakhs to these 3 units. But instead what they did, they distributed 4 lakhs, 2.5 and 2.5 to 2 branches. Instead of 3, they distributed 4, 2.5 and 2.5. Now to which unit they have distributed excess? Branch 1 they distribute excess na. From branch 1 the recovery of 1 lakh will be made. So if the ISD has distributed excess credit to any recipient, the excess can be recovered from the recipient with interest. And every ISD should get a compulsory registration irrespective of their aggregate turnover. Then, so we will come across turnover in 3 places. One is Rule 42, common ITC used for both taxable and exempted proportionate ITC available. Then Rule 43, Rule 43 also same, total ITC divided by 60 into exempted turnover by total turnover. Again input service distributor also we come across turnover ratio. Wherever we take the turnover ratio, in the turnover we need to exclude old indirect taxes. What are they? Excise duty, central sales tax and value added tax should be excluded. Also value of supply of duty credit scrips should be excluded, okay, which means duty credit scrips, even though it is exempted, but it will be excluded from the exempted turnover na. It should be treated as taxable turnover, but this point already I gave there. So you remember only one point. What is that one point you should remember? Old indirect taxes should be excluded. Generally these old indirect taxes will form part of turnover value under 15(2)(a), which says all taxes, duties and cess by whatever name called other than GST should be included in the turnover. Because of that reason, so this should be added generally as per 15(2)(a), but this is an exception. While determining turnover in 3 places, what are the 3 places? Rule 42, Rule 43 and Rule 40 like section 20. In these 3 places, so turnover excludes old indirect taxes. Then next one, we have a circular on replacement of parts during warranty. So these are some additional circulars which are basically amendments for May 24 exam. So please concentrate, carefully listen. So this circular is basically about purchased goods which are used in replacement during warranty period. So here warranty can be given by the supplier. So whenever there is a like standard warranty or additional warranty, so during that warranty period if there is any manufacturing defects or etc., so freely the part will be replaced by the supplier. So this is that background. So here issue number 1, Sleek is a modular kitchen supplier. So they have done the interior decoration to Mr. X, who is a customer, for which the customer pays a consideration of 8 lakhs plus GST 18%. This is a normal contract, interior decoration contract. Under this contract, if there is any part which is used in the modular kitchen is damaged, so that will be replaced by this company for a period, usually 6 months or 1 year or 2 years. That will be a warranty period. In that warranty period, they will replace the parts. And now what happened is that Mr. X asked Sleek to replace a part during warranty period, and Sleek will purchase that part for replacement. So parts purchased by Sleek for replacement to customer during warranty period, and the value of that part is 50,000 and GST is 6,000. Now they have replaced that part during warranty period and they did not charge any amount for that. Who did not charge any amount for that? The Sleek supplier did not charge any amount for that. Now the question here is, on the 6,000 can ITC be taken or cannot be taken? First, anywhere we have blocked credits related to this, goods used in warranty period, so ITC is blocked, like that anywhere we learn? No. And is it used in the course or furtherance of business? Yes. So as a business practice, they have to give this assurance to the recipient, then only the recipient will undertake, like receive the services from the supplier. So therefore, as a part of this business only, they do the replacement during warranty period. Means logically they can take ITC, we don't have any restriction. You got it? So reversal of ITC by manufacturer shall not arise, even if such replacement of part is without any consideration. So yes, they can enjoy this ITC of 6,000 rupees. Now, sometimes they charge a nominal amount rather than giving it for free absolutely. So they will charge a nominal amount like 10% or 20% depreciation value, like that they will charge. See, you used for 3 months. Now I am replacing a part new. Then for the 3 months you used na. So for that reason, I will charge some money from you, 10% or 25%, like that I will charge. Now in that case also, is there any restriction with respect to ITC? No, whether you charge or you do not charge, that is irrelevant. And you are using the goods for replacement during warranty period, so happily you can take the ITC. If any consideration is charged with respect to such replacement, then it is supply under 71A. Which is supply under 71A? That money collected, the 10% or 25%, and GST payable on such consideration, but reversal of ITC shall not arise. So what is one point that you need to remember based on this example? If I am purchasing any goods and used it as replacement during warranty period, for that replacement, whether I charge any consideration or not charge any consideration, I can take ITC on the goods purchased. Clear? Then second issue. Issue number 2, you see. So there is a car manufacturer. Toyota is a car manufacturer. Lance and Toyota is a dealer, and they are making sale of car including warranty for 3 years to Mr. X, a buyer. So car manufacturer will sell the car to the dealer and dealer will sell the car including warranty to the buyer. Now in this background, what happened is that, so dealer has paid 12 lakhs plus GST to the manufacturer and they collected 15 lakhs plus GST from the buyer. Why they are getting 3 lakhs? That is their profit margin. Dealer's margin 3 lakhs. Now dealer will provide the service, free after sale service. In this free after sale service, dealer will do service plus even change the parts during the warranty. Got it? Now this services plus part, whether the dealer is really doing it for free or he will get the money, he will definitely get money. From whom he will get the money? Not from the buyer, he will get money from the manufacturer. Dealer will get the money from the manufacturer. So Lance and dealer provided free after sale service of 3,000 and replacement of parts 2,000. This is the background. Okay. Now in this case, we need to understand certain things. First, dealer is procuring the parts for replacement from the third party. Means this replacement of part 2,000 is there na. The dealer did not get from the manufacturer, but he purchased it from the market and he used it for free replacement during warranty period and charged consideration from the manufacturer. Now you please step into the dealer's shoes. As a dealer, what is that you are doing? First you are buying the part from the market for replacement. Can you take ITC on the part purchased? Yes or no? From dealer point of view, you please interpret. Yes or no? Yes. That already we discussed in the previous point. What is that? If any goods are purchased for replacement during warranty period, whether we charge or we do not charge, we can take ITC on the part purchase. Correct? So on this part of 2000 rupees, whatever GST is paid, as a dealer you can take ITC on that. Done. Second point. Now you are incurring 5000 rupees. What you will do? 5000 rupees you will incur out of your pocket, or you will charge it to manufacturer? You will charge it to manufacturer. On that, will you pay GST also? Yes. And in turn you will recover it from the manufacturer. You got it? So see the dealer's perspective. First, invoice for recovery of cost from manufacturer, 3000 after sale service, replacement of part 2000, total 5000, GST 18%, so 5900. Now dealer will pay this 900 rupees to government. Then on parts purchase, 2000 into 18%, 360, ITC is available to the dealer. And whether any reversal of ITC? No. Even though you are doing it for free or you are charging, you can enjoy the ITC of this 360. No reversal of ITC required by the dealer in case of replacement of parts. This is from the dealer's perspective. Now, from the manufacturer point of view, we will see. So, as a manufacturer, now step into the shoes of a manufacturer. Now, what you are doing? You are paying 5900 rupees to the dealer, correct? Now, can that 900 rupees be taken as ITC by you? Yes, because dealer will raise invoice to you and you can take ITC with respect to that 900. That is simple. Manufacturer shall pay 5900 to the dealer and ITC of 900 can be claimed by the manufacturer. So, you tell me, this is example. From this example, you should remember the provision. I have not given the provision directly, because if you read the provision directly, nothing you will understand. That's why through numbers I am making you understand. So now tell me, what is the treatment when the part is procured from the third party? As a dealer, dealer will recover the charges from the manufacturer and GST will be payable on those charges recovered, and on the parts procured ITC can be availed. And as a manufacturer, manufacturer will pay the charges to the dealer, and on the charges GST ITC can be availed by manufacturer. Then second situation, same scenario, question is same. Scenario 2, situation 2. What happens in situation 2? If replacement of parts are received by dealer from the manufacturer, so means what happens here? That part dealer is not procuring. Dealer is not procuring that part. That part dealer got it for free from the manufacturer. Okay. And the dealer has used it in the buyer, which means as a dealer, how much you will recover from the manufacturer? 3000 or 5000? 3000. Why you will recover only 3000? Because part you got it for free from the car manufacturer. So to the car manufacturer, you raise a bill for 3000 plus applicable GST and you will pay the GST. As you did not procure the part, so the question of ITC does not arise. So see that as a dealer, you will raise invoice to the manufacturer, 3000 rupees after sale service, GST 540 and invoice value 3540, and you will pay 540 rupees to government. Now you tell me, as a manufacturer, what you will do. So as you procured the part freely, you have given to the dealer, but you would have procured the part as a manufacturer. On that part procured, so you can take ITC, yes, because you are using that part for what purpose? Free replacement during warranty period. As a manufacturer, you can enjoy the ITC on that part procured, and even dealer will raise invoice to you for that 3000 rupees plus GST. That 540 rupees can be taken as ITC. So see that manufacturer shall pay 3540 to the dealer, and ITC of 540 can be claimed by the manufacturer with respect to after sale service. Then 2000 into 18%, sorry, you just change this to 360. 2000 into 18%, that is 360 rupees. What is this 360 rupees? GST paid on the part purchase. GST paid on the part purchase, so can be taken as ITC. And any reversal of ITC required by the manufacturer? No, not required. Now you tell me, what is the treatment of this as a provision? What is this situation? So parts are procured by the manufacturer and given it for free to the dealer. In that case, can the ITC be enjoyed by the manufacturer? Yes. And whenever a dealer raises the invoice for free after sale service, on that GST paid can be taken as ITC by the manufacturer. Dealer will simply pay GST on whatever money that he has recovered from the manufacturer, and dealer will not purchase the part. So the question of ITC does not arise. Now, third situation. Listen, what happens in this third situation is that 100 numbers of spare part is supplied by the manufacturer to the dealer at 2000 rupees, excluding GST at 18%. So these parts are for sale. Basically, these parts are for sale. Manufacturer will send it to the dealer for sale parts. But the dealer, out of these 100, one part he has taken and used it for replacement during warranty period, which means dealer is required to pay to manufacturer for 100 parts or 99 parts, only 99 parts. Why 99 parts? Again I am replying, again I am discussing this, concentrate. I am a manufacturer, you are my dealer. I am sending you 100 parts. I will raise invoice for 100 parts to you. But you will pay me for 100 parts or 99 parts, only 99 parts. Why not 100 parts? Because one part you are using it for replacement during warranty period, and for which you are not required to pay me money, correct or not? Which means first I will raise as a manufacturer to you invoice for 100 parts. Thereafter I will give you credit note for one part because you are not required to pay money for that. You got it? Now, as a dealer, first you procured 100 parts and you availed the ITC, and as you got the credit note, you need to reverse the ITC. Got it? This is related to that parts. Over, job done. Now, how much you will charge to the manufacturer for after sale service? 3000. So, into 540 rupees, that I will take as ITC. Okay. So, say this. First, from the dealer point of view, situation 3, 100 numbers of spare parts supplied by manufacturer to dealer at 2000 excluding GST. Out of that, one spare part is used as replacement during warranty period. So, the dealer will pay 2,36,000 to manufacturer first. Why? Because manufacturer will raise invoice for 100 into 2000, 2 lakhs, and GST 18%, 2,36,000. And in the 2,36,000, ITC dealer will take 36,000. Now, one credit note will be given to the dealer. So, ITC must be reversed by dealer based on credit note. So, if 100 parts GST is 36,000, for one part it is how much? 360, that 360 needs to be reversed. Then, as a dealer, you will raise invoice to the manufacturer for 3,540 and you will pay GST of 540. This is the job in the hands of dealer. Now, in the hands of manufacturer, what will happen? Manufacturer will first raise invoice for 100 parts now. 2 lakhs plus 36,000, and one credit note will be given for reducing that, and dealer will raise invoice for 3,540 to manufacturer, and 540 can be taken as ITC by the dealer. Okay. Actually, this is given in pure English. In the circular, they have given a circular related to this, and in that circular, they have given fully about this, in English, which we cannot read and comprehend. Even in exam also, they will not test whatever you learnt in circular, you write like that, they will not ask a question. So, they will convert it into numbers like this. So, that is why this will be useful. So, just literally like this only they can ask questions on this. Then next, another issue. Issue number 3. This is related to, usually warranty, we pay additional amount for warranty. If you pay that additional amount for the warranty at the time of purchase of the product itself, what is the GST rate applicable for this additional warranty? At the time of purchase of the product itself, you pay for warranty. Whatever is the GST rate applicable to the product, that should be taken for additional warranty also. Suppose if you buy the additional warranty separately, not at the time of purchase of the product, then for the warranty, the general rate 18% will be applicable. For example, iPhone 15 Pro Max 1,59,900, say rate of GST 28%, and coverage is there. Usually extra money you have to pay for the coverage, Apple Plus coverage, 15,000 inclusive of GST. Now this 15,000 is taxable at what rate of GST? Now, if the coverage is taken at the time of purchase of iPhone, this 15,000 will be taxable at 28%. If the coverage is taken at a later point of time, then this 15,000 will be taxable at what rate? 18%, because it will be treated as a separate contract. Then another circular is related to cross charge. So it's not gross charge, it is cross charge. In this alphabet it's cross charge, it's not gross charge, cross charge. So what is this cross charge means? Cross charge means one office will raise invoice to the another office. It can be head office or branch office. So ISD opposite is cross charge. So either we can distribute the credit based on ISD concept, or we can also follow the cross charge. It's like head office. Head office is there, and below the head office we have branch office 1, branch office 2 and branch office 3, and there is a supplier, and this supplier will raise invoice to the head office, and the head office will avail ITC, and this ITC will be distributed to all the 3 branches. So this is the concept of input service distributor. Okay. Now here, what is the disadvantage in this ASD? They should distribute it in turnover ratio, correct? Distribute in turnover ratio. Now I don't want to follow this. Instead, I want to make it simple. That is, the supplier will raise invoice to branch office 1, and the branch office 1 will raise invoice to branch office 2, branch office 2 will raise invoice to branch office 3, or branch office 1 will raise invoice to branch office 3. So I just wanted to structure it that way. So branch office 1, branch office 2, branch office 3. Now I want to eliminate this concept of ISD. So the supplier will raise invoice to branch office 1. Now branch office 1 will take ITC availed, full ITC. Now branch office 1 will raise invoice to branch office 2 and branch office 3. Invoice they will raise. You got it? And this concept is known as cross charge. This is known as cross charge, whereas this is known as input service distributor. Okay. So, but both cases the objective is achieved. All the 3 branches are taking the ITC. Now based on this invoices, so here branch office 2 will take ITC availed, and even branch office 3 will avail the ITC. You understood? Whereas in ISD also the objective is same, all the 3 branches, so distribution of ITC, so 3 branches will also take the ITC. Now should I follow ISD or cross charge? Circular says anything you follow. Either you follow ISD or you follow cross charge, but ensure that in cross charge this service is not attributable to only one division. The service is really attributable to other divisions also, then you do this. But what is the advantage we can achieve in this cross charge? Turnover ratio we don't have to follow. Got it? Turnover ratio need not be followed. Okay. Now this particular circular will be applicable only for May 24 exams. Reason being, they gave a Finance Bill 2024. As per the Finance Bill 2024, they are telling that this cross charge should not be followed, ISD only should be followed. Previously, ISD only should be followed. Circular gave either cross charge or ISD you follow. Again, Finance Act 2024, they are telling follow ISD only. Okay. So then Parchimutu Gordon Lirkla. So therefore, why they change that, I don't know, but this circular is applicable only for your exam. Okay. What is that? Either ISD or cross charge can be followed by head office for distribution of credit to branch office. In case of cross charge, normal invoice is raised by head office to branch office. Turnover ratio need not be followed, but those services should be attributable to branch office. Okay. And even in case of cross charge, separate registration not required. That head office, one separate registration we used to get, that is also not required. That all those things are only for ISD, not for cross charge. Then, now one more point they have given in the circular related to internally generated services. See, with respect to services procured from the third party, either they can follow ISD or they can follow cross charge, no doubt. But with respect to internally generated services, what is this internally generated services means? Branch office HR function is taken over by the head office. Means head office or corporate office is only looking after the HR of all the branches, because HR they will make centralized. They will not do separately. HR, finance, marketing and sales, these things and all, they will make it like a common. They will not give it separately for each and every branch. If that is the case, then good, one chartered accountant can be appointed for one branch. So, but usually finance and all, they will concentrate only in the centralized location. Now, in that case, what happens is that head office will incur the expenses even for the branch office also, and will raise a debit note for recovery of the expenses, common expenses. This only we call as apportionment of overheads. Common overheads we will apportion between the divisions. So, head office will incur the common services, they will incur the expenditure. And how they will recover the expenditure? By raising the debit notes to the branches, they will recover the expenses. Now, what is the treatment of that recovery of expenses? This is not procured from the third party. This is internally generated. What is the treatment of that? Services provided by head office to branch office, not procured from the third party, internally generated. Now, this will come under transaction between distinct persons. In case of transaction between distinct person, head office is one distinct person, branch office is one distinct person, and the value needs to be determined under Rule 28. We have Rule 28 of valuation rules, which says that you take either open market value or like kind and quality or cost plus 10%. If the recipient is eligible for full ITC, the open market value is nothing but the transaction value. Okay. Now see that. Is branch office eligible for full ITC or branch office not eligible for full ITC? If branch office is eligible for full ITC, whether amount recovered or not from the branch office by head office, value under Rule 28 is nothing but invoice value. Why? Open market value deemed to be transaction value. You can write that. Open market value deemed to be transaction value. Because of that reason, even value can be taken as nil also, no issue. Suppose if branch office is not eligible for full ITC, then we need to determine the open market value. Amount recovered from branch office by head office, open market value should be taken. What if open market value not available? Like kind and quality or cost plus 10%, that will come. What if amount not recovered from branch office? Even then open market value should be taken. But this is exception to Rule 28. What does they are telling? No value of taxable supply. So this is exception to Rule 28. Actually Rule 28 says whether consideration is there or not. Sir, if the amount is recovered, it will become supply under section 71A. If the amount is not recovered, it will become supply under section 71C. Whether it is supply under 71A or 71C, transaction between distinct person, the value will be as per Rule 28. As per Rule 28, if the value is open market value, only should be taken. But in this case, when the amount is not recovered from the branch office by head office, the CBIC circular says that you don't have to take any value. Okay, so value will be taken as 0 and no need to pay GST. This is an exception which they have created in the circular. Okay, so these are the amendments that we have in input tax credit. With that, we have completed ITC, and now we are looking into summary on CGST rules related to valuation. So you can see this, when these rules are applicable mainly when, so price is not the sole consideration or supplier and recipient are related. So first Rule 27 we have. What does Rule 27 says? when price is not the sole consideration, means consideration is partly in money and partly in other form, or consideration is in non-monetary form, then in that case rule 27 will be applicable. Then when 28 is applicable, in case of transaction between related parties including distinct persons, rule 28 is applicable, and rule 29 is applicable in case of principal agent transactions. So this information is in page number 73. So first, so three rules are there, rule 27, 28 and 29. 27 is when price is not sole consideration. 28 related party transactions including transaction between distinct persons. 29 principal agent transaction. First we are seeing rule 27. It says that, so when price is not sole consideration, you please take the open market value. So if open market value not ascertainable, the first priority is open market value. If that is not available, then only we need to take money received plus money value of non-monetary consideration. So suppose if this is also not available, why this is not available? Money value of non-monetary consideration is not available, then we need to take like, kind and quality. Like, kind and quality also not available, then rule 30, which says that we need to take cost plus 10%. So when we are taking cost plus 10%, so below in note 2 I have given, so what should be taken as a cost? The cost will be in case of manufacturer, cost of production. In case of a trader, it is cost of acquisition. In case of service provider, it is the cost of providing the service. Suppose if I am a manufacturer and I am giving it to a person where I am getting partly in money and partly in non-monetary form. Now open market value not available. So and price, money received plus money value of non-monetary consideration. I got some non-monetary consideration from the recipient. So that also not available here. So like, kind and quality also not available. Then what I will do, I will take cost of production, add 10% or into 110%. Anyway, you can remember, and that will be taken as a value for payment of GST. And here, what is the difference between open market value and like, kind and quality? So first we need to check open market value. If not available only, so then the second, money received plus money value of non-monetary consideration, if that is also not available, then like, kind and quality. What is the difference? So OMV and LKQ. Comparable time, if you see, for OMV it is the same date. Open market value, it is the same date, which means that today, what is the price at which the transaction has happened? So I am making sale today. So for that, what is the open market value I need to take? Open market value also today only, same date. Whereas like, kind and quality need not be the same date, it can be any nearest date also can be taken. That is this. And comparable value, open market value should be like transaction value. Transaction value means, so that is only the price involved in the transaction. It should not be value under any rules. Whereas in case of like, kind and quality, either it can be transaction value or value as per rules also. And who is the supplier? Comparable supplier. In case of open market value, same supplier or any other supplier. Whereas in case of like, kind and quality, it should be same supplier. And comparable goods. In case of open market value, it should be same goods. So different goods and all will not be taken. Whereas in case of like, kind and quality, so minor differences are acceptable. So that's what usually I tell in the class. So you take a washing machine. For a washing machine, so if you take front load washing machine, the open market value should be another front load washing machine only. And in case of like, kind and quality, also it should be front load washing machine only, but minor differences. Minor differences means what? So change in the color or change in the capacity, little bit there could be a change, but more or less it should be same. So minor differences are acceptable. That is what like, kind and quality is. And in case when money received plus money value of non-monetary consideration is available, we will go by that. But remember, when we have open market value as well as this, we cannot decide here. It's not up to the option of the supplier. So first open market value available means we need to go by open market value only. So what are the four priorities? OMV, money received plus money value of non-monetary consideration, like, kind and quality, cost plus 10%. What if cost is also not ascertainable? Then fifth point is there, that is residual value, where the value will be determined by the officer. So if the above value is not possible, then the value will be determined as per rule 31. Rule 31 is residual value. So we will follow the principles of valuation and we can determine the value, or alternatively, we can go for provisional assessment. We can request the officer to determine the value. So that is this residual value, rule 31. Now, In the second case, what is the second case? Related party transaction including transaction between distinct persons. So we will be taking only 4 points. So in the second case, second point is missing. So what is the second point here? Money received plus money value of non-monetary consideration is not there in the case of Rule 28. So remember, for second situation, second point is missing. Okay. So first open market value. If that is not ascertainable, like, kind and quality. Immediately we will jump to like, kind and quality. If like, kind and quality also not available, cost plus 10%. If that is also not available, residual value. Related to this open market value, there is one point. What is that? If recipient is eligible for full ITC, whatever is the transaction value in the invoice, that itself will be deemed to be the open market value. For example, I am making sale to a related person. I am raising an invoice for some 100 rupees. That 100 rupees itself will be taken as the value, provided my recipient is eligible for full ITC. When my recipient is eligible for full ITC, if his outward supplies is fully taxable, if his outward supply is partly taxable, partly exempted, he cannot take full ITC. If his outward supply, my recipient's outward supply is fully exempted also, he cannot take ITC. So therefore, recipient is eligible for full ITC means what? His outward supply. Whose outward supply? Recipient outward supply fully taxable. Then only he is eligible for full ITC. Then only whatever price that I declare in the invoice, that itself will be taken as the open market value. What if recipient is not eligible for full ITC? Then we need to determine the open market value. Sir, in question, if it is silent, they have not given anything about recipient eligible for full ITC or not eligible for full ITC. You take that recipient is not eligible for full ITC. If recipient is eligible for full ITC, specifically it will be given in the question. If the question is silent, which means that recipient is not eligible for full ITC, and we need to determine the open market value. That is this point. Now, alternatively means instead of following this OMV, like, kind and quality, cost plus 10%, alternatively we have another option also for the supplier, and the supplier can choose between either OMV, LKQ, cost plus 10% or this option. What is this option? 90% of the resale price option. Means I am selling to you, you are my related person, I am selling to you. You in turn sell it to an unrelated person. So that sale to an unrelated person into 90% will be taken as my value. For example, I am selling to you for 10,000 rupees and that will not be taken. Why that will not be taken? Because that may not be the true value, because you are a related person and you are not eligible for full ITC. So this 10,000 irrelevant. Now you are subsequently selling to an unrelated buyer. What is the price at which you are subsequently selling? Say 20,000 rupees. That 20,000, assumption here is 10% is the profit margin that you will make. So 20,000 into 90%. What is 20,000 into 90%? 18,000 will be taken as my value. So that should be taken here. So this is alternative only, which means either I can go for OMV, LKQ or cost plus 10%, or I can follow 90%. For example, open market value is only 15,000 and 90% of resale price is 18,000. So now what I can choose? I can choose 15,000, whichever is lower option only that I will be choosing. But remember, this 90% of the resale price option is available only in case of goods, not in case of services. Rule 27 is common for both goods and services. Rule 28 also common for both goods and services. But this 90% of the resale price option is only applicable in case of goods. And one more condition for this 90% of resale price is that recipient should not process that. For example, I am selling to you, you are my related person or you are my distinct person. You should be selling it as such. You should not do any processing. If you do any processing, this 90% resale price option will not be applicable. So recipient should not process those goods but should have been sold it as such. Then there is one more proviso that has been added. This is an amendment, so which is applicable for May 24 exam onwards. What is that it is about? In case of corporate guarantee, which is given by one company to the another company for the purpose of borrowal. So here usually what happens whenever we make some borrowals, unsecured loans and all, so banks expect someone to give guarantee. Secured loan means there is a proper security available, but when it is unsecured loan, there is no security, so the bank will expect us to get some guarantee. This guarantee can be given by any person who is having some good financial standing, and this guarantee can be given by individuals also, or this guarantee can be given by corporates also. Okay, now there is a company which is borrowing some money. So now when it is borrowing some money, another company, usually who will give guarantee? Holding company will give guarantee to the subsidiary company. Suppose if the subsidiary company is so sound then the subsidiary company sometimes will give guarantee to the holding company, but that is minor case only. But usually holding companies will give the guarantee when the loans are being taken by the subsidiary company. Now, holding company and subsidiary company are treated as related parties. Usually in case of this guarantee, there is a concept called as guarantee commission. So if I am guaranteeing a loan taken by you, so I expect a commission from you because I am giving you the guarantee for the loan that you are taking. So therefore a commission will be expected. So here holding company, when it gives the guarantee to the subsidiary company, so the subsidiary company will pay guarantee commission to the holding company. So now in that case, it's a related party transaction. Sometimes the guarantee commission may not be paid also. Consideration may be there or consideration may not be there. But here the logic is, it is coming under 7(1)(c). Why it will come under 7(1)(c)? Holding company and subsidiary company are treated as related parties. Any transaction between related parties is treated as supply under section 7(1)(c). So in this case, what should be taken as the value? The value should be taken as the open market value logically, correct or not? So because it's a related party transaction, rule 28 should be applied. But in case of corporate guarantee between related persons, they have added one provision. What does it say? Supplier of services providing corporate guarantee to any banking company or financial institution on behalf of the recipient, that is related party, value of supply will be 1% of the guaranteed amount or the actual consideration, whichever is higher. According to me, it is one stupid provision, because holding company is giving guarantee to the subsidiary company for 100 crores. Now in the case of this 100 crores guarantee, the commission, guarantee commission, which is paid by the subsidiary company to the holding company, could be somewhere like 10 lakhs. 10 lakhs could be the actual guarantee commission. Now when 10 lakhs is the actual guarantee commission, but GST will be payable not on 10 lakhs. Okay, see this, there is a holding company and this holding company is giving a guarantee to the subsidiary company for the loans being taken. Okay, guarantee with respect to loans, for which subsidiary company will definitely pay a guarantee commission. So what is that guarantee commission? Let's take the guarantee commission as 10 lakhs. Guarantee commission, that guarantee commission, let it be 10 lakhs. 10 lakhs is taken as guarantee commission. And what is the loan amount? The loan amount is 100 crores. The loan amount is 100 crores. Now, is it supply or not a supply? Definitely it is supply under section 7(1)(c). Why it is supply? Actually 7(1)(a) itself will come, because there is a consideration. As there is a consideration, it will come under 7(1)(a). It's a supply. But we need to determine the value as per rule 28, because they both are related parties now. So due to that reason, value under rule 28. Here this holding company and subsidiary company are treated as related parties. So value under rule 28 is simple. 1% of guaranteed amount. What is the guaranteed amount? 100 crores. 1% of 100 crores or actual consideration. Actual consideration is 10 lakhs. Whichever is higher or whichever is lower? Whichever is higher. Means even though the actual consideration is only 10 lakhs, so therefore the value will be taken as 1 crore, correct? 100 crores into 1%, so that will be taken as 1 crore will be taken as the value, and on which GST is payable. Now, what if there is no guarantee commission? What if there is no guarantee commission? There is no guarantee commission. Even in that case, the answer will be same. So in case when the guarantee commission is not there also, still the value will be taken as value under rule 28 will be 1% of 100 crores or actual consideration. There is no actual consideration. So whichever is higher is what? Definitely 1 crore in 1 crore. 1 crore will be taken as the value of supply, which means just because a guarantee is being given, unnecessarily the holding company is required to pay GST on this 1 crore. And whatever GST that they pay, and definitely they can recover it from the subsidiary company, and the subsidiary company can take ITC with respect to this. But the twist here is, what if the subsidiary company is engaged in exempted supplies? The entire GST is lost for them now. So that is the stupidity in this provision, but we need to do. But remember, this provision is applicable only in case of corporate guarantee, not in case of personal guarantee. Personal guarantee means what? So wherein a director will be giving guarantee with respect to loans taken by the company. Okay, so director giving guarantee is called as personal guarantee. So that personal guarantee point we are not discussing right now. We are discussing only about the corporate guarantee. Okay, now so there are multiple combinations in corporate guarantee that could be possible. So let's try to understand the corporate guarantee situations. So what are the various situations that will be possible in case of corporate guarantee? Corporate guarantee, so given by unrelated company to company, between unrelated companies or between related companies, possible. So even unrelated company also can give corporate guarantee. Yes, given by one related company to another related company, one related company to another related company. So when the corporate guarantee is given by one related company to another related company, so is it supply or not a supply? Yes, it will be supply. It will be supply under section. Now we need to see whether it is for consideration or without consideration. So for a consideration, so then it will become supply under section 7(1)(a). And suppose if it is corporate guarantee given by one related company to another related company, without consideration, another related company without any consideration, So in this case it will become supply under section 7(1)(c), supply under section 7(1)(c). In both these cases, what should be taken as the value? In both these cases, the value will be common. So value under rule 28. Value under rule 28 is what? 1% of guaranteed amount or actual consideration, whichever is higher. Actual consideration involved, whichever is higher. Suppose if it is by related company to another related company without any consideration, value under rule 28, what will be taken as value under rule 28? Only 1 point, 1% of guaranteed amount, 1% of guaranteed amount. Suppose if an unrelated company is giving the guarantee, then what will happen? Can unrelated company give guarantee? Yes, they are basically associate companies. So not holding subsidiary company. Holding and subsidiary only will be treated as related under GST, but associated companies are not treated as related. So for example, one company has invested 26% in the other company. As per income tax, they are treated as associated companies, but under GST, they are not treated as related persons. So due to that reason, but sir, there is one point related to 25% in related parties. What is that 25%? There are two companies having a common shareholder, and that common shareholder has invested 25% or more. Then these two companies will be treated as related. But here I am not talking about that. I am talking about one company investing 25% in the other company. So they are associated, or 26% in the other company, they are associated. But they are unrelated for the purpose of GST. Now what will happen in that case? So third point, corporate guarantee given by unrelated company for a consideration. Is it supply or not a supply? Definitely it will become supply under section 7(1)(a), because there is a consideration that is involved. Then what will be taken as the value? So definitely rule 28 will not be applicable. Why rule 28 will not be applicable? Because they are not related. As they are not related, we need to take the value under section 15. What is the value under section 15? That is transaction value, which is nothing but the actual consideration that will be taken in this case. And then another point, so number 4, what if it is given by unrelated company without consideration? without consideration. Is it supply or not a supply? It is not a supply. Why it is not a supply? Because it is unrelated and there is no consideration. So in order to become supply under 7(1)(c), 4 points will come. DRIP, DRIP. D for disposal of business asset on which ITC is availed. That is not applicable here. Related party transaction including transaction between distinct persons. That is also not applicable here. And then we have import of service from a related person, not applicable. Principal agent transaction, that is also not applicable. Consequently, it is not a supply. When it is not a supply, we don't have to determine the value for payment of GST. So this is in case of corporate guarantee. Now, one more point is also possible, that is guarantee given by government. So what if the guarantee is given by government to a company, whether it may be with consideration or without consideration, then what is the impact of that? So this point also we will write, that is guarantee given by government, guarantee given by government to whom they will be giving public sector undertakings. They will not be giving it to normal companies, they will be giving it to PSUs. What about this? Is it supply or not a supply? And it may be for a consideration. Definitely it is for a consideration called as guarantee commission. For a consideration. Is it supply or not a supply? Definitely it will become supply under section 7(1)(a). But should we determine the value here? No. Why? Because it is called as exempted supply. Why it is exempted supply? We have seen some activities of government to business entities. In that list of 14 activities, there are 14 specific exemptions with respect to services provided by government to business entities. In that 14 exemptions, one of the exemption is guarantee commission earned by the government. So government will give the guarantee with respect to loans taken by PSUs, for which the PSUs will pay a guarantee commission. That guarantee commission which is received by the government will be exempted. So we don't have to bother about any valuation here, because the activity itself is an exempted supply. Then what if it is a personal guarantee? What if it is a personal guarantee? So who will be giving the personal guarantee and what is the treatment related to that? So personal guarantee can be given by director or a ex-director. So director giving guarantee to the company, so that we are taking, so continuing to this. So the sixth situation is director giving guarantee to company. Director giving guarantee to company. Is it for consideration or without consideration? Definitely it should be without consideration. Why it should be without consideration? Because there is a RBI circular which says that whenever a director gives the guarantee to the company with respect to loans taken by the company, so the company should not pay any consideration as per RBI circular. So due to that reason, director giving guarantee to company, so will be without consideration. Without consideration. Why it should be without consideration? So as per RBI circular, consideration should not be paid. Consideration should not be paid. So due to that reason, consideration will not be there. Will this become supply or not a supply? It will become supply under section 7(1)(c). Why, sir, it will become supply under 7(1)(c)? Because this circular says that director and company are deemed to be related. They are treated as related. Under which point they are treated as related? Such persons or officers or directors of one another's business. Under that point, so director of a company and the company will be treated as related. So director and company are treated as related. And moreover, it is without consideration, so it will become supply under 7(1)(c). And we need to determine, as they are related, we need to determine the value under rule 28. What will be taken as value under rule 28? Whether this 1% of the guaranteed amount or actual consideration, whichever is higher, is applicable in this case. Not applicable, because that proviso is applicable only in case of corporate guarantee. But what we are discussing is not a corporate guarantee, it is a personal guarantee which is given. So, but value will be determined as per rule 28. What will be the value as per rule 28? Open market value. What is that open market value? Nil, as per CBIC circular. Why as per CBSE circular the value will be taken as nil? Because RBI circular says that there should not be any consideration involved. Means consideration should not be paid by the company to the director. Means open market value, generally there won't be any consideration. So how to determine the value? It cannot be determined. Due to that reason, here the open market value should be taken as nil. This is as per RBI circular. So, and CBSE circular, these two are connected. That's what I have already given here in the note. In case of personal guarantee by director to company without consideration, value shall be considered as nil as per CBSE circular. Why? Why like that they have given? Because as per RBI circular, consideration should not be paid in case of personal guarantee by director to company. So there should not be any consideration for that reason. Sir, but can this circular be overridden? Yes. So we can override this circular. Companies can override this circular, but they will not do this. So because we are not talking about the provisions when the companies breach, so they will, if RBI circular is given, they will follow that. But what if they are not following RBI circular and all? It's not useful for exam, because those kind of questions in exam they will not be asking. Okay. So this point only will be tested in exam. Don't worry about that. Then next, what if ex-director giving guarantee to company? Here whether RBI circular will be applicable? So no, because RBI circular is applicable only in case of director giving guarantee to the company, not ex-director giving guarantee to the company. Means when ex-director is giving guarantee to the company, will there be consideration involved or not? May or may not be. So therefore, seventh case, ex-director giving guarantee to company for a consideration. Is it supply or not a supply? Definitely it will become supply under section 7(1)(a). But rule 28 will not be applicable. Why rule 28 will not be applicable? Because they are not related parties. Ex-director and company are not read as related. So therefore we need to determine the value under section 15. What will be taken as value under section 15? That is transaction value. That will be actual consideration. Whatever is involved will be taken. Okay. Now, last case, what if there is a ex-director and that ex-director giving guarantee to company, without consideration? Possible? Yes, without consideration. Then what will be the activity? Is it supply or not a supply? As it is without consideration, we need to refer to 7(1)(c). And as per 7(1)(c), they are not related parties, and even principal agent also will not be applicable. Consequently, it is not a supply. When it is not a supply, we don't have to bother about the valuation. So therefore, these are the 8 different combinations which are possible on this amendment. Now, any question can be tested in exam. So you should be clear with respect to the treatment. So it is again a very, very important area. If you are not getting question on this, return the paper and come. That much important it is. Trust me, it will come. Many times my intuition didn't go wrong. So even every attempt I was telling this. So this attempt, definitely this area will be tested. So these 8 combinations, any combination can be tested. At least worst come scenario as a MCQ they will be testing it. Okay. So that is about this area, and this is an amendment we have seen. So we have seen so far rule 27 and rule 28. Then next, principal agent transactions. And here in this regard, one more point also. So that, sir, what if director is giving guarantee to company? So will it come under RCM? I am telling the value itself is nil. There is no GST at all. When there is no GST at all, why RCM, FCM will be applicable? So when RCM will be applicable, first there should be a value and there should be a GST, then only RCM will be applicable. Moreover, here RCM will not be applicable. Why? Because there is another amendment which is there in RCM, which says that one circular has been given. So whether director who is providing services to the company in his personal capacity, generally director service to company will come under RCM. But what if the director is providing service to the company in his personal capacity? For example, director is having an immobile property. commercial property which he is giving on rent. So now in that case, will it come under RCM or FCM only? FCM only, it will not come under RCM. Generally, director service to company comes under RCM. If it is director service, if the director is acting in a personal capacity, in his personal capacity, that will never come under RCM, it will be FCM only. And that discussion is not at all applicable here, because here first of all the value will be taken as nil and there is no GST liability. Rule 29 talks about principal agent transactions. In case of principal agent transactions, Rule 29 is applicable only in case of goods, not in case of services. Rule 27 is applicable for both goods and services. 28 is applicable for both goods and services. But this 29 is applicable only in case of goods. What should be taken? In the third point is missing. So in the second situation, second point gone. In the third situation, third point is gone. So what should be taken? OMV. If not available, cost plus 10%. But for this OMV, they are asking us to compare with 90% of the resale price. So we need to take open market value or 90% of the resale price at the option of the supplier. Otherwise, then cost plus 10% will be taken. And see these notes. Suppose if any of these is not possible, so Rule 31 will be applicable, and Rule 30 cost means what we have seen. So in such case, that is when open market value is deemed to be transaction value, when the recipient is eligible for full ITC, any value declared in the invoice will be deemed to be the open market value. Means 1 rupee invoice also can be raised, yes. 1 rupee invoice also can be raised. In that case, invoice can be generated for any value, even 1 rupee is considered as value. Then in case of services, Rule 30 will not be applicable. Why? Because Rule 30 talks about cost plus 10%. So cost of providing the services is difficult to ascertain. So therefore, in case of services, we can skip Rule 30 and directly go to Rule 31, that is residual value. And this is the difference between OMV and LKQ. So here we have completed Rule 27, 28, 29, 30 and 31. So these are the 5 rules that are connected in this. Now we are looking into Rule 31A. So Rule 31A is applicable in case of specified actionable claims. So there is an amendment in this aspect here, that previously all actionable claims other than lottery, betting and gambling was excluded from supply. But now they modified this to all actionable claims other than specified actionable claims are excluded from supply. So what are these specified actionable claims? So you remember this keyword HC block. So what are these specified actionable claims? The specified actionable claims is HC block. What is that H? H refers to horse racing, and C refers to casinos, and B refers to betting, and L refers to lottery, and O refers to online money gaming, not online gaming, online money gaming, and G refers to gambling. Sir, why online gaming will not come under specified actionable claims? Because online gaming is treated as OIDR services. Due to that reason, it will not be coming under specified actionable claims. So that's treated as service. And these specified actionable claims are treated as goods. All these specified actionable claims are treated as goods. What is the difference between online gaming and online money gaming? Online money gaming means, so generally we deposit some money, and with the objective of winning the money, we play the game. That is known as online money gaming. Online gaming means normally we spend money to play the game, but there the objective is not winning the money. So that is not the objective, just playing the game, but we spend the money to play the game. So that is known as online gaming. Like for example, so there's a Sniper 3D or PUBG or Free Fire. So a lot of Call of Duty, these are all some games which people will play and they will spend money to play the games. Even GTA also, GTA Vice City, etc. So these are like where we spend money to play the game. That is online gaming. Whereas online money gaming is like betting platforms like Rummy Circle, Online Rummy or Dream 11. So these are all some websites wherein we spend money to play. Lot of games are there, betting games like Ludo also there. Ludo betting game is there. You can put 100 rupees, you can play Ludo, and if you win, you will be getting 400 rupees. So that is called as online money gaming. Betting is involved. So that will come under specified actionable claims, and these are all treated as goods. And what is the rate of GST for this? The rate of GST will be 28% in all these cases. Now, what should be taken as the value in this case? In case of lottery, So there are total 6 specified actionable claims. In that, for lottery, we are discussing the value first. What should be taken as the value? So lottery tickets always assumed to be inclusive of GST. Always assumed to be inclusive of GST, and we need to take face value of the lottery ticket or the price notified by the organizing state, whichever is higher, into 100 by 128 will be value, GST will be 28 by 128, always inclusive only, and we will never calculate in case of lottery on exclusive basis. And face value of the ticket means that price that is printed on the ticket. Price notified by the organizing state means, so sometimes the price may be lesser than the face value of the ticket. So if the demand is less, so they will try to reduce the price of the ticket. If the demand is high, they will increase the price of the ticket, who the organizing state. So therefore, whichever is higher will be taken, into 28 by 128 will be GST, into 100 by 128 will be taken as the value. That is with respect to supply of lottery, and always inclusive basis only. Okay. And here rate of GST, so this 28% is the rate of GST, this 12% is not applicable. GST rate is 28%, and always assumed to be inclusive of GST. Always GST computed on inclusive basis. Computed on inclusive basis. Then, in case of specified actionable claim related to betting, gambling and horse racing, for three cases. So horse racing, betting and gambling. For these 3 cases, they are telling 100% of the face value of the bet or the amount paid to the totalizer. For example, there is a horse racing, 10 horses are there, and people will randomly place bets on different horses, but only one horse will win. Now, all the horses people have placed the bet now, that is called as a total bet value, not the people who place bet on the winning horse, all the horses. So whether you are winning or losing, government will always be winning. So therefore the total bet value will be taken as a value for payment of GST. You understood? Means even on losing horse also people will place a bet. So that amount also GST will be payable. So the total bet value or the total amount collected in the bet. And here, whether it will be computed on inclusive basis or exclusive basis, that depends. This they are not telling, it will be always on inclusive basis. So you go by the question. If the question says inclusive, you take inclusive. If the question says exclusive, you take exclusive. But here we don't have any mandatory provision like it should be computed on inclusive basis. So in case of lottery ticket, what should be taken as a value? Come on. And this valuation is given in Rule 31A, B, C. Rule 31A, Rule 31B and Rule 31C. Previously Rule 31A was only there. Now they have added Rule 31B and Rule 31C. So first, in case of lottery, what should be taken as a value? Face value of the ticket or price notified by the organizing state, whichever is higher. And it should be always computed on an inclusive basis. Number 2, in case of betting, gambling and horse racing, these 3 cases, what should be taken as a value? So 100% of the face value, like 100% of the amount collected. So it is like, so total amount collected by the totalizer or organizer, that should be taken as a value, not the commission, total amount collected. Then next we have Rule 31B and 31C. 31B is in case of online money gaming and 31C is in case of casinos. Okay. So in case of online money gaming, sir, what about online gaming? For online gaming also we can apply Rule 31B. So, but online gaming will not come under specified actionable claims. Online gaming will come under which category? OIDR services. But online money gaming will come under specified actionable claims. But when it comes to valuation, the valuation will be common for both online gaming as well as online money gaming. And 31C is in case of supply of actionable claims in casinos. First we will see online gaming and online money gaming, what should be taken as a value. The value will be amount paid or payable or deposited with the supplier by way of money or money's worth, including virtual digital asset, by or on behalf of the player. So usually what happens is that when we play the online money gaming, so we will deposit some money to play the game. So either it can be money or it can be virtual digital assets like cryptocurrency. Using cryptocurrency also we can place the bet. So this money deposited will be taken as the value. For example, so you have downloaded one Rummy app or some betting app, and you started playing. First you need to deposit money. Say you deposited 10,000 rupees, and this 10,000 rupees will be chargeable to GST. 10,000 rupees should be taken as the value. Now when you play the game, say for example 6,000 rupees you have spent for playing the game and you lost 6,000 rupees. Now how much is the money left? 4,000 rupees. Now you realize usually people will not get this habit. So what they will do is that let's spend this also so that the 6,000 we can win, because it will become an addiction. Only a great heart will have the guts to withdraw the money. Okay, so therefore you realize 6,000 rupees you spend, at least 4,000 rupees you want to save. So therefore 4,000 rupees you have withdrawn, which means how much you placed as bet is only 6,000 rupees, but the GST is payable on 10,000 rupees. If you withdraw 4,000, you will not get any GST refund, which means GST is payable on the amount deposited. If any amount is withdrawn out of that, we will not get any reduction in the value. Is it clear or not? Then suppose 10,000 rupees you have deposited, you paid GST on 10,000 rupees. In that 6,000 rupees you have spent for playing the bets, and you won some bets and you got more money. Say for example you deposited 15,000, now in your account 15,000 is there. You deposited 10, in your account 15,000 is there. That 5,000 rupees is what? Gain. On that gain, are you required to pay any GST? No. Either if you withdraw, no need to pay GST. Even using that 5,000, again you will play the game, then also no need to pay any GST on the winning amount. Okay, only on the amount deposited initially we need to pay. Now see the twist. You are withdrawing that 5,000 rupees. Again you are putting that 5,000 rupees to play the game. Now it will be considered as a new deposit. Again on that GST will be payable. So without withdrawing, if you use it for playing the game, on that there won't be any GST. The moment it is withdrawn and again deposited, it will account for new deposit and again new GST will be attracted. So see this. Value of supply will be, remember, amount deposited. Value of supply is what? Amount deposited. That amount can be in the form of money, or it can be in the form of money's worth, or it can be in the form of virtual digital asset. Anyway it can be. So sometimes what will happen, some betting platforms and all, they will not allow you to deposit the money. So the moment you want to play the game, so they will be giving you some mobile numbers. To that mobile numbers, you need to do GPay. The moment you make GPay to that mobile number, so in your account, they will be giving some tokens or coins. So these tokens or coins or points, etc. So is money's worth. So you did not deposit money, but you got some tokens or points. How it is that it is money's worth? Sometimes without attracting any GST, people will try to play the games or betting using the cryptocurrency like Bitcoins or Ethereum coins or Doge coins or Raven coins, etc. Even those coins also will be considered as money's worth only, and on that GST will be payable. That is this money deposited or amount deposited. Now see this point, any amount returned or refunded by the supplier to the player, including amount paid or deposited with the supplier, which is not used by the player, shall not be deducted from the value of supply. So 10,000 rupees we deposited, that's the example I gave you. So 10,000 deposited. For this first point, what is the example I gave you? 10,000 deposited, 10,000 deposited, 6,000 used for playing, and 4,000 withdrawn, 4,000 withdrawn. Now GST payable on 6,000 or 10,000? 10,000. So this withdrawn 4,000 rupees withdrawn will not be reduced. So whatever money that is withdrawn which is not used by the player shall not be deductible from the value of supply. Okay. And next, second, any winning amount which is used by the player without withdrawing shall not be considered as the amount paid to or deposited with the supplier. What is that? Say this. 10,000 deposited and used for playing, and won 15,000, okay, which in turn is used for playing, is used for playing. So now GST payable on 10,000 rupees. Any winning amount which is used by the player without withdrawing shall not be considered as the amount paid to or deposited with the supplier. Suppose in this case 10,000 deposited and used for playing and won 15,000. 5,000 withdrawn and again deposited for playing. Now what will be taken as the value? So GST will be payable on 15,000. GST payable on 15,000. So simply remember, whatever is the money that you are depositing, on the deposit there will be GST. Okay. And one friend has given super nice point. So GST on deposits and income tax on withdrawals. Correct? Of course. So when you deposit, you need to pay GST. When you withdraw, you need to pay income tax because it comes under gains, betting, etc. Correct. Then, so but it's not on the withdrawal literally. It is on whatever gain that you are getting, on that you need to pay. So this is about online money gaming. Whereas casino also same point, no change. For casinos also same story, but only difference is what? In casinos you will not directly deposit the money, you will spend money to buy the coins, chips. In casino there will be like something called as chips, like green color, red color, yellow color chips and all will be there. So to buy these chips we will be spending money. So that money spent for purchasing of chips will be treated as the value. And suppose we win the money, we win the chips and we redeem it. At the time whether we get any reduction in the value? No. So same story, everything same. Only difference is what? In online money gaming we deposit and here we spend money to buy the chips. Say this. Value of supply will be amount paid or payable for purchase of token, chips or coins or tickets for use in the casino by or on behalf of the player, and these points are common in this case. So again, this is another area which you can definitely expect a question, at least a MCQ on this. So MCQ, at least a 2 marks MCQ they will be testing on this specified actionable claim, what should be taken as the value. Then rule 32 we are moving on. So this rule 32 is applicable in case of 5 specified transactions. Rule 32 is a optional valuation. Either we can follow the transaction value or we can follow the value as per rule 32. What are the 5 cases where rule 32 is applicable? Number 1, foreign exchange transactions including money changing. Number 2, air travel agent. Number 3, life insurance business. And number 4, second hand dealer in goods. And number 5, vouchers, coupons, etc. So these 5 cases only rule 32 will be applicable. Again remember, rule 32 is an optional valuation, which means that either we can follow transaction value or we can follow the value as per rule 32. So value of supply in special situations, either a transaction value or value under this rule at the option of supplier. For each supply, with respect to each invoice we can decide. The first one is foreign exchange transactions including money changing. Means basically here we will exchange one currency to another currency, and in that again we have 2 options. Rule 32 itself is an option. In that rule 32 again we have 2 options. Option 1, rule 32 2A. What does it says? Check whether one of the currency exchange involves Indian rupee and RBI reference rate is available for that currency on that day. Then either bid rate or ask rate and the RBI reference rate into units of currency will be taken as a value. Say for example, there is a quote which is available, rupee per dollar, that is 82 and 85. So this is the quote, and in this case what happens is that we are exchanging $10,000 for Indian rupees. Now RBI reference rate and RBI reference rate for that day is 83.5 per dollar, rupees 83.5 per dollar. what will be taken as the value? Value under rule 32 sub rule 2A. A refers to first option. A refers to first option. We need to take, so either bid rate or ask rate, depends. Which rate should be taken? Here bid rate should be taken because we are exchanging $10,000. When we are exchanging $10,000, bank is buying $10,000. So therefore the relevant rate will be bid rate 82. And what is the RBI reference rate? 83.5. So the difference will be 1.5. On that 1.5 into units of currency. How many units of currency? 10,000. So that will be equals to 1.5 into 10,000. 15,000 rupees will be taken as the value. So when one of the currency exchange involves Indian rupee and RBI reference rate is available for that day, we need to take either bid or ask depending upon the transaction and the RBI reference rate. The difference should be taken into units of currency. This will be taken as the value under rule 32.2a. Suppose in the same case, what will be taken as value under rule 32.2b? Another option. Rule 32.2b is like a slab rate model. In this slab rate model, what will happen is that if the gross amount does not exceed 1 lakh, then 1% of the gross amount or 250, whichever is higher, will be taken. If the gross amount exceed 1 lakh but does not exceed 10 lakhs, 1000 rupees plus 0.5% of the gross amount exceeding 1 lakh. If the gross amount exceed 10 lakhs, 5,500 plus 0.1% of the gross amount exceeding 10 lakhs subject to maximum 60,000. You need to remember these percentages, 1%, 0.5% and 0.1%. Say for example, if the gross amount exchange is 60,000 rupees, 60,000 rupees into 1%, that is 600 rupees or 250, because 60,000 will come in the first slab. So 60,000 into 1%, 600. 600 or 250, whichever is higher, will be 600. Suppose if the gross amount exchange is 20,000, still it is in the first slab. 20,000 into 1%, 200, 200 or 250, whichever is higher, will be taken as 250. Suppose if the gross amount exchange is exactly 1 lakh, 1 lakh into 1% will be 1000, 1000 or 250, whichever is higher, will be 1000. So when you are moving into the second slab, the minimum amount will be 1000. Say for example 3 lakhs. 3 lakhs means you are coming into the second slab. For the first 1 lakh it will be 1000 and remaining 2 lakhs. 2 lakhs into 0.5% will be 1000. So 1000 plus 1000, 2000 rupees will be taken as a value. What if it is 9 lakhs? So again second slab. First 1 lakh 1000, remaining 8 lakhs. 8 lakhs into 0.5%. So that will be 4000. 4000 plus 1000 will be 5000. What if it is exactly 10 lakhs? Still second slab. First 1 lakh it will be 1000, remaining 9 lakhs. 9 lakhs into 0.5% will be 4500. 4500 plus 1000 will be 5500. So the moment you are moving into the third slab, it will be 5500 rupees plus. So there will be extra amount into 0.1%. Say for example, if it is 80 lakhs. 80 lakhs means you are in the third slab. First 10 lakhs it will be 5500, remaining 70 lakhs. 70 lakhs into 0.1%. So 70 lakhs into 0.1% will be 7000. 7000 plus 5500. So that will be 7000 plus 5500 is what? 12,500 will be taken as the value. Now, what if it is like 800 lakhs? 800 lakhs, first 10 lakhs will be 5500, remaining 790 lakhs into 0.1, 79,000, but the maximum amount is only 60,000. That will be taken as a value. Now, applying this here in this case, what is the gross amount? Suppose if you are determining the value under rule 32, sub rule 2b, what will be taken as a value? Take the gross amount exchanged in Indian rupees. What is the gross amount exchanged in Indian rupees? $10,000 into 82 rupees. So gross amount in Indian rupees, gross amount is $10,000 into 82 rupees per dollar. That will be how much? 8 lakh? 8 lakh 20,000. 8 lakh 20,000 means that comes under which slab? Second slab. For the second slab, what should be taken? First 1000, minimum 1000 rupees. Plus, what is the extra amount? 7 lakh 20,000. 7 lakh 20,000 into 0.5%. So please do this. 7 lakh 20 into 0.5% plus 1000. 4,600 will be taken as a value. So this is how we need to arrive at the answer. Then second, what if RBI reference rate is not available? If in above case, RBI reference rate not available. So then what we will do? Simple, we will be taking gross amount exchanged in Indian rupees into 1%. Say this. One of the currency exchange involves Indian rupee and RBI reference rate not available for that currency on that day. So gross amount in Indian rupees into 1%. So this is in case of rule 32(2)(a). So the value under rule 32(2)(a), value under rule 32(2)(a) is gross amount into 1%. What is the gross amount? 8,20,000. 8,20,000 into 1%, that will be 8,200 will be taken as value. Whereas what will be taken as value under rule 32(2)(b), no change. So whether RBI reference rate available or not available, this will be always same. 1,000 rupees plus 7,20,000 into 0.5%, that will be coming to 4,600. Then next we will be taking number 3. What if both the currencies exchange involves in foreign currency? So when both the currencies exchange involves foreign currency, convert both the currencies into Indian rupees using RBI reference rate into 1%, whichever is lower will be taken. Say for example, we have dollar per pound, so is 1.5 and 1.8. We are exchanging, so 6,000 pounds for dollars. Okay, RBI reference rate for rupee per dollar is 85 and rupee per pound is 140. Then what will be taken as the value in this case as per 32(2)(a), value under rule 32. Value under rule 32(2)(a) will be gross amount exchanged in Indian rupees using RBI reference rate into 1%. So lower of what? So take the sold currency, that is 6,000 pounds. 6,000 pounds into RBI reference rate, that is 140 per pound into 1%. So 6,000 into 140 into 1%. How much that will come to? 8,400. Now 6,000 pounds, 1.5 rupees means how many dollars? So dollars wise, if you see 6,000 pounds, if you take 1.5, you will be getting $7,500. Now that $7,500 into exchange rate 85 rupees per dollar into 1%. So how much that comes to? 9,000. 6,000 into 1.5, 9,000. 9,000 into 85 into 1%. 7,650, whichever is lower, therefore 7,650 will be taken as the value. So therefore the purchased currency as well as sold currency, convert both the currencies into rupees using RBI reference rate into 1%, whichever is lower will be taken as the value in this case. And in this case, whether 32(2)(b) is possible? No. Value under rule 32(2)(b) not possible. Why 32(2)(b) not possible? Because both the currencies are exchanged which are foreign currencies, so we cannot determine the value in case of rule 32(2)(b). So this is about 32(2)(a) and 32(2)(b). Now in these two options, which option I should choose? I can choose any option, but that option chosen in the beginning of the financial year will be applicable throughout the financial year. But sir, you said invoice wise we can choose. Yes, invoice wise we can choose transaction value and value under rule 32. But the moment you go into rule 32, in rule 32 we have two options that we need to decide in the beginning of the financial year, that will be applicable throughout the financial year. Option to be decided in the beginning of the financial year, which shall be applicable throughout the financial year, and what will be taken as a transaction value. Currency conversion fee or currency markup fee. So whatever is the actual consideration that the bank or forex dealer is collecting from us for doing the currency exchange, so that markup fee or currency conversion fee will be taken as a transaction value. We can go by transaction value also. Wherever rule 32 is not possible, we can determine the transaction value. This is about 32 sub rule 2. Then 32 sub rule 3 is in case of air travel agent services. In case of air travel agent services, so air travel agent is required to pay GST on 5% of the base fare in case of domestic bookings and 10% of base fare in case of international bookings. Base fare will be the basic amount that will be there in the ticket. In air ticket, there are three components: base fare, fuel surcharge, other charges and taxes. In that, the base fare is the first component. On that first component, into 5% in case of domestic bookings, 10% in case of international bookings. Then life insurance business. In life insurance business, so if it is a risk cover policy means term insurance, wherein we will pay the premium. If nothing happens, we will not get anything backwards. So that is called as term insurance. In case of term insurance, entire premium will be income to the insurance company. So therefore, on entire premium, GST will be payable by the insurance company. Whereas in case of reinvestment policy, in reinvestment policy, whatever premium that we pay will not go into the hands of the insurance company. In that, they will deposit a percentage in the stock market or some debt instruments, etc. So the remaining amount will be taken as value on which they will pay GST. So premium collected minus amount allocated for investment, but condition, important condition is that the amount allocated for investment should be communicated to the policyholder at the time of collection of the premium. So where the amount allocated for investment is intimated to the policyholder, gross premium minus amount allocated for investment. Then single premium annuity policy, there is only one premium that is involved. Rather than paying every year, a single premium will be paid. So in that case, 10% of that single premium will be taken as the value. So risk cover policy, entire premium collected. Single premium annuity policy, 10% of the single premium. Reinvestment policy, amount collected, premium collected minus amount allocated for investment. If amount allocated for investment is not communicated to policyholders, then what it will be? It will be like a normal life insurance policies. In case of normal life insurance policies, so what should be taken as a value? 25% of premium in first year and 12.5% of premium of subsequent years. So every year insurance company will have first year premium and subsequent year premium. So this year, whatever new policies that they have given, premium collected is first year premium. Those who already took the policies in the previous years, they will pay premium this year, that is known as subsequent year premium. So first year premium into 25%, subsequent year premium into 12.5%, that will be taken as a value in this case. Then next one, rule 32 sub rule 5, buying and selling of second hand goods. In case there is a person, a dealer, who is engaged in purchase of second hand goods and sale of second hand goods, so then only this will be applicable. My purchase also used goods, my sale also used goods. Then I need to take the margin scheme. What is margin scheme? Sale price minus purchase price will be taken as the margin scheme, and on the difference only GST will be payable. For example, I am purchasing a used car for 1,50,000. I am selling this used car for 2,50,000. Now what is the margin here? 1 lakh. So I need to pay GST only on 1 lakh. Sale price 2,50,000, purchase price 1,50,000. So 2,50,000 minus 1,50,000, on 1 lakh only GST will be payable. So value equals to selling price minus purchase price, that is margin scheme. What if it is negative? For example, I am purchasing a car for 2,50,000 and I am selling it for 2 lakhs. So 50,000 rupees is loss for me. Whether I need to pay any GST? No. As the margin is negative, so you don't have to pay any GST, value will not be there. ITC should not be availed on the purchase. So I should not avail any ITC. If the ITC is availed, margin scheme is not possible. Means at the time of purchase of the car, I should not have taken any ITC. So if ITC availed, anyhow I will pay GST effectively on margin only. So due to that reason, this margin scheme is not applicable. Even though I gave you example of car, but this is applicable in case of all second hand goods. And then suppose in case where we do the repossession and sale, we are a finance company. We would have given finance with respect to an asset, motor vehicles or assets, etc. Now the person has not repaid EMIs. When he is not paying the EMIs, as a financier we will do repossession of that asset, and this repossessed asset we will sell. At the time of repossession, whether this asset is a new asset or a used asset, and we are selling that used asset to recover our finance amount. So which means we will also come under the category of second hand dealers. So in this case, what should be taken as the sale price, the price at which that repossessed asset is sold. But what will be taken as a purchase price? We are not buying it, we took it as a repossession. Then what should be taken as a value? So we need to give a depreciation. How to calculate the depreciation? 5% for every quarter or part thereof, from the date it is purchased, the asset is purchased, till the time it is sold. So repossessed and sold. So we need to count that. So purchase price is original purchase price to the defaulting borrower, who is an unregistered defaulting borrower, minus 5% for every quarter or part thereof, from the date of purchase till the date of disposal of that repossessed asset. So that should be taken as a value in this case. Then in case of coupons or vouchers, so the value will be money value of supplies redeemable against such voucher or coupon. So for example, we have got a voucher. That voucher, if you redeem, you will be getting goods worth rupees 1000. Then what will be taken as a value of this voucher? 1000 rupees will be taken as a value of this voucher. Money value of supplies redeemable against such voucher, that will be taken. Then there are some notified service between distinct persons without consideration. The value should be taken as nil, but the services are yet to be notified for this purpose. So this rule is not applicable at present. So you don't have to remember this. Then next point is related to TCS. Generally, as per 15(2)(a), all taxes, duties and cess by whatever name called other than GST should be included in the value. Then whether the TCS which is collected by the supplier from the recipient under Income Tax Act should also be included in the value. No, because TCS is not a tax on income. TCS is a tax on expenditure. So it is an interim levy, not having the character of tax. For example, I am a car dealer. I am selling a car to you, and apart from the price of the car, I am also collecting TCS at 1% from you, plus GST also I am collecting. While computing GST, whether this 1% TCS should be included in the value of the car? No, because this is basically your expenditure. On your expenditure, I am collecting this 1%, which is an interim levy, and I will deposit it so that you have to show the source of income to the income tax department, and you need to pay tax. Suppose if you don't have any income tax, that 1% you will fully get it as a refund. So due to that reason, it is not having the character of tax, it is basically interim levy. So CBIC circular says that this TCS collected by the supplier from the recipient under Income Tax Act should not be included in the value. That is this. Any taxes, duties and cess shall be included in the value, but TCS is not includable in value as it is an interim levy but not having character of tax due to that reason. Then next, usually in case of banking companies, financial institutions, they will be appointing business facilitators and business correspondents. These people are basically like agents. So whichever work the bank has to do, that work will be done by these business facilitators and correspondents. So they will be collecting some service charges. So these service charges they collect and they remit to the bank. So on these service charges, they are not required to pay GST. The GST is payable by the bank. Then what will be included in the value of their supply? It is only the commission. So they get a commission, that will only be their value of supply. See this, there is a banking company and there is a business correspondent or business facilitator and there is a customer. Now business correspondent or facilitator will provide the service on behalf of bank to the customer, and they will be collecting service charges from the customer and they will remit that service charges to the banking company. For doing this activity, so they will get a commission. Now what will be taken as value of supply in the hands of BC and BF? It is commission. What will be taken as value of supply in the hands of the banking company? It is the service charges. Then next, we have rule 34, which talks about relevant date for determination of exchange rate in case when the transaction is in foreign currency. I mean sale of goods or purchase of goods or supply of services or any import of services. We need to pay GST on that. Now the invoice is in foreign currency. Now for me, I have to pay GST in Indian rupees. So I have to convert the invoice which is in foreign currency into Indian rupees. For that, what exchange rate should be taken? In case of goods, I need to take CBIC notified exchange rate. In case of services, GAAP rate. Usually GAAP rate is average of the buying rate and the selling rate. So that will be taken. So in case of goods, CBIC rate. In case of services, GAAP rate. Prevailing on which date? Prevailing on the time of supply for this transaction. For every transaction, there will be a time of supply. You see the time of supply for the transaction. On that date, whatever is the CBIC rate or GAAP rate you take and multiply, you will get the value in Indian rupees. On that, you pay the GST. Suppose if I have taken 85 rupees per dollar and I paid the GST on import of goods, and actually, so I am paying 86 rupees per dollar. 85 is the CBIC notified rate, but at the time when I made the remittance, it is 86 rupees per dollar. Now on that extra 1 rupee, again should I compute the GST? Not required. So ignore the foreign exchange gain or loss. So exchange gain or loss shall be ignored for the purpose of GST. So these are the various points related to value of supply. We completed this. And there are few queries. So let's see. Sir, what will be the value of a second-hand car if ITC is availed? If ITC is availed, the value will be full value, sale value. Don't go for margin scheme. Full sale price will be taken as the value. In Rule 32 Sub-Rule 5, quarter means calendar quarter. Everywhere in GST and customs, yesterday itself I told you that we need to take only calendar quarter only. It should not be like, so January 15th to April 15th if you see, actually it is 3 months only. But it should be taken as 2 quarters. Why it should be taken as 2 quarters? Because calendar quarter logic we should apply. So everywhere it will be, wherever quarter comes in GST and customs, it will be calendar quarter only. Okay. Then next. Gaming agency is a supplier. So supplier of online money gaming has to pay GST. Yes. So definitely supplier only will be paying GST even if the supplier is located outside India. So that point comes in section 14A, place of supply. There I will discuss with you. So online money gaming supplier is only liable to pay GST. Online money gaming is not covered under RCM. It is covered under FCM. Always supplier only will pay. Sir, what if the supplier is located outside India? Then also that supplier only will be paying GST. Then, sir, the gaming agency is only has to pay GST. Yes, correct. Then, what about the bonus given Rummy circle into the user account? See, that bonus is basically not coming here because bonus will be coming under an incremental amount only, like a winning amount only they will be giving. So, on winning amount there is no GST now, only on the amount deposited there will be GST. So, how much amount you have deposited, that only should be taken into that user account. Yes. Fine. I have given the list of goods which are covered under RCM. Section 9(3) read with notification number 4/2017. Sir, already in this one you know what is that? PSLC. Just now we discussed priority sector lending certificate. Who will be paying GST? Recipient will pay GST. So liability to pay GST is on the recipient. Priority sector lending certificate. Okay. And then next you need to know, I think it's not there. It's not there in that book. You quickly make note somewhere, na? Okay. I think I have given that. It might be there. Otherwise, you can make note of it. For the sake of this and all, don't buy new book. Okay. Of course, if you buy it is revenue for me only. But what's the point? You know, many students ask me, sir, I have November 23 book, sir. Can I make use of it? I told them 2 options. Number 1, if you can afford, you buy the new book. If you cannot afford, anyhow amendments and all I am sharing. In these lectures I am discussing. So just to pause the video and you make note of this amendment. Okay, that's the best thing. Anyhow, it is free only, na? YouTube it is there. How many times you want to pass, you can pass and you can make note of it. Okay. And say this, or if you want to buy, you buy, good only, anything is fine for me. Then, so 9(3) read with notification 4/2017, the first product that you need to remember is what? PSLC. Who will pay GST in this case? The recipient will pay GST. Now see this, 4 goods sold by agriculturist, 4 goods sold by agriculturist. What are those 4 goods? Cashew nuts, BD wrapper. BD wrapper leaves means, BD leaves means what? Tendu leaves. So they will take a leaf, put the tobacco on, roll it, na? That is BD leaf. Okay. So this poor man's cigarette, BD leaf. Cashew nuts, BD leaves and tobacco leaves. What is tobacco leaves? This tobacco leaves will be used inside the product. Okay. Outside the product is BD leaf. Inside that we get pieces. Okay. In cigarette inside and all pieces will be there. In cigars inside and all pieces of leaves will be there. That is tobacco leaves. Okay. BD leaves, cashew nuts, tobacco leaves and raw cotton. Not processed cotton, raw cotton. From the plant, they take the cotton. Na? So one big kind of will be there, raw cotton. You would have seen one seed will be there. To that seed, cotton will be attached. So that they will pluck from that seed. So that is a raw cotton. These 4 are sold by whom? Agriculturists. Then the ability to pay GST is on the recipient. Okay. What is the first point you need to remember? Priority sector lending certificate. Acquiring bank, that is buying bank, will be paying GST. Then second point you need to remember, 4 goods. What are the 4 goods? Cashew nuts, BD leaves, tobacco leaves and raw cotton. okay, sold by agriculturist to any person, liability to pay GST is on the recipient. You understood? And in this case, the recipient should be a registered person. What if they are selling to an unregistered person? As this is covered under 9.3 or not covered under 9.3? Not covered under 9.3, because 9.3 says the recipient should be registered. 9.3 says the recipient should be registered, then only it will come under RCM. So what if it is unregistered person? Means it is not covered under 9.3. When it is not covered under 9.3, then supplier unregistered, recipient also unregistered. Whether any GST is applicable? No, there is no GST. Why supplier is unregistered? Just now I said na yaar, agriculturist is exempted from registration, correct? 4 people are exempted from registration. Who are those 4 exempted from registration? Exclusively exempted, exclusively RCM, exclusively non-taxable, agriculturist. Agriculturist will never register. So supplier is definitely unregistered. And recipient, if registered, it will come under RCM. What if it is unregistered? What if the recipient is unregistered? It will not come under RCM 9.3, which means there is no GST on that, because this point can definitely be tested. They will tell sale of cashew nuts by an agriculturist to an unregistered person. And in the options, liability to pay GST is on supplier, recipient, either on supplier or recipient. D, none of these. The answer is none of this. Okay. Why none of these? Because there is no GST on that transaction. 9.3 will be applicable only if the recipient is registered person. You got it? So what is that you need to remember? First point, priority sector lending certificates. Supplier can be any registered person, recipient is any registered person. Whereas in case of 4 goods, what are the 4 goods? Cashew nuts, tobacco leaves, BD leaves and raw cotton. Supplier should be agriculturist. Who should be the recipient? Any registered person, And then along with this, we will also see, as raw cotton we completed, silk yarn also you see. Silk yarn. Silk yarn is sold by a manufacturer, a person who manufactures the silk yarn from raw silk or silkworm cocoons for supply of silk yarn to a registered person, then it will be coming under RCM. So people who do sericulture, they extract the raw silk from the silkworm cocoons, and even so this raw silk will be supplied to manufacturers. Manufacturers will make the silk fabric, silk yarn, and that silk yarn they will be selling to garment manufacturers. So these people, any person, supplier can be any person, and the recipient should be a registered person, then it will be coming under RCM. See, you have to remember mainly the recipient. Supplier not a problem, recipient only you need to remember. Then only it will come under 9.3. Then next one. So 3 points you understood? Next, say this. Certain essential oils other than those of citrus fruit. There is a big list of essential oils. That list and all we cannot remember. Okay. Less peppermint oil, eucalyptus oil, like that lot of oils they have given. Okay. So remember, essential oils other than those of citrus fruit. Supplier any unregistered person, and recipient should be a registered person. And then we have lottery. Who is selling lottery? State government is selling lottery. State government or union territory. Then only RCM. What if lottery is not sold by state government, is sold by lottery distributor to a lottery retailer? Will it come under RCM? No, it will be FCM. Okay. Then used vehicles, seized vehicles or goods or confiscated goods sold by government. So government is selling seized vehicles or seized goods or confiscated goods. So they will be selling, excluding Ministry of Railways. Why sir, Ministry of Railways it is excluded? Because write down below in the notes, Ministry of Railways is always covered under FCM. Ministry of Railways is always covered under FCM. We don't have any RCM with respect to this. Ministry of Railways, Ministry of Railways, this is also an amendment. Ministry of Railways always covered under RCM. Oh, sorry. always covered under FCM. So liability to pay GST is on the supplier. That's why they have given excluding Ministry of Railways. Okay. Then state government, union territory or local authority. So supplier is government here. Supplier is government. Government means central government, state government, local authority or union territory. They are selling it to any registered person. So the liability to pay GST is on that registered person under RCM. On what? These seized vehicles or used goods or seized goods or any confiscated goods. Then these are the points that you need to remember, but please remember the supplier and the recipient also, because don't remember only the goods. If you remember only the goods, you may end up with the wrong answer. 90% wrong answer only it will be, because goods you know that it is covered under RCM, but they will not play in the goods, they will play in the supplier and the recipient. So therefore they will be giving like recipient is unregistered person, you will tell RCM, and the recipient is compulsorily required to get registered and all you will write. No, actually it is not there. Okay. One more point also you write down, sale of cashew nuts or sale of tobacco leaves. Sale of tobacco leaves by agriculturist to unregistered person. To unregistered person. What is your answer? No GST. There is no GST in this case. Only if it is sold to a registered person it will be coming. Then now one student has messaged, book is not very costly, no point in struggling with the old book and new amendments. That's what I said. But if I tell no, why new book and all, then they will say, see, sir wanted to earn money, he want to construct 4 or 5 buildings, for the sake of that he is telling like that, people will think. It's up to you, you decide which you need. I will not force anyone. Okay. Then say this, one more point, sale of lottery tickets. Sale of lottery tickets by lottery distributor to retailer. Lottery retailer. FCM or RCM? FCM. Only when the lottery tickets are sold by government to the lottery distributor or agent, then it will be coming under RCM. But when any other person is selling it to lottery retailer or agent, that will not come under RCM, it will be FCM. Okay. Like this, points can be tested. So this is what you need to remember. Okay. So one last time I am repeating. So first you need to know priority sector lending certificates sold by any registered person to any registered person, it will come under RCM. Then second point you need to remember, cashew nuts, BD leaves, tobacco leaves and raw cotton sold by agriculturist to a registered person. Number 3, silk yarn sold by any person manufacturer to a registered person, it will be coming under RCM. And then essential oils other than those of citrus fruit by any unregistered person to a registered person, it will come under RCM. 4 points. Then fifth one is like lottery sold by government to lottery distributor or lottery agent. And the last point you need to know is about that used vehicles, seized or confiscated goods sold by government to a registered person. Correct or not? So now what if, say this, sale of used goods by government in brackets registered to unregistered person. What is your answer? Sale of used goods by government registered to unregistered person. GST applicable. Government is registered. FCM. Between two unregistered persons only no GST. Don't write everything no GST and all. Between two unregistered persons only no GST. Here government is registered to unregistered person. It is not covered under RCM. Why it is not covered under RCM? See the wording there. So sale of used vehicles, seized and confiscated goods and used goods by government to any registered person, then only it will come under 9(3) RCM. Okay. Then, sir, if agriculturist voluntarily taken registration, then agriculturist sold to unregistered person, liable to pay tax under FCM or not? So if they are selling it to unregistered person, it will not come under 9(3). First you should interpret like this. Agriculture is selling to unregistered person. It will not come under 9(3). Not coming under 9(3) means what? Regular FCM. FCM. And is the supplier registered? Yes. Voluntarily he got registered. So let him pay GST. You got it? Suppose if the supplier is not registered, no GST. But if the supplier is registered, GST payable. Same logic, this also. Government selling the used goods to the unregistered person. Is it given in 9(3)? Not given in 9(3). Not given in 9(3) means what? FCM. Got it? FCM. And is the supplier registered? Yes, he will pay. Supplier not registered? No GST. Got it? That is how you need to interpret. Then, what if cashew nuts shelled sold by agriculturist to registered person? So, not shelled, that is processed cashew nuts then, not the raw cashew nuts. Why agriculturist he will be called as? Hypothetical question it is. He will not be called as agriculturist. The moment he do the process, he will not be called as agriculturist, because who is called as an agriculturist? Who is engaged in supply of agricultural produce, produce out of cultivation of land. The moment he does the process, then it will not be called as he will not be called as agriculturist. If he is not called as agriculturist, is he covered under this list? No. So naturally it will be FCM only. You got it? So therefore this question is a hypothetical question here. Now these are the points that can be tested. It's an amendment. Then next we will see services covered under RCM. You understood now? 4/2017. Now what will be taken as the date of payment? So usually date of payment from the supplier point of view is date of entry in their books or date of credit in their bank account, whichever is earlier will be taken. Whereas from recipient point of view, if you see opposite, what is that? Date of entry in the books or date of debit in their bank account, whichever is earlier. Then in case of goods covered under FCM, on advances GST not payable generally, correct? Exception is we have seen composition schemes, specified actionable claims, and GST is payable only upon invoice as the time of supply is date of invoice or actual date of invoice, whichever is earlier. But in case of service under FCM, GST is payable on advances. As GST is payable on advances in case of services, if you are receiving any excess amount beyond the invoice, for that excess amount, what will be the time of supply? For example, I raised invoice for 11,200, but you paid 12,000. 800 rupees you paid extra. For that 800 rupees, this month I am receiving 800, but this 800 will be reflected in the next month bill. So invoice is next month, payment is this month. Whichever is earlier means I have to pay GST this month. But it will be administratively inconvenient. For that there is one proviso which says that if the excess amount is up to 1000 rupees, what is the excess amount here? 800, which is up to 1000 rupees. Either we can pay based on invoice itself or as per the normal provisions. As per normal provisions means invoice or payment whichever is earlier, or the date on which invoice is raised. As the case may be, supplier has the option to choose. Say this. Up to 1000 rupees received in excess of the invoice. In case of services covered under FCM, time of supply can be date of invoice or determined as per 13(2), and the supplier has option to choose. Then, in case of supply of services between associated enterprises, who are associated enterprises as per section 92A of Income Tax Act, we have now a list of associated enterprises. Basically, it is 26%. One company or one person holding 26% in the other will become associated enterprises. In case of associated enterprises, import of services. Generally, import of service will come under RCM. So what will be taken as the time of supply? Import of services RCM. RCM services, what is the provision? 13 subsection 3, date on which payment is made to supplier or 61st day from the date of invoice. But in case of associate enterprises, we are removing 61st day from the date of invoice and we are taking the date of entry in the books of the recipient, whichever is earlier. So what is the provision? So the date on which payment is made to supplier or date of entry in the books of recipient, whichever is earlier. Then when the goods are taken outside India for exhibition, is it supply or not a supply? Not a supply. But if the goods are not brought back within 6 months, the deeming fiction under 31 subsection 7 will be applicable, like sale on approval or on return basis. As the goods are taken for exhibition, not brought back within 6 months, on expiry of 6 months, it is deemed to be supply and invoice needs to be raised. That is this. When goods are taken outside India for exhibition, it is not a supply. But when the same is not brought back within 6 months, it is deemed to be supply in terms of 31 subsection 7. Then the last section that we have is section 14. So section 14 talks about time of supply in case of change in rate of tax. So in case of change in rate of tax, when the section 14 will be applicable? Mainly section 14 is applicable in case of services. Okay. So applicable only in case of services, and it is also applicable in case of person opting for composition scheme and specified actionable claims. Okay. So first you should know to whom this section 14 is applicable. This section 14 is applicable only in case of services. Also applicable in case of composition scheme and specified actionable claims. But practically it is irrelevant. Why? Because in case of composition scheme, the rates will be always same, 1%, 5%, etc. And in case of specified actionable claims also, the rate will be always same. What is that rate? 28%. So this change in rate concept will not be coming. So practically the section 14 is applicable only in case of services. Now when 14 will be applicable? Services. What is the situation where 14 is applicable? Between 3 dates there is a change in rate. What are those 3 dates? Date of completion, date of invoice or date of payment. Between these 3 dates there is a change in rate, then 14 will come. And in that we have 2 scenarios. What is that? 14A, supply before change in rate, means the completion is before change in rate. And then what should be taken as the time of supply? Very simple, invoice or payment, whichever is earlier. Say this. Suppose if the completion is before change in rate, then invoice date or payment date, whichever is earlier. Suppose if the supply is after change in rate, then what you need to do? Then check whether both invoice and payment is before change in rate or one before, one after. If both invoice and payment before change in rate, whichever is earlier. If one is before, one is after, then it will be taken as whichever is later. Invoice date or payment date, whichever is later. Now, what will be taken as the date of payment? Generally, what is the meaning of date of payment? Date of entry in the books or date of credit in the bank account, whichever is earlier. However, in case of section 14, if the payment is credited in the bank account within 4 working days from the change in rate, then only it will be entry date or credit date, whichever is earlier. Okay, if the payment is not credited within 4 working days from the change in rate, then the date on which payment is credited only will be taken as the date of payment. So date of payment for section 14 is date of entry in the books or date of credit in bank account, whichever is earlier. When if the payment is credited within 4 working days from change in rate, or date of credit in the bank account if the payment is credited after 4 working days from the change in rate. Now let's see how this section 14 will have an impact. So there is a change in rate. There is a change in rate with effect from 1/5/2023. There is a change in rate with effect from 1/5/2023. Now date of completion, then date of invoice and date of credit date of credit, date of entry. Date of credit where? In bank account. Date of credit in bank account, date of entry in books. Now, based on this, you need to determine what is the date of payment, and you need to determine what is the time of supply and what is the rate of GST, whether old rate or new rate is applicable. Okay. Now, let's see this. Date of completion is 15/4/2023 and date of invoice is 30/4/2023 and date of credit in the bank account is 2/5/2023, but the date of entry is 28/4/2023. Okay. Now, what should be taken as the date of payment? So, as the payment is credited within 4 working days, we will assume that all days are working days from 1st May, because 1st May we don't have any holidays and all. So, all days are working days. So, 2/5 is within 4 working days, correct or not? As the payment is credited within 4 working days, so due to that reason, we will take date of credit in the bank account or date of entry in the books, whichever is earlier, which is earlier 28/4/2023. Now, in this case, if you see, completion is before change in rate, invoice also before change in rate, payment also before change in rate, correct? Normal provision. What is that normal provision? Invoice or payment, whichever is earlier. Which is earlier? Which is earlier? So, 28/4/2023, that is invoice date or payment date, whichever is earlier will be taken. And what is the rate that will be applicable? Old rate will be applicable. So, like that we need to determine. Now, see, 15/4/2023, invoice is 5/5/2023 and date of credit in the bank account is, so 3/5/2023 and the payment date of entry in the books is 28/4/2023. Now, what will be taken as the date of payment? Same, 28/4/2023, as the payment is credited within 4 working days. So, therefore, we need to take 28/4 and 28/4 or 5/5, whichever is earlier, even though invoice is given at the new rate, but old rate only will be applicable. 28/4/2023, old rate will be applicable. Next, another example. Say, if the completion is 15/4/2023, date of invoice is 5/5/2023 and the credit is happening on 10/5/2023, but the entry is 28/4/2023. Whether the payment is credited within 4 working days? No, not within 4 working days. When it is not within 4 working days, what will be taken as the date of payment? Date of entry in the books only will be taken, or date of credit in the bank account will be taken? Date of credit in the bank account will be taken. Now, what will be taken as the time of supply? Date of invoice or date of payment, whichever is earlier. So, 5/5/2023, what is the rate that will be applicable? New rate will be applicable. Okay. Then next, suppose if the completion is 8/5/2023 and the invoice is 28/4/2023, payment is credited on 3/5/2023 and 29/4/2023. So, what will be taken as the date of payment? Is the payment credited within 4 working days? Yes, the payment is credited within 4 working days, and as the supply is after change in rate, supply is after change in rate, carefully see the provision, supply is after change in rate, and one before, one after, or both before? Both before, both invoice and payment before change in rate. So, we need to take date of payment is 29/4/2023, no change, but we need to take whichever is earlier or whichever is later, whichever is earlier. Why whichever is earlier? Because both is before change in rate. Whichever is earlier, that is 28/4/2023, old rate will be applicable. Now suppose 8/5/2023, so 28/4/2023, the payment is credited on 10/5/2023, but the account entry is 29/4/2023. It is not within 4 working days. Now what will be taken as the date of payment? Date of payment will be 29 or 10? 10. So 10/5/2023 will be taken, and date of invoice is before change in rate, payment is after change in rate. So one before, one after, means we need to take whichever is later. Why? Because this is supply after change in rate. So whichever is later. Which is later? 10/5/2023. So what will be the rate that is applicable? New rate will be applicable. Like that, any combination they can give in question. You be careful on the provision. What is the provision you need to remember? Completion before change in rate, invoice date or payment date, whichever is earlier. Completion after change in rate, both invoice and payment before change in rate, whichever is earlier. One before, one after, whichever is later. What is the meaning of date of payment? Payment credited within 4 working days from the change in rate. So credit date or account entry date, whichever is earlier. Payment not credited within 4 working days, date of credit in the bank account only will be taken as the date of payment. So that is about 14. Then with this we completed. Now we are starting the revision related to customs and FTP, and customs and FTP, there are no much amendments compared to November 23 to May 24 exam. So it will be the same, and mostly May 24, November 24 also the same portion might be applicable. And here already November 23, so I have done the rocket revision on customs portion. If you want to watch that, you can watch that, or even this also you can see. And page number 181, you can have a look into segment 23, taxable event under customs. So first we need to understand in customs, the Customs Act is 1962 and the Customs Tariff Act is there, that is 1975. Customs Act contains the procedures and the provisions relating to import and export, what is the value, etc. But the rate at which the customs duty is payable is contained in Customs Tariff Act 1975. First we have levy, that is section 12 of Customs Act 1962, which says that 4 conditions should be satisfied for the purpose of levy of customs duty. Number 1, there must be goods, and that goods must be dutiable goods. So what is the meaning of dutiable goods? Dutiable goods means the goods should be specified in the Customs Tariff Act 1975, then it will be called as dutiable goods. The first condition is that there should be goods, and that goods must be dutiable goods, and that dutiable goods must be imported or exported, and where it should be imported into India or exported from India. So if these 4 conditions are satisfied, then there is levy of customs duty. And even government is also covered under levy. So even government, if imports anything, so they are also required to pay customs duty. So government goods treated on par with non-government goods for the purpose of levy of customs duty. And in this regard, we need to know certain definitions. First, we need to know what is the meaning of goods. So goods, all the definitions are given in section 2 only here, so you don't have to remember the clause, but just remember section 2. Goods includes vessel, vehicle and aircraft. The vessel, vehicle and aircraft which is bringing the goods is also goods, and even vessel separately or vehicle separately or aircraft separately when we are importing for use it in the domestic transportation here, so that will also be treated as goods. And stores refers to, so goods which are used for consumption during the journey is known as stores, and baggage refers to passengers luggage. Currency and negotiable instruments is also treated as goods under customs, and any other kind of movable property. It is important to note that currency and negotiable instruments are treated as goods under customs. So an import of this currency, so we need to pay customs duty, whereas we don't have to pay IGST. So because goods do not include currency as per GST definition, so whenever there is import of currency, customs duty is only payable, but IGST on customs duty will not be applicable. As we all know that on import we will be paying basic customs duty, social welfare surcharge and additional customs duties, and so we also have this IGST. So that IGST alone not applicable in case of currency, but in case of all other imports IGST applicable. Also remember this point, whenever we are exporting we are required to pay only basic customs duty, other additional customs duties will not be applicable. Then stores already we have seen, goods include stores. Stores refers to the goods which are present in the conveyance, that is aircraft, vessel or vehicle which is coming from outside India to India, like fuel which is left and the spare parts and the consumables, water, etc. So that will be called as stores. Goods for use in the vessel or aircraft and includes fuel, spare parts or any other articles of equipment, whether or not for immediate fitting, that is called as stores. Then import, what is the meaning of import? So import means bringing goods from outside India to India is known as import. So import with its grammatical variation and cognate expressions means bringing into India from a place outside India is known as import, and export means taking goods from India to a place outside India is known as export. And what is the meaning of India? India extends up to 12 nautical miles from the baseline. So from the baseline, if you see, up to 12 nautical miles is known as India. And for the purpose of customs, India is up to 12 nautical miles, but for the purpose of GST, India is up to 200 nautical miles from the baseline. So here territorial waters is only called as India up to 12 nautical miles from baseline, and all the provisions of Customs Act will be applicable. And there is something called as exclusive economic zone. Exclusive economic zone is up to 200 nautical miles from the baseline, and this exclusive economic zone is known as Indian Customs waters. And basically in these Indian Customs waters, few sections empowering the customs officer to arrest or search a vessel are applicable. And high seas refers to international waters, that is beyond 200 nautical miles from baseline is known as high seas, where the Customs Act is not applicable in that place. So when the goods are said to be imported, as and when goods are entering into the territorial waters, the goods are said to be imported. And the same way, when the goods are said to be exported, as and when the goods cross the territorial waters and leave to a place outside India, when it crosses the territorial waters, then it is called as export from India. Then customs area. Customs area means the area which is under the control of the customs department. So not all ports, airports or places will be under the control of customs. So in the port also, not every port is a customs port. There will be some ports and airports which will be regarded as customs port or airport, where it is permitted to import or export goods from that places. And in that port or airport also there will be a notified area. That notified area only will be under the control of the customs department, and that area is known as customs area. Customs area means the area under customs station includes any area in which import goods or export goods are ordinarily kept before clearance by the customs authorities. Then next we have dutiable goods. What is the meaning of dutiable goods? Any goods which are chargeable to duty and on which duty has not been paid, not yet paid. Not been paid means not that you are not required to pay the duty, you are required to pay the duty but not yet paid the duty, that is known as dutiable goods. Once you pay the duty, then it will be called as duty paid goods. Simple. Then Indian Customs waters, already I told you, which is extending up to 200 nautical miles from the baseline, is known as Indian Customs waters. Export goods means goods which are taken out of India to a place outside India. Who will be called as exporter? Exporter refers to owner or beneficial owner, any person holding himself to be an exporter. Suppose if I am the owner of the goods and I am only manufacturing, I am only exporting the goods, I will be called as exporter. Suppose if I am the owner of the goods but you are exporting the goods, then I will be called as beneficial owner, and you are the merchant exporter who is holding yourself as the exporter. So I will also be called as exporter, you will also be called as exporter. So owner, beneficial owner, or any other person holding to be exporter. Beneficial owner means on whose behalf the goods are exported or imported. Even importer definition also we have this. If you see exporter definition and importer definition, both places it is the same wording. Owner, beneficial owner, any other person holding himself to be exporter. Here also same, owner, beneficial owner, any person holding himself to be an importer. Okay. Then who is a beneficial owner? On whose behalf the goods are being imported or exported, or who exercises the effective control over the goods. So that person is called as a beneficial owner. That is, say for example, I am the brand name owner or I am the owner of the goods and you are exporting on behalf of me, then I will be called as a beneficial owner. Then imported goods means already goods brought from outside India to India. And baggage, baggage refers to passenger's luggage. It can be accompanied or unaccompanied. Accompanied means which is coming along with the passenger is known as accompanied. So if it is coming either before passenger's arrival or after passenger's arrival, then it is called as unaccompanied baggage. But baggage does not include motor vehicle, because practically motor vehicle, whenever we are bringing, it will come as a cargo consignment, so like a commercial goods only. Then coastal goods refers to goods which are taken from one port in India to another port in India, will be called as coastal goods. These are neither imported goods nor exported goods. Goods other than imported goods transported in a vessel from one port in India to another port in India. So like basically it is a domestic transportation. Then foreign going vessel or aircraft. So basically any vessel or aircraft which is taking goods or people from India to outside India is known as a foreign going vessel or aircraft. So it attains some importance because in case of stores we will learn this provision. So whenever a person is selling goods to a foreign going vessel or aircraft, it will be be treated as deemed export as per customs. So therefore it is treated as export for the purpose of customs, but it is not treated as export for the purpose of GST, but it is treated as export for the purpose of customs. So due to that reason, so all export benefits are available in case of sale to a foreign going vessel or aircraft. So what is a foreign going vessel or aircraft? Any vessel or aircraft which is going from India to a place outside India carrying people or goods is known as a foreign going vessel or aircraft. But it also includes a navy vessel of foreign government taking part in any navy exercises in India, or any vessel engaged in fishing or other operations beyond territorial waters, because beyond territorial waters means outside India, and any vessel or aircraft proceeding to a place outside India for any purpose. So that is basically Indian navy vessels or Indian aircrafts. So military aircraft, so which are going to outside India, will also be called as a foreign going vessel or aircraft. Then, so whenever goods are being imported, so what are the options available to the importer? There are two options available to the importer. As soon as the goods are unloaded in the customs area, that goods may be taken to the importer's place by filing one bill of entry called as bill of entry for home consumption. Option 1, clearance for home consumption upon payment of customs duty and by filing bill of entry for home consumption. And option 2 is known as deposit in the warehouse. So that is, if the importer is unable to pay the customs duty at the time of import, he can defer the customs duty payable by depositing the goods in a warehouse called as customs warehouse. Customs warehouse is properly not owned by the customs, but it is licensed by the customs department, so they need to adhere to whatever regulations that are specified by the customs department. So whenever the goods are deposited in the customs warehouse, we need to present one bill of entry. That is, the importer has to present one bill of entry called as inbound bill of entry or bill of entry for warehousing, and the goods will be deposited, and we need to execute a bond because we are not going to pay the duty. So we need to execute a bond, and as and when we want to clear the goods from the warehouse, we need to pay the duty and the bond gets released. So it is called as ex-bond bill of entry. Deposit in warehouse without payment of duty by filing inbound bill of entry, and clearance from warehouse upon payment of custom duty by filing ex-bond bill of entry. And basically without filing any bill of entry, that is either bill of entry for home consumption or bill of entry for warehousing, goods cannot be cleared from the customs place. The unloaded goods cannot be cleared for home consumption or warehousing. Goods can be cleared to warehouse without payment of duty, but thereafter for clearance of goods from the warehouse, we need to pay the duty. And when the bill of entry should be paid, submitted, the bill of entry should be filed before the date of arrival. If today is the arrival of the vessel or aircraft or vehicle, we need to file it before the date of arrival. And suppose if you file it even on the date of arrival also, there is a 1 day delay. So for every day delay, there is a late fee that will be payable. Bill of entry can be filed before or after arrival, but the time limit is before the date of arrival. If filed on the date of arrival or later date, then a late fee will be payable. And then as clearance from the warehouse is the taxable event. So what is a taxable event? That is when there will be levy of customs duty attracted at which point of time. So as and when you clear the goods from the customs area for home consumption, or as and when you clear the goods from the warehouse for home consumption, at that point of time, that is either at the time when you file the bill of entry for home consumption or you file the ex-bond bill of entry, at the time only the taxable event gets attracted. Suppose at the time of import, if the goods are chargeable to customs duty, but at the time of clearance from the warehouse, if there is an exemption, are we required to pay customs duty or not? No, we are not required to pay customs duty. Same is the case at the time of import, the goods were exempted from payment of customs duty and we deposited the goods in the warehouse, and thereafter at the time of clearance from the warehouse, the goods became dutiable. Are we required to pay customs duty? Yes, we are required to pay customs duty in that case. Customs warehouse, already I told you, basically customs warehouse is a warehouse which is not owned by the customs department, but basically it is licensed by the customs department to act as a customs warehouse. And then if any importer has a warehouse for which license is obtained, so what is the advantage? So importer for his own warehouse can also obtain a license. So in that case, what will happen? There will be a deferment of customs duty that is payable. Then he can defer the customs duty payable till the time he uses such goods, as clearance from warehouse is only the taxable event in this case. And then what are the various documents involved? So basically in case of import, what are the documents to be filed by the person in charge? Person in charge is like in case of vessel, the master of the vessel; in case of aircraft, the pilot; and in case of vehicle, so any driver or conductor will be taken as a person in charge. In case of import, the person in charge is required to file import manifest in case of vessel, and arrival manifest in case of aircraft, and import report in case of vehicle. Whereas in case of export, that opposite documents, that is here import manifest, so here it is export manifest; here arrival manifest, so departure manifest. manifest. Here import report, so export report. So these are the documents to be filed by the person in charge. Basically, what does this document contain? This document contains the details of the goods which is present in the ship or aircraft or vehicle. And what is the document to be filed by the importer in case of import? In case of vessel or aircraft or vehicle, the document name is called as bill of entry only. Whereas in case of export, the exporter is required to file shipping bill in case of vessel and aircraft and bill of export in case of vehicle. And who is person in charge? Already I told you, master of the vessel and pilot of aircraft and conductor or guard or any other person for the vehicle. Only after filing import manifest, grant of entry inwards is given for the vessel to enter into India. But for aircraft and vehicle, there is no requirement of grant of entry inwards. Grant of entry inwards means giving a permission to enter into India, but for vessel only it will be applicable. So whenever the import manifest is filed by the person in charge, so thereafter grant of entry inwards will be given for that vessel to enter into India. And vehicle, so basically the concept of grant of entry inwards is not applicable in case of aircraft and vehicle, but arrival manifest or import report should be filed before the arrival. And along with the bill of entry, importer should also prove that he is the owner of the goods. So for that he need to file some documents. What are those documents? So that is document of title to the goods. In case of aircraft, so that is import of goods by airways, airway bill is the document of title. In case of waterways, it is bill of lading, and in case of railways, so it is railway receipt or lorry receipt. So that will be taken to claim the ownership of the goods. And also an invoice is raised to him now by the exporter outside India. Even that document also should be submitted. So basically 3 documents are required to be submitted by the importer. So number 1, bill of entry. Number 2, document to prove that he is the owner of the goods, that is document of title to the goods. And number 3, invoice, so to tell what is the value of the goods that is being imported. Then taxable event and relevant date for determination of rate of duty in case of import. So import, there are 2 options, clearance for home consumption and clearance for warehousing. So what is taken as a taxable event? It is not the date when goods enter the territorial waters, but when the goods cross the customs barrier, that is called as taxable event under customs. So when it crosses the customs barrier, so as and when you file the bill of entry for home consumption, or as and when you file the export bill of entry, it crosses the customs barrier. Customs barrier means customs control. So that is called as a taxable event. That's what we have seen. So at that time, whatever is the levy, that will be applicable. So date of crossing customs barrier, it is held by Supreme Court in Garden Silk Mills case and Kiran Spinning Mills case. So Kiran Spinning Mills case and Garden Silk Mills case, Supreme Court, date of crossing customs barrier is the taxable event. Whereas in case of export, if you see, when the goods are crossing the territorial waters, then only it will be called as export. So again, Supreme Court is specifying this clearly in 2 cases, that is Rajendra Dyeing and Printing Mills case and Sun Exports case. So these 2 cases, what is the conclusion we can draw? The goods, when it crosses the territorial waters, then only it is said to be export. Then section 15 and section 16. So the levy related to customs duty is given under section 12. Section 15 talks about the point of payment for the purpose of, that is relevant date for determination of rate of duty in case of import is section 15. Relevant date for determination of rate of duty in case of export is given in section 16. So as per section 15, what does it say? If you are importing the goods by vessel, so then you need to check option 1 or option 2. Option 1. So option 1, it is the date on which importer presents a bill of entry, that is imported for home consumption. Importer presents a bill of entry for home consumption, or grant of entry inwards, whichever is later, not whichever is earlier, whichever is later. In case of aircraft and vehicle, there is no concept of grant of entry inwards, so we need to take arrival. So date of presentation of bill of entry or date of arrival, whichever is later, will be taken. This is which case if it is imported for home consumption. If it is imports for warehousing, it is the time when you file the ex-bond bill of entry, all cases. So whenever the ex-bond bill of entry is presented for clearance from the warehouse, that date will be taken as relevant date for determining rate of duty. But for exchange rate, always it is the bill of entry date. So in case of option 1, there is only one bill of entry, that is bill of entry for home consumption, that is for exchange rate. Whereas in case of option 2, there are 2 bill of entries, one for depositing the goods in the warehouse, another for taking the goods from the warehouse. So which date of bill of entry is relevant? So inbound bill of entry, at the time of depositing the goods in the warehouse, whatever is the exchange rate, that only will be taken. So date of presentation of inbound bill of entry, that is bill of entry for warehousing. Whereas in case of, this is about section 15, relevant date for determination of rate of duty and relevant date for determination of exchange rate. Whereas in case of export, section 16 says that the relevant date for determination of rate of duty is the date on which let export order is passed. As soon as the goods are submitted to the customs officer along with the shipping bill, so the customs officer will pass a let export order. On the date of let export order, whatever is the rate of duty that is applicable, that will be taken. And then in case of exchange rate, the exchange rate also based on the shipping bill or bill of export which is filed by the exporter. So that date will be relevant for determining the exchange rate, shipping bill or bill of export. And here it so happens that we have filed a bill of entry, and date of presentation of bill of entry or date of arrival, whichever is later, will be taken as relevant date for determination of rate of duty. So and bill of entry has to be filed before the date of arrival. So we filed the bill of entry. At that time it was 10%, and actually arrival is at a later point of time. At that time it is 12%. So which is the relevant rate? 12% is a relevant rate. But already we filed a bill of entry with 10%. So what we need to do? We need to amend the bill of entry. By amending the bill of entry, the 2% extra amount we need to pay, because whichever is later. So we presented a prior bill of entry, and the prior bill of entry only should be presented. So we don't have the concept of later bill of entry. So prior bill of entry is presented. Arrival is at a later point of time. So whichever is later, so the new rate will be applicable. But already we filed a bill of entry with the old rate. So we need to amend the bill of entry by adding the 2%. So that is one exercise to be done, and for amending the bill of entry we don't have to pay any charges. So here exchange rate determined by whom should be taken? Exchange rate as determined by CBIC should be considered. And in case of improper import or improper export, what is that improper import or export? So without submitting any documents, without bill of entry or shipping bill, if the goods are imported or exported, that is known as improper import or improper export. So in that case, the relevant date is the date of payment of customs duty. So whenever you pay the customs duty, whenever the goods are being brought into India, when they catch the smuggled goods, so at that time you pay some duty. At that time, whatever is the rate relevant, that should be taken. Relevant date is the date of payment of duty. So this is about section 12, section 15 and section 16. Then we are moving on to segment 24, which talks about exemptions from customs duty. Firstly, section 25, which says that so government is having power to grant the exemption. So as per section 25, central government by notification in the official gazette exempt goods from payment of customs duty either unconditionally or subject to certain conditions. And these exemptions, we don't have the specific exemptions like this product is exempted or not from import or export, like that we don't have, but they have given broadly certain exemptions. In that, the first area that we have is with respect to section 13, 23 subsection 1 and 2 and then 22. So what is this all about? So section 13 talks about no duty on pilferage. So whenever the goods are imported and that goods are pilfered, pilfered refers to petty theft. In that case, we don't have to pay the customs duty. Then section 23 subsection 1 is applicable when the goods are destroyed. So because of any accident on account of natural causes, etc. So then in that case, so when the goods are destroyed or abandoned, so we will be getting remission of duty. Remission of duty means first we need to pay the duty and we need to prove to the satisfaction of the officer that the goods are destroyed. So then thereafter they will be giving us the refund. That is with respect to 23 subsection 1 when the goods are destroyed. But when the goods are not according to the specifications, in that case you don't need the goods, so you don't have to pay the duty. So then it will be called as relinquishment of title to the goods. So you will be giving away the title to the department, so therefore you don't have to pay the customs duty. That is known as relinquishment of title to the goods. And then section 22 is applicable in the situation when the goods are damaged, not destroyed, but the goods are damaged, which means that there is a reduction in the value of the goods. So on account of the damage, then proportionately to the value of the damaged goods, you need to pay the customs duty. So for example, 100% goods means whatever is the customs duty payable. After damage, the goods capacity or value will not be 100%, it will be reduced. So proportionately you will pay the customs duty, that is known as abatement. So basically, when which section will be applicable? When 13 is applicable, when the goods are pilfered. And when section 23 subsection 1 is applicable, goods are lost, destroyed or abandoned. When 23 subsection 2 is applicable, goods are not conforming to the specifications. And when section 22 is applicable, damage or deterioration to the goods. Deterioration is reduction in value on account of efflux of time. So whenever the goods are like evaporation, or whenever there is a reduction in the quality of the goods, so that is called as deterioration to the goods. So therefore, when the goods are pilfered, section 13, and what is the title? No duty on pilfered goods. What is the advantage? Because of this, you don't have to pay duty. Then section 23 subsection 1, when the goods are lost, destroyed or abandoned, so you will have remission of duty. What is the benefit? First you need to pay the duty, prove that the goods are destroyed, then you will get the refund. So then in case when the goods are not conforming to the specifications, relinquishment of title to the goods means you don't have to pay the duty at all. So you give away the title to the department. So whenever there is damage or deterioration of the goods, section 22 abatement. So what does the abatement say? Abatement is like, so you will pay the duty proportionately based on the value of the damaged goods. So that is the benefit. So in case of section 13, customs duty not payable by the importer but payable by the custodian. The imported goods will be under the control of a person called as custodian or port trust authorities. So that particular custodian will pay the customs duty because he is responsible for that goods. So importer is not required to pay. What if the goods are restored? So custodian identifies the person who has stolen that goods and the goods are restored. In that case, so the customs duty will be payable by the importer, and thereafter the remission of duty will be given to the custodian. Then whether applicable in case of warehoused goods? No. So then when the pilferage should have happened? Pilferage should have happened so after unloading the goods. After unloading the goods, that is at the time or after unloading the goods, if the and thereafter, so before the order for clearance. Okay, so see the stage at which the pilferage should have happened. So the goods are in the transit. So after the goods are unloaded in the port or airport and before order for clearance, what clearance? Either before clearance for home consumption or before clearance for warehousing. At this stage, if the goods are pilfered, then only section 13 benefit will be applicable. So that's why in case of warehoused goods, section 13 benefit will not be applicable. Whereas if you see section 23 subsection 1, remission of duty, what is the benefit? First you need to pay the customs duty and prove to the officer that the goods are destroyed, and then you will get the refund with respect to that. Whether applicable in case of warehoused goods? Yes. So which means you can claim the remission of duty even after the order for clearance and before actual clearance. If you see here, first the goods are unloaded in the port or airport, thereafter order for clearance, and thereafter clearance for home consumption, or it may be cleared for warehouse and thereafter it may be cleared from the warehouse for home consumption. Now at this stage, before actual clearance, if the goods are lost or destroyed, we will get remission of duty. Means whether the remission of duty is applicable even before order for clearance? Yes. So the remission is applicable before order for clearance. So if you see section 23 subsection 1 and section 22 is applicable at this stage also. Is applicable at this stage. Also. Okay, so at this particular stage also we will get, so anytime before actual clearance, after unloading and before actual clearance, that is about remission of duty. Then if you see 23 subsection 2, relinquishment of title, what is the benefit? We don't have to pay the customs duty in this case. And relinquishment, remember, not possible with respect to prohibited goods. Any prohibited goods or illegal goods that you have imported and thereafter they have identified that goods, now you cannot say I will relinquish the title, not possible. So therefore prohibited goods you cannot relinquish the title, you have to pay the duty and you need to face the consequences with respect to that goods. Whether applicable in case of warehoused goods? No. So it is not applicable in case of warehoused goods because relinquishment should have done before order for clearance. So after unloading the goods and before order for clearance, if the owner does not want to take delivery of the goods, relinquishment of title to be done under section 23 subsection 2. Okay, so that is this case. But suppose if the goods are deposited in the warehouse, at that time if you feel like the goods are not according to the specifications, that is you file a bill of entry and you have taken the goods to the warehouse, and warehouse you have observed that the goods are not according to specifications. In that case, the section 23 subsection 2 is not there, but in warehousing provisions one proviso is there, that is proviso to section 68. So as per that proviso to section 68, relinquishment of title is possible. That's what I have given, but relinquishment is possible under proviso to section 68. In case of warehouse goods, that's a different provision. Then so that is with respect to relinquishment of title. Then 22, abatement. So in case of abatement, what is the benefit? Customs duty payable at the discount in proportion to the value of the damaged goods. So based on the value of damaged goods, we need to pay the customs duty. So if you see the value of the goods imported, so value of goods imported is say somewhere 8 lakhs. 8 lakhs is the value of the goods imported, and customs duty payable on above. Customs duty payable on above is somewhere like 3,25,000 is the customs duty payable on above. Now what happened to the value of the goods imported after damage? So value of goods after damage. Value of goods after damage. Value of goods after damage came down to 5 lakhs. If value of goods after damage is 5 lakhs, how much is the customs duty payable on above? So that is how the abatement is computed. So the proportionate customs duty will be payable. How to calculate that? Simple. So first for 8 lakhs it is 3,25,000. For 5 lakhs it will be how much? So what we need to do? We need to take 5 lakhs, okay, into 3,25,000 divided by 8 lakhs. Okay, for 8 lakhs it is 3,25,000. So 5 lakhs, how much is the proportionate amount? So that will come to, so 5 lakhs into 3,25,000 divided by 8 lakhs. So that comes to 2,03,125 is the customs duty payable on above. So therefore, what is the abatement that we have got? See, this is not abatement, this is the customs duty payable based on the damaged value of the goods. So what is the abatement? 3,25,000 minus 2,03,125 will be taken as the abatement. Okay, so that difference will come to 1,21,875 is taken as abatement. So this is how proportionately the abatement will be computed. So we need to take customs duty equals to value after damage into original customs duty divided by value before damage. So that's how we need to compute. Whether it is applicable in case of warehoused goods, yes, in case of damage, but not in case of deterioration. When the deterioration should have happened? Before or at the time of unloading, the deterioration should have happened. So deterioration only before or at the time of unloading of the goods. So in case of warehouse goods, if it is deteriorated, we will not get any benefit. So that is with respect to this section. So remember, before the goods are unloaded in the port or airport, if the goods are lost in transit, first of all, there is no levy, so we don't have to pay any customs duties. That is based on the Supreme Court case. And after the goods are unloaded and before order for clearance, all the 4 sections are applicable: 13, 23 subsection 1, 23 subsection 2 and section 22. Whereas after order for clearance and before actual clearance, only 2 sections are applicable. That will be remission of duty section 23 subsection 1 and abatement, that is warehoused goods, only 2 points. And remission of duty and abatement, apart from that, relinquishment of title is there, but that's in a different section. So that is proviso to section 68. Then we have section 21, which talks about derelict, jetsam and flotsam, which refers to whenever the goods are thrown into the sea, that is called as jetsam. And those goods which are thrown into the sea will continue to float, that will be called as flotsam. And derelict refers to the damaged parts of the ship, and that is whenever the ship got derailed, so there will be some damaged parts of the ship, that is called as wreck. So all goods derelict. So goods derail, like ship derailed and the goods are falling into the water. Then jetsam, goods thrown into the water to save the ship from sinking. Flotsam, those goods which are thrown into the water will continue to float. And wreck refers to damaged parts of the ship. If these goods are brought into the shore, okay, so brought into or coming into India, shall be dealt as if these goods are imported by the person into India, unless the goods are exempted goods, as if they were imported into India, unless proved to the satisfaction of the officer that they are entitled to be admitted duty free. That is about section 21. Then section 20 talks about re-importation of goods. So in this regard, there are 2 notifications: notification 45/2017 and notification 60/2018. What does notification 45/2017 says? First, a person is importing the goods. Whenever he imports the goods, he will pay the customs duty on those goods. So those goods are exported. So whenever the goods are exported, thereafter it is subsequently re-imported. So the first is import, then export, and thereafter re-import. Import, export, re-import. Import, export, re-import. Okay, first there is a import, and thereafter there is a export, and thereafter there is a re-import. In case of import, custom duty is payable. In case of export, what is that person doing? Is he claiming any incentive at the time of export? Yes, he is claiming incentive at the time of export. So at the time of re-import, so he should pay only that incentive what he claimed at the time of export. That is sufficient. He don't have to pay any customs duty on this re-importation. Same way, at the time of export, if the goods are exported for repairs and thereafter it is re-imported, at the time of re-import, that person is required to pay a customs duty on fair value of the repairs carried outside India, plus freight and insurance both ways. So from India to outside India to India, that should be taken as a value for payment of customs duty. If export for repairs, upon re-import, the customs duty will be payable. How much is the customs duty payable? Fair value of repairs. So why they use the word fair value of the repairs? If the goods are sent outside India for repairs, it may be covered under warranty. When it is covered under warranty, so we don't have to pay any amount towards that. But even then, we need to take what could be the value. If it is not covered under warranty, that should be taken, plus freight and insurance both ways should be added. That should be taken as a value for payment of customs duty. Suppose at the time of export, so import and at the time of export, suppose if it is happening that we are neither claiming any incentive nor it is exported for repairs, but normally it got exported and it is re-imported, are we required to pay any customs duty on re-import? No, we don't have to pay any customs duty on re-import. So that is based on this notification 45/2017. But they gave one condition. What is that condition? From the export to re-import, what is the time limit within which the goods should be re-imported? 3 years, and it can be extended for a further period of 2 years. So that is this, and we have some notes in this regard. Even IGST will be payable on the same value, not only the customs duty but also IGST is also payable on fair value of repairs plus freight and insurance both ways. Suppose if export is subject to export duty, at the time of export if we are paying export duty, upon re-import whatever customs duty we paid at the time of export, we will be getting it as a refund. So that is refund under section 26. So that is this point. If export is subject to export duty, then upon re-importation we will get the refund of customs duty paid at the time of export as per section 26. If the goods are exported under duty exemption or any duty remission schemes, etc., then in that case the time limit for re-importation is 1 year, plus it will be extended for a further period of 1 year. And if the goods are exported or not subject to any incentive, so at the time of export we did not claim any incentive or exemption and not exported for repairs, then upon re-import the customs duty is not at all payable in that case. And the fifth point is that exported goods and imported goods must be same and the ownership should not have been changed. So the ownership should remain the same. And concession under this notification is not applicable to 100% TOU. Why? Because anyhow imports by 100% TOU, we don't have to pay customs duty. Also unit in free trade zone, also we don't have to pay customs duty on import. And public or private warehouse, we don't have to pay customs duty when we keep the goods in the public or private warehouse. And tobacco and petroleum products, so these are some notified goods on which, so the concession under this notification is not applicable. And then in case the goods are taken outside India for exhibition purposes, so this point we have seen in GST that upon bringing it back within 6 months from the rate of export, on re-import customs duty not payable. Why? Because at the time when it is taken outside India for exhibition, we have not claimed any incentive, nor it is exported for repairs. At the time when it is imported back, we don't have to pay customs duty with respect to these goods. So that is in case of notification 45/2017. Then we have notification 60/2018. What does it say? So here the first is export. So first we are making export and those goods are imported and then it will be re-exported. So then in that case, what are the concessions that are available? So at the time of export, from export to import, it should be within a prescribed time limit. What is the time limit? In case the goods are exported for reprocessing, or that is whenever the goods are exported, why is it coming back? So is it because of remaking, refining or reprocessing, because of the manufacturing defects? Then it should come back to India within 1 year. Suppose if it is for repairing or reconditioning, it should be coming back to India within a period of 3 years. In case of notified goods, it will be 7 years. So there are some notified goods, we don't have to remember what are those notified goods. In case of that notified goods, it will be 7 years. In case of other than notified goods, it will be 3 years, and 10 years in case of Nepal and Bhutan. This is the time limit within which the exported goods should be imported. So for what purpose? Either repairs or reconditioning. And from the time it is imported, it should be re-exported. After doing that repairs, reprocessing or refining, reconditioning, etc., it should be re-exported. What is the time limit for that? 6 months. Plus it can be extended for a further period of 6 months. And here some conditions are there. So what is the benefit? First of all, here at the time of export to import, and they can again re-export, here you are making import now. On this import, customs duty is not payable, and the condition is that import goods and re-export goods should be same, and importer at the time of importation executes a bond. So that is with respect to this. So notification 60/2018, export, then import, and then re-export. Now see this, suppose if there is any loss of imported goods during such operation, that is from the time we exported to the imported, or again from the time we imported to the re-exported, if there is any process loss at this stage. So this process loss is okay, and we don't have any restriction under this notification. That's what it says. If any loss of imported goods is noticed during such operation, that loss shall be exempted from whole of the customs duty, subject to satisfaction of AC/DC, even if the quantity re-imported is short or low, as long as the nature and variety is same. Okay. So then next we have this 21 already we discussed. 24, denaturing or mutilation of goods. If you see here, section 20 which talks about concession with respect to reimportation, 21 derelict jet stamp float stamp, and 22 talks about abatement, 23 relinquishment of title and remission of duty, and 13 is a different section, no duty on pilfered goods, and 24 talks about denaturing and mutilation of goods. In case of denaturing and mutilation of goods, what happens is that, so first of all, when the goods are imported which has high rate of customs duty and low rate of customs duty depending upon the purpose for which it is being imported. So if imported goods having twin purpose, and depending upon the purpose if the rate of duty is applicable, so now when you denature the goods you will make it unfit for the other purpose, so that the applicable customs duty you will be paying. So owner of the goods will make request for denaturing, that is diluting the chemicals, and mutilation, breaking the machinery. Same way, when you import the machinery, say you have to pay high customs duty. When the parts of the machinery is imported, you need to pay low customs duty, but you don't need the machinery, but you need the parts of the machinery. You can break down the machinery into parts, and only the parts can be taken, and the remaining structure etc. will be so scrapped. Then in that case, accordingly the customs duty will be payable. Central government make rules regarding the same. Duty is payable as if the goods are imported in the denatured or mutilated form. That is about section 24. So these are the various exemptions that we have. Then section 25 talks about classification of goods and types of customs duty. So basically in this classification of goods, so it talks about gender interpretative rules. That is, a classification refers to identifying the imported goods or exported goods in the appropriate place in the tariff is known as classification of the goods. So in this regard, we have some general interpretative rules, also known as rules for interpretation of tariff. In that, the rule 1 says that the titles of the sections are only for the reference, so headings etc. So you cannot classify the product based on the headings or subheadings. So you need to check the relevant section notes and the chapter notes, and based on the section notes and chapter notes only the product needs to be classified. And rule 2a says that any reference to complete goods also includes incomplete or unfinished goods. So for example, we are importing a car without tire or a car without seat, so that should be classified along with the car only. So incomplete goods or unfinished goods having the essential character of finished goods will be classifiable under the finished goods. Then next 2b says that any reference to a material includes combination of that material with the other material. For example, if you are importing coffee with chicory will also be classified along with coffee only. So any reference to material includes combination of that material with other material. Then 3a says that when there is a specific heading and when there is a general heading, we need to prefer specific heading over general heading. For example, we are importing electric shaver, and that electric shaver, so we have two headings. One is shavers and hair clippers, which is a specific heading, and another is a general heading, electromechanical domestic appliance. So that's a general heading. Now as it is a specific heading is there, so we need to prefer specific heading over general heading, so it should be classified under shavers and hair clippers. Then 3b says that classification shall be as per essential character if a particular product is mixture or composite of the article. Suppose if we are importing a bag or a box that contains different articles, so then we need to classify it based on the essential character. For example, a geometry box is imported, so that has a metal box, sharpener, eraser, pencil and drawing instruments, but the essential character is drawing instruments, so the entire geometry box should be classified as drawing instruments. Then 3c says that if both the headings are specific, we need to prefer the latter the better. For example, there are two headings, 8702 which talks about motor vehicles for transportation of persons, and 8703 motor vehicles for transportation of the goods. Now you are importing a vehicle which is capable of doing transportation of goods as well as transportation of people, then it should be classified as last in the numerical order. That is, both the headings are specific, so we need to take which comes last in the numerical order, that is 8703. Then rule 4 talks about akin goods. Akin goods refers to similar goods. Similar goods means that, so whenever you are importing some goods but it do not have anywhere presence in the tariff, then what is the similar goods related to that we need to see, and based on similar goods you need to classify. For example, you are importing sun films, sun protector films to be pasted in the car mirrors. So now what happens is that this particular sun films which you have imported for the purpose of putting it in the cars to prevent the sunlight directly entering, so we don't have any separate heading. In that case we will be taking the blinds and curtains so as the heading, and there it should be classified, that is based on similar goods. Rule 5 talks about packing containers. So whenever you are importing the packing containers for packing a particular product, if it is a specific packing material, it will be classifiable along with the product. For example, violin box is imported, so the violin box will be used only for violin, so therefore it should be classified along with the violin. Packing containers and packing materials can be classified along with the main articles which are sold. Then rule 6 says that goods should be compared at the same level only, so heading under one chapter should be compared at the another heading of the same chapter. So goods can be compared at the same level only, that headings are subheadings, but one heading with chapter cannot be compared with another chapter. So that is about rule 6. Then we have computation of customs duties payable. So all the sections that we are having in this particular area, computation of customs duty, we are referring to Customs Tariff Act, that is 1975, but not the Customs Act 1962. So what does this say is that, so these are the various customs duties that we have. Basic customs duty. So in basic customs duty, again we have standard rate and preferential rate. Whenever we are importing goods from the country with which India is having trade agreement, so in that case the preferential rate will be applicable, otherwise the standard rate will be applicable. So it will be given in the question itself. So it is at the applicable rate, and it should be computed on the assessable value, which is computed under section 14. And after that we need to take social welfare surcharge. Social welfare surcharge will be always 10% of basic customs duty, whether it is given in the question or not. We need to compute social welfare surcharge as a 10% on basic customs duty. Then integrated tax and GST compensations, these two will be computed on basic customs duty plus all customs duties including social welfare surcharge plus assessable value. Finally, IGST and GST compensations should be computed, and the rate will be given in the question. So GST rate in the force on assessable value plus all customs duties above, and same way compensation cess also. Only if the compensation cess is given in the question, then we need to take. And in the past, on imports, we used to pay countervailing duty under section 3 subsection 1 in order to counterbalance the excise duty, and special additional duty under section 3 subsection 5 in order to counterbalance the sales tax. Now, so this CVD and SAD, wherever excise duty and sales tax is applicable, that will be taken. However, now on account of GST applicability, so it is limited to only few goods. And then in case of export, as I already told you, only basic customs duty is applicable if the exports are chargeable to duty. So only when the question says about customs duty, we need to compute customs duty on export. Otherwise, we don't have to. That too only basic customs duty. We don't have social welfare surcharge. Social welfare surcharge is applicable only on import. Then in case of warehoused goods sold by way of transfer of warehouse receipt, IGST shall be computed on regular assessable value plus basic customs duty, social welfare surcharge the regular way, or the sale value of such warehouse goods, so whichever is higher. So usually what happens is that whenever we do the computation of customs duty, let's take assessable value. So assessable value equals to 1 lakh. So this will be taken as the assessable value, which is determined under section 14. So we need to do this computation as per 3 steps. So first we need to take step 1. So in this step 1, we will be having 3 customs duties. What are the 3 customs duties that we will be having? So we will be having basic customs duty. So basic customs duty will be computed at the rate which is given in the question. Say for example 10% is given in the question. So it will be computed on what? It will be computed on assessable value. So we need to take 1 lakh. And on that 1 lakh into 10%, that will be 10,000 will be taken as the basic customs duty. And then the second one will be social welfare surcharge. Social welfare surcharge will always at the rate of 10% on basic customs duty. So we need to take basic customs duty. What is the basic customs duty? 10,000 into 10% will be taken. So that will be coming to 1,000. So that will be social welfare surcharge. And then we have something called as CVD, countervailing duty under section 3 subsection 1. This is to counterbalance excise duty. This will be at the rate of PESHN. So it will be specifying, say for example 12.5% it is given. So it should be computed on what? It should be computed on landed value. What is the landed value? Assessable value plus basic customs duty plus social welfare surcharge, it will be computed. Okay, and it will be computed on what? So this countervailing duty is applicable only on 3 products. What are the 3 products on which it will be applicable? It will be applicable on petroleum products. So whenever petroleum products are being imported, so 5 petroleum products we have under GST: crude oil, petrol, diesel, aviation, turbine fuel, natural gas. So then in that case, then next we have alcoholic liquor for human consumption, and then thereafter we have tobacco products. So in case of tobacco and tobacco products, in case of these 3 products only, CVD will be applicable. So only when the question talks about these 3 products and the rate is given, then only we need to take, otherwise the CVD will not be applicable. Now if you add this will be called as customs duty excluding additional customs duties. So customs duties excluding additional customs duty. So that will be coming to 1 lakh. That is 1 lakh is the assessable value. So 11,000 will be taken as customs duties excluding additional customs duties. Then we have step 2. So in step 2, we will be talking about 3 additional customs duties. What are they? Number 4. So we have something called as safeguard duty. So safeguard duty will be applicable under section 8B. So then next we have that is applicable on import of goods in large quantities. That will be at the rate percentage. So that will be at a percentage which will be on assessable value or landed value we need to take. So when the question is silent about assessable value or landed value, usually we will be taking it on assessable value. Okay. So what is landed value? Landed value will will be assessable value plus basic customs duty plus social welfare surcharge. So LV refers to landed value. So what we need to do for landed value, we need to take assessable value plus basic customs duty plus social welfare surcharge will be taken as landed value, and if it is applicable we will be taking, otherwise we will not take this. So then that should be given in the question, otherwise we will not take. Then we have something called as CVD under 9. So alternatively you can remember, because there are two CVDs, you can remember it as anti-subsidy duty. So this anti-subsidy duty is applicable whenever the imported goods attract some subsidy which is given by the exporting country in order to cripple the domestic market in India. So the exporting country will be giving some subsidy. In that case, to counterbalance that subsidy given by the exporting country, the Indian government will be adding some anti-subsidy duty. So this anti-subsidy duty again at a percentage, so which will be computed on assessable value or it will be computed on the landed value. Again, how to determine the landed value? Landed value will be determined based on assessable value plus basic customs duty plus social welfare surcharge. Again, whenever it is given in the question, then only we need to take, otherwise it is not required. Then we have something called as anti-dumping duty. So this anti-dumping duty is applicable. So whenever the exporter is dumping the goods into India, so this is unfair export made by the exporter. He is trying to import, like sell the goods to India at a price less than his selling price in the exporting country. So then anti-dumping duty will be applicable, but anti-dumping duty will be absolute. So it is computed. So based on dumping margin or injury margin, whichever is lower. So dumping margin or injury margin, whichever is lower will be taken. So based on that we need to get the anti-dumping duty. So who is dumping? The exporter is dumping. So the dumping margin we need to see from the exporter perspective. So what is the dumping here? What is the price at which he is selling in his local market, normal selling price in his domestic market, minus what is the price at which he is exporting to India, export price. So that difference will be taken as dumping margin. Whereas injury margin will be, so what is the price at which, so the goods are being imported into India, that is landed value of the imported goods, and we need to compare it with normal selling price in India. So normal selling price in India minus landed value of the imported goods, that is injury margin, to that extent the domestic manufacturer is injured. So whichever is lower, dumping margin or injury margin, whichever is lower will be taken. So that is about the anti-dumping duty. Only when it is given in the question we need to take that. So this will be called as customs duties excluding, so IGST, compensation cess and SAD, special additional duty. So what is that? 11,000 rupees, as we don't have anything else. Now the last step, so this is step 3. So in step 3 we will be having IGST. So number 7, IGST we will be taking. So that IGST is at the rate given in the question. Say for example 18% is the IGST. While computing IGST we need to compute it on assessable value plus step 2. So whatever is the step 2 total. So assessable value plus step 2 total should be taken. For example, assessable value is 1 lakh plus step 2 total will be 11,000. So on that we need to take 18%. So 1 lakh 11,000 into 18%, that will come to 19,980 will be taken as the IGST. And then we will be having compensation cess. Compensation cess only if given in the question we need to take, so that will be given, and again it should also be computed on assessable value plus step 2 total, that should be taken, and only when it is given in the question we need to take, and we don't have to add GST while computing the compensation cess. So then we have something called as, so last one, SAD, but this SAD is at the rate, again it will be given in the question, so that should be computed on same assessable value plus step 2 total. But remember, this SAD is applicable only in case of petroleum products, not alcoholic liquor also, only in case of that 5 petroleum products this SAD will be applicable. Again only when it is given in the question we need to take, otherwise we don't have to take that. Okay, so remember, whenever there is SAD, definitely IGST and GST compensation cess will not be applicable, and whenever IGST GST compensation cess is applicable, SAD will not be applicable. So because SAD is only on petroleum products there is no GST. Now when you add this, this is known as total customs duties payable. So what is the total customs duties payable? The total customs duty payable in this case will be 11,000 plus 19,980, that will come to 30,980 will be taken as the customs duty payable. So this is how the customs duty computation will be made. So these 9 steps that we need to, like 3 steps and 9 customs duties that we need to remember. Now here what happens is that while computing the GST, GST, we are adding everything. Okay, so now whenever the goods are imported in and deposited in the warehouse, and when the imported goods are deposited in warehouse and thereafter it is transferred, the document of title is transferred to some other person. Say for example, Mr. A is importing the goods and that imported goods are kept in the warehouse. Okay, so imported goods. So these imported goods are kept in the warehouse, customs warehouse. Okay, these goods are deposited in the customs warehouse. When the goods are deposited in the customs warehouse, what A is doing? A is not clearing the goods from the warehouse, but A transferred the document of title. Transfer of documents. So A made the transfer of documents to Mr. B. So now who will be clearing the goods from the warehouse? Mr. B will be clearing the goods from the warehouse. So now when Mr. B is clearing the goods from the warehouse, so Mr. B files the ex-bond bill of entry. So to clear the goods from the warehouse. Okay, ex-bond bill of entry to clear the goods from the warehouse. Now what happens is that how to compute the customs duty payable? Now we need to understand here. So what is the value of the imported goods? Say the value of the imported goods is, say 1 lakh rupees is the value of the imported goods, and whereas transfer of documents for rupees 1,20,000. So now Mr. B is required to pay customs duty on what? So that is where the question is. So this is transfer of warehoused goods by way of documents of title. It is not that Mr. A is clearing the goods. Mr. B is filing the ex-bond bill of entry in the warehouse and he is clearing the goods from the warehouse. Okay, so from the warehouse the goods are cleared by B. So goods cleared by B, goods cleared by Mr. B by paying customs duty. By paying customs duty. Now what is that customs duty that Mr. B is required to pay? So what will be taken as the assessable value here? The assessable value will be taken as 1 lakh, no doubt. The assessable value will be taken as 1 lakh, but what happens to the IGST computation only, it will differ. So basic customs duty will be how much? So the basic customs duty will be, say at the rate of 10% we will take, so 10,000 rupees. Social welfare surcharge will be 1,000, no doubt about that. But while computing the IGST, so we have a computation. What is that we need to do? So say IGST is at the rate of 18% and we don't have any other customs duties. First we need to take A. What is that A? 1,11,000. So we need to take 1,11,000, or B. What is B? 1,20,000. What is the transaction value at which the goods are sold by A to B? So that is 1,20,000. Whichever is higher we need to take, and whichever is higher into 18% will be taken as a customs duty payable. So whichever is higher is what? 1,20,000. 1,20,000 into 18%. So that is 21,600 will be taken as customs duty, like IGST. So the total customs duty will be 21,600 plus 11,000. That will be 32,600. If you see the previous computation, so if the assessable value is 1 lakh, we are having a customs duty of 30,980, but in this case when the assessable value is 1 lakh, the customs duty is not 30,980, 32,600. Why? Because in this case what has happened, Mr. A did not clear the goods, Mr. B has cleared the goods. Mr. A filed the in-bond bill of entry. So basically at the time of deposit of goods in the warehouse, so Mr. A filed in-bond bill of entry and ex-bond bill of entry is filed by Mr. B. As ex-bond bill of entry is filed by a person other than who filed the in-bond bill of entry, so in that case the IGST will be computed based on regular value. What is the regular value? Assessable value plus basic customs duty plus all customs duties. Okay, or transaction value at which these goods are sold by way of transfer of documents to the title, that is 1,20,000, whichever is higher. So on that the IGST rate should be multiplied. So this is what I have given here. In case of warehoused goods sold by way of transfer of warehouse receipt, IGST under custom shall be computed on the assessable value plus basic custom duty plus social welfare surcharge or sale value of such warehouse receipt, whichever is earlier. Suppose in this example, what if Mr. A is only clearing the goods from the warehouse? In that case, Mr. A will pay the regular way. So what is that regular way? 30,980. That is basic custom duty 10,000, social welfare surcharge 1,000. IGST will be computed on 1,11,000 only. Okay. So because if a different person is clearing, then only it will happen. What if Mr. A is selling to Mr. B for 90,000, then what will happen? So then 1,11,000 or 90,000, whichever is higher. So 90,000 only will be taken, or 1,11,000. 1,11,000 will be taken, and on that 18% will be multiplied. So don't forget this provision. Then where basic customs duty is nil, social welfare surcharge is also nil. So we don't have to take any social welfare surcharge. And then additional custom duty, but IGST will be there. Of course IGST will be there, even though basic custom duty is nil, social welfare surcharge is nil, IGST may be there. Maybe import of goods is exempt under customs, but it may be chargeable to IGST. So then we need to compute IGST. IGST compute on what? Assessable value plus basic custom duty and all customs duties. So IGST will be definitely applicable, but basic custom duty is nil, social welfare surcharge alone will be nil. Then we have the additional custom duties. So protective duty, safeguard duty, anti-subsidy duty and anti-dumping duty, these are the additional duties that we have. All these four is for the purpose of protecting the domestic manufacturer. In protective duty, what will happen as per section 6? Protective duty is not additional duty, this is just enhancement to the basic custom duty. If the regular basic custom duty for a product is 10%, so when the protective duty is applicable, the basic custom duty will go to 30% or 40%. That is the meaning of protective duty. So protective duty is levied by the central government based on the recommendations of the tariff commission. So tariff commission in India from time to time will be giving recommendations to the central government. So based on that, the central government will be revising the basic customs duty rate for certain imported goods. And what is the basic relief? Why they want to provide this? So they want to provide relief by way of protecting the domestic industry, so against the imports. What is the extent of relief? Simple, it is increased to the basic customs duty. So is there any investigation? No investigation required, because it is based on the recommendations by the tariff commission, and provisionally also it will not be levied. So finally it will be levied. So as there is no provisional levy, duration of provisional levy not applicable, and excess duty on account of finalization not applicable, duration of levy not applicable, we don't have any specific provision, exemption from levy and even retrospective levy we don't have. Whereas if you see safeguard duty, basically when safeguard duty will be applicable in case whenever, so the exports are being fair. So it is not the mistake of the exporter, it is a mistake of the importer. The importer is trying to import the goods in large quantities, so then safeguard duty will be applicable. So section 8B of Customs Tariff Act, it is levied by central government based on the complaint or information made by the domestic industry. The domestic industry should make a complaint that, so because of these imports in large quantities, the domestic industry is getting affected. So in that case they will be conducting the investigation and they will be levying safeguard duty. So what is the relief? Relief against serious injury to the domestic industry on account of what? So specific, on account of large quantities. So this is general. Serious injury to the domestic industry, okay, to protect the domestic industry they will levy, but safeguard duty is specific. For what reason? On account of imports in large quantities. What is the extent of relief? Usually I told you safeguard duty will be a percentage. So that percentage will be on assessable value or landed value, that will be taken. So to the extent adequate to prevent or remedy, rate shall be specified in the question, and that will be taken on assessable value and landed value. If the question is silent, you please take it on the assessable value. Then next, so is there any investigation required? Yes, required, because this is based on the complaint by the domestic industry. So investigation is required. Till the time investigation is completed, they can levy provisional safeguard duty. For what period? 200 days they can levy provisional safeguard duty. What happens upon finalization? Upon finalization, either the differential amount will be payable or we will get the excess amount. Whatever we have paid, we will be getting that excess amount. Either refund allowed or the differential duty will be payable. What is the duration of the levy? The duration of the levy will be 4 years, plus it can be extended for a further period of 6 years. And what is the maximum period of duration of levy? Maximum will be for 10 years. So this will be maximum for 10 years. Thereafter the safeguard duty should not be levied. So once imposed, initially 4 years, and it can be extended for a further period, but the maximum is only 10 years. Exemption from levy. If it is imported, if there is a product that attracts safeguard duty, and if the product is imported from any country, safeguard duty will be applicable, because safeguard duty is product specific. If you are importing the product from any country, that safeguard duty will be applicable. However, if it is imported by 100% EOU or a unit in SEZ, they are not required to pay safeguard duty. However, if the unit in like EOU, 100% EOU or unit in SEZ is trying to import into their place, and thereafter subsequently they sell it in DTA, then safeguard duty will be payable by them. So however, if imported and cleared to DTA, then it will be applicable. Retrospective levy, no, it cannot be levied retrospectively. Means today they are passing an order for levy of safeguard duty. From today only they can levy, not based on retrospective effect. So then we have something called as anti-subsidy duty. This anti-subsidy duty is because of the unfair export made by the exporting country. So exporting country is trying to make a trade war with India. So section 9 of Customs Tariff Act. So who will be levying this? This will be levied by central government, again based on the complaint made by the domestic industry. So investigation is required. Basically this is on account of serious injury to the domestic industry on account of export subsidy enjoyed in the export pricing. So on account of subsidy enjoyed in export pricing, means exporting country is giving a subsidy to the exporter, because of which the exporter is selling the product to India at a lesser price. That is the meaning here. What is the extent of relief? Again same, to the extent So to the full extent of subsidy allowed in the export price, this is based on a percentage. That percentage will be given in the question. That percentage will be based on assessable value or landed value. If the question is silent, you can take it on the assessable value. And here investigation required because this is based on complaint, and till the time investigation is completed, a provisional duty can be levied. What is the period for which the provisional duty will be levied? So in case of safeguard duty 200 days, now it will be 4 months. And what will happen upon finalization? Either the refund will be given to us or we need to pay the differential duty. What is the duration of levy? 5 years, plus it can be extended for a further period of 5 years at a time. So which means they need to conduct the review for every 5 years, and if they need, they can extend it for a further period of 5 years. And here there is no maximum time limit in this case. And here the one important point is there automatic extension for 1 year. So 5 years over and they have not decided anything, automatically it will be extended for 1 year. In that 1 year they need to decide. If they have decided, it will extend it for further 5 years after 1 year. Otherwise in that 1 year will be the last, and thereafter it will not be extended. So automatic extension for 1 year if not decided whether to extend or not within the expiry of 5 years. That is this. And maximum we don't have any time, so unlimited time, because it is unfair exports made by the exporting country. Exemption from levy. So here the same exemption is applicable, import by 100% EOU or SEZ. So basically this particular anti-subsidy duty is on account of, this is country specific, that country and product specific. So that country which has given the subsidy to the product, and that product is coming from anywhere across the globe, so then there will be anti-subsidy duty. But import by 100% EOU or SEZ not applicable. If cleared to DTA, then it will be applicable. Retrospective levy, yes, it can be levied retrospectively. Today the order can be given for the purpose of levy of this retrospectively within 90 days prior, that is up to 90 days prior to the date of notification. Then you can see anti-dumping duty. Anti-dumping duty is because of the unfair export made by the exporter, not the exporting country, it is exporter. So then it will be like, so that particular exporter who is giving the goods to India, he is trying to dump the goods into India, and as per section 9A, so it is also levied by central government based on the complaint made by the domestic industry. So it is serious injury to the domestic industry on account of imports of goods at a cheaper price. And what is the extent of relief? So basically anti-dumping duty will be lower of dumping margin or injury margin. So dumping margin will be normal selling price in the exporting country minus export price to India, whereas injury margin will be normal sale price in India minus landed value of the imported goods. What will be taken as a landed value? Assessable value plus basic customs duty and social welfare surcharge will be taken. So that difference will be taken as the anti-dumping duty. Say for example, there is an exporter, and that exporter who is in UK, so is exporting the goods to India. So there is a importer in India. Now what happens? The normal selling price in UK, if you see, normal selling price of these goods, normal selling price in UK is, say, like 100 pounds. Normal selling price in UK is 100 pounds. But what is the price at which they are exporting to India? The export price is, say, 50 pounds. Now in this case, what will be taken as the dumping margin? So when they are selling at 100 pounds, why are they exporting for 50? So therefore there will be a dumping margin. And what is the dumping margin? The dumping margin will be 50 pounds. Then the importer in India, when the export price is $50, by the time it will be coming to India, there will be a landed cost. What and all will be added to the landed cost? To this landed cost, we will add freight, insurance, and then basic customs duty, social welfare surcharge. The landed cost came to 90 pounds. Whereas what is the normal selling price in India? So normal selling price in India is, say, normal selling price in India is, say, 125 pounds. So now the difference, if you see, so that is called as injury margin. What is the injury margin? The injury margin will be 125 minus 90, that will be 35 pounds will be taken as injury margin. So what will be the anti-dumping duty? So whichever is lower. So dumping margin or injury margin, whichever is lower, so that will be like 35 pounds will be taken as the anti-dumping duty. So this is how we need to calculate anti-dumping duty. Now what if this normal selling price in the exporting country is not available? Then what we need to do in that case? So in that case, that exporting country is making to a third country. So that third country price will be taken as a normal selling price in the exporting country. Suppose if that export, like selling to third country is also not there. See, normal selling price in exporters country we will take. Suppose if it is not there, what is the price at which they are selling to a third country will be taken. If that is also not there, then we need to ascertain the cost of production plus usual profit margin, like that. So we need to ascertain what is the value of those goods. So cost of production plus usual profit margin, that will be taken as the normal selling price in that exporters country. So that's what I have given here. So basically what will happen? So in this case usually it will be dumping margin or injury margin, whichever is lower. But if the normal selling price in exporting country is not available, remember we need to take export to a third country, or we need to take cost of production plus usual profit margin. And investigation, yes, of course it is required, and provisional duty ends until completion of the investigation. Provisionally it can be levied. What is the duration of provisional levy? For a period of 6 months. And excess duty on account of finalization, yes. So either the refund will be allowed or the differential duty will be payable on account of finalization. Then what is the duration of levy? Here same, it is 5 years plus 5 years after review and unlimited time, and here within automatic extension for 1 year within 5 years if they have not decided. And exemption same, and even retrospective levy also it will be the same. So the provisions of anti-subsidy duty and anti-dumping duty will be same, and basically these two talks about import of goods at a lesser price, one because subsidy given by the exporting country, another dumping by the exporter, and that's why whenever anti-subsidy duty is levied, anti-dumping duty will not come. So anti-subsidy duty and anti-dumping duty are mutually exclusive. Out of these two, any one only will be applicable. Then see this notes. In case of import in large quantities, government can resort to tariff rate quota. There is a concept called tariff rate quota rather than safeguard duty. Tariff rate quota means fixing as to how much quantity of imports can be made by a person. So that is known as tariff rate quota as a safeguard measure instead of safeguard duty. Anti-subsidy duty under section 9 and anti-dumping duty under 9A is mutually exclusive. Then we have some special points in this case. Non-applicability of safeguard duty. In two cases, safeguard duty is not applicable. So safeguard duty is basically product specific. So if that product is imported from any country, safeguard duty will be applicable. However, if the product is imported from a developing country, that product we are importing only from a developing country, and remaining and all we are importing from developed countries. So now import from a developing country does not exceed 3% of the total import of that article into India, then safeguard duty not applicable in case of import from developing countries. Say for example, we are importing a product from one developing country and 20 other developed countries. Now in that case, imports from this particular developing country is less than or equals to 3% of the total imports of that article from all countries together. Then in case of import from the developing country, safeguard duty not applicable. Suppose if you are importing from more than one developing country, say we are importing from 5 developing countries and 5 developed countries. Now in that case, import from each developing country with less than 3% taken together. So in these 5 countries, so which and all countries less than 3%, you group it. And if that group total does not exceed 9%, then also on that group there is no safeguard duty. So articles originating from more than one developing country, so long as the aggregate of imports from developing countries with less than 3% share of imports taken together does not exceed 9% of the total imports of that article, then also there is no safeguard duty. For example, it so happens here that now we are importing from 5 developing countries. So A, B, C, D, E are the developing countries. So these are developing countries, and we are also making imports from developed countries. Now you need to see the percentage of import to total. So the total will be 100%. So from country A we are importing 3.5%, country B we are importing 2.8%, country C we are importing 2%, country D we are importing so like 2.5%, and country E we are importing 1.5%, and remaining balance we are importing from the developed countries. Now so definitely safeguard duty, applicability of safeguard duty. So in case of import from developed countries, definitely safeguard duty will be applicable always. Developing countries, so 3%, more than 3% or 3% or more, so definitely safeguard duty will be applicable now. So less than 3% you take together. So what are these less than 2%? These 4 countries less than 2%, you group it. And what is the percentage, total percentage? 2.8 plus 2 plus 2.5 plus 1.5, so that will be 8.8%. So which does not exceed 9%. So on these imports, safeguard duty will not be applicable. So on all these countries, safeguard duty, that is B, C, D, E, import from B, C, D, E countries, safeguard duty will not be applicable. That is the meaning of this particular statement. Then circumvention of anti-subsidy duty and anti-dumping duty. So when circumvention will happen, you try to escape from anti-subsidy duty or anti-dumping duty, where the usually when you are importing the goods that attracts anti-subsidy duty or anti-dumping duty, you will try to change the description or name or composition of the article to escape from ASD or ADD, or you will import it in unassembled or disassembled form to escape, or you will be changing the country of origin, or in any other manner where you will try to escape from ASD or ADD. Then in that case, whatever product for which you have altered the name, or whatever product for which you are mentioning that you are importing from some other country, or importing an assembled or disassembled form, the existing notification can be made extended to those countries or those goods also. So where central government on inquiry, as it considers necessary, is of the opinion that circumvention has taken place in any of these 4 ways, it may extend ASD or ADD to such other article also from such date not earlier than the date of initiation of inquiry, as the government may by notification specify. Then there is something called as absorption of ASD and ADD. So what people will try to do, that is, in this case there is an anti-dumping duty. What is anti-dumping duty? So anti-dumping duty is 35 pounds. Because of that, landed value is already 90 plus 35 will be 125. So 125 will be taken as the import cost of the goods. So then it is on par with normal selling price in India, and no one will be importing. Because no one is importing, the exporter selling price, like sales will get affected, because of which exporter is trying to absorb this anti-dumping duty. So 35 pounds is the anti-dumping duty. What exporter is doing, he is telling, okay, I will give you a discount of 20 pounds. So because already you are paying 35, I will give you a discount of 20, which means, so now the landed cost, like now what will happen? So far the cost was 125 total, including anti-dumping duty. Now exporter is giving a further 20, so minus 20 means the cost will become 105. So when the cost becomes 105, people will try to do the import. So this is known as absorption, that is to nullify the effect of anti-dumping duty. So the exporter will give a discount by way of reducing the export price, that is known as absorption. Now what will happen? So Indian government can again levy 20 pounds as anti-dumping duty, so like in order to balance it. So existing anti-dumping duty 35, now for 20 extra also will be given. Whatever benefit that was given by the exporter, to that extent here they can enhance the anti-dumping duty, that is known as absorption of anti-dumping duty. You can see here. So absorption, when the absorption is said to have taken place, absorption is said to have taken place if there is a decrease in the export price of an article without any commensurate change in the cost of production of that article, then absorption has taken place. So whenever absorption has taken place, so anti-dumping duty so imposed is rendered ineffective. It may modify such duty to counter the effect of such absorption. So previously they cannot do. Now what they are telling, the existing notification itself they can modify. So to counter the effect of such absorption from a date not earlier than the date of initiation of inquiry, as the government may by notification official gazette specify. Then these old custom duties, I told you already, what are the goods on which we have SAD at present? SAD at present is applicable only on petroleum products, that is crude oil, high speed diesel, petrol and natural gas ATF. Then CVD is applicable at present only on alcoholic liquor for human consumption, petroleum products, tobacco and tobacco products. There only CVD will be applicable. Whereas on all other goods we have only GST. So on import we will be having IGST and compensation cess. So this is the procedure for computation or steps involved in computation of customs duty payable. So these are the various sections that we have related to customs tariff. Then related to rate of duty, one more section is there. This is section 19 of Customs Act, not Customs Tariff Act, Customs Act. Section 19 is applicable whenever you are importing the goods which attracts different rates of customs duty as a package. When you are importing, that particular package contains articles with different rates of customs duty, which rate should be taken. Suppose if the articles are liable to ad valorem duty. Ad valorem duty means what? Whenever the duty is payable as a percentage of value, then it is known as ad valorem duty. Suppose if the rate is same, say for example we are importing camera, DSLR camera, tripod, SD card, etc. and all these articles are taxable at the same rate of 10%, the confusion will not arise. So the same rate will be taken and we will be applying. Suppose if the articles are liable to different rate of duty, now what we need to do, whether separate value can be ascertained. If the separate value can be ascertained, so respective value will be taken for respective rate and we will take, say for example camera 10%, SD card 20%. So for camera 10%, SD card 20% we will be taking, so respective rates for respective values. Suppose if it is separate separate value not ascertainable, and it is a compulsory article, compulsory accessory supplied along with the main article. Say tripod. Tripod is always compulsorily supplied along with the camera. Then in that case, whatever is the rate applicable to camera, that will only be taken for the tripod also. So entire consignment is chargeable to duty at the rate applicable to the main article. This is just like our composite supply in GST. Suppose it is not a compulsory article, single price. See, these two are applicable in case of single price. Separate value means separately we will take single price, but not a compulsory accessory. It's an optional accessory. Say SD card is an optional accessory, lens is an optional accessory. In that case, between these goods, whatever is the highest rate, that will be taken. Entire consignment chargeable to duty at the highest rate. What if in this group one article is non-dutiable? Even that non-dutiable article also will be dutiable at the highest rate as adjacent. Okay, so that is this article not liable to duty also gets liable to duty. So these are the aspects that we have in classification of goods under customs and types of customs duty. The next segment that we are going to discuss is valuation under customs. So valuation under customs is very important chapter for practical like exam purpose. So lot of practical questions will be based on this chapter. So basically this valuation under customs is only one section, that is section 14, and in this section 14 we have assessable value. So basically customs, we have specific duty method and ad valorem method. Specific duty method means when customs duty is payable based on the units of measurement, like when you are importing the goods, so per kg or per quintal or per square feet, like that when we pay customs duty, that is known as specific duty method. Ad valorem method means when the customs duty is payable as a percentage of some value, that will be called as ad valorem method. In this ad valorem method again we have two, that is called as ad valorem method, tariff value and transaction value. Tariff value means what will happen, so the value will be determined by the CBIC with respect to some notified goods. So we will go with that value only, even if the transaction value is ascertainable and the value, transaction value is more or less than the tariff value, but we go by tariff value only if the goods are notified for tariff value. If the tariff value is not applicable, then we will go for transaction value. So what will be the transaction value? The price involved in the transaction will be taken. That is basically this. So what is the assessable value in case of import? That is transaction value is nothing but the CIF price. CIF price refers to cost, insurance and freight. So usually we need to know certain prices differences here. Ex factory price. Ex factory price refers to the price prevailing at the factory gate of the exporter is known as ex factory price. Then FAS, free alongside price. Free alongside price means the price prevailing at the port. So that is of the exporter. So but it is not including loading charges. So usually what we will do is that we will be taking ex factory price to that ex factory price. So there are few prices which we need to understand. Depending upon whatever price that is given in the question, we can be taking. So ex factory price. So ex factory price is one price, and then free alongside price. Free alongside FAS. FAS price is there, and then free on board price. Free on board, that is FOB price. So free on board price is there. Then cost, insurance and freight, CIF price is also there. Now how we will be getting free alongside price to the ex factory price? You add to the ex factory price, you need to add, so freight from factory gate of the exporter to the load port or airport. So freight from factory to load port, to loading port or airport. So that will be called as free alongside price. Now to this free alongside price, if you are adding to this free alongside price, if you are adding loading charges, so there will be some loading charges that will be incurred, so in the port or airport. So that loading charges in the loading port or airport, loading not unloading, loading charges, that will be called as free on board price. Then to this free on board price, if you are adding freight and insurance, from where to where? Exporters port or airport to importers port or airport, so that will be called as CIF price, freight and insurance. So we need to add freight and insurance from exporters port or airport, to importers port or airport. then it will be called as CIF price. So basically CIF price will be taken as the assessable value. So that assessable value is nothing but FOB price plus insurance plus freight. FOB price, we need to take FOB price given plus certain adjustments we need to make to the FOB price. That adjustments is given below. So then we will be getting the revised FOB price. So to this revised FOB price, we need to add insurance and freight. Insurance ascertainable, then we will take actuals. Ascertainable means, so it is like, so at the time of import, the importer is aware of whatever is the insurance charges that is actually payable by him. Sometimes when the container is shared between the importers, so he don't know what is the proportionate insurance that he need to pay till the time the consolidation agent or the logistics operators is giving him the receipt for the purpose of insurance payment and freight payment. So that is called as ascertainable, not ascertainable. So therefore, if it is ascertainable, actuals will be taken. If the insurance is not ascertainable, say the importer don't know as to how much is the insurance that he is payable because the container is shared between two importers, so then it will be 1.125% of FOB. What FOB? Revised FOB will be taken as the insurance. Freight. In case of freight, divide into two: ascertainable, not ascertainable. Not ascertainable, very simple. It will be 20% of FOB. Which FOB? Revised FOB will be taken. Suppose if it is ascertainable, if it is air freight, we need to compare between actual air freight or 20% of FOB, whichever is lower will be taken, because air freight is restricted to 20% of FOB. Suppose if it is other freight, that we will be taking actuals. And basically this freight shall include handling charges. So this handling charges is not at the place of import. So this handling charges, so this freight shall include handling charges not at the place of import. So means unloading charges in the place of import should not be taken. Even this freight will include ship demurrage charges, which is payable by the shipping company whenever they anchor the ship at a outer space. That ship demurrage charges will be included, and lighterage and barge charges for bringing the goods from the ship to the shore. So that is lighterage and barge charges, that will also be included. But remember, demurrage charges will not be included. There are two demurrage charges: ship demurrage charges and demurrage charges. Ship demurrage charges is payable by the shipping company for anchoring the ship at outer space, that will be included in the freight, whereas demurrage charges is payable by the importer when the goods are not cleared within the time limit. So that demurrage charges will not be included in the freight. Okay, so this should be taken. And what are the adjustments that we need to make to the FOB price? The first adjustment is with respect to commission. So commission is broadly divided into two: buying commission and selling commission. So buying commission is paid by the importer to his agent, whereas selling commission is paid by the exporter to his agent. So whenever the importer is paying commission to his agent, that will not be included in the value of imported goods, whereas whenever the exporter is paying the commission to his agent, that will also not included. But when exporter's agent, importer is paying, it's an indirect consideration to the exporter, so that commission to be included. So selling commission, commission to exporter's agent paid by the exporter. So when it is paid by the exporter, it will not be included, but when it is paid by the importer, it's indirect consideration, so it should be included in the value. The other name for selling commission is local agent's commission. So basically this commission is payable by the importer's agent, so importer to the exporter's agent, where the exporter's agent will be in India. So that's why the selling commission is also known as local agent's commission. And then second inclusion is that usually importer will be sending some material, molds and dies or any capital goods to the exporter for use in the manufacture of finished goods which are to be imported. So whenever which is imported here, so the exporter will not charge for the free of cost material which is given by the importer. So therefore the goods will be only for the conversion charges. But as we need to value the value of the imported goods, so we need to take, so whatever is the expense, like whatever is the amount charged by the exporter plus free of cost material sent by the importer to exporter should also be included in the value. So material sent by the importer to exporter, including capital goods or intangibles, these are included in the value either at the actual cost or at the apportioned cost. If it is capital goods, we need to apportion it, used in the manufacture of imported goods. Apart from that, any other expenses which is recovered by the exporter from the importer, suppose if it is before import, definitely it should be included in the value, like design charges, etc. If it is after import, so now we need to check whether it is as a condition of sale of imported goods or otherwise. If it is as a condition of sale of imported goods, like installation charges, even though it is incurred after import, it should be included in the value. Suppose if it is customization charges based on importer's request, it is to be excluded from the value. And remember, these intangibles should be procured from outside India. If these intangibles are procured in India, that will not be included. So these intangibles, whatever intangibles is there, this should be procured. This should be procured outside India then only it will be included. If these intangibles are procured in India, then it will not be included. So these are the adjustments we need to make to the FOB price, and we get the revised FOB price. And next we have rules. So in which case the transaction value will not be applicable. Generally transaction value only will be taken in case of import, that is CIF price, but some cases the transaction value will not be applicable if the importer and the exporter are related, or price is not the sole consideration. Price must be the sole consideration. If it is the price is not sole consideration, transaction value not applicable. Unrelated persons, what if they are related, then also transaction value not applicable. Unconditional sale, so there should not be any condition specified by the exporter to the importer for this goods. And unrestricted sale, there should not be any restrictions. If there is any restrictions, it will not be applicable. Also one more case, whenever the proper officer is of the opinion that the value declared by the importer is not correct based on the comparable imports, then also the proper officer can reject the value declared by the importer. In these cases, transaction value not applicable. So customs officer shall not have any doubt about the truth and accuracy of declared value. If he has a doubt, he will reject. Suppose if the value is rejected by him, or in these cases, so transaction value not applicable, we determine the value as per rule 4. So rule 3 says assessable value equals to transaction value if these conditions are satisfied. Otherwise, assessable value equals to value of identical goods will be taken. So first T, that is transaction value. If not I, that is identical goods. TISDCR. You remember this? TISDCR. T for transaction value. If not transaction value of identical goods, if not similar goods, if not deductive value, if not computed value, finally residual value will be taken. So what does the identical goods say? Identical goods means that goods also imported goods having the same physical features and characteristics and produced in the same country. So we are importing goods from one country means the identical goods also produced in the same country, and whatever goods that we are importing, so is manufactured by one manufacturer, the identical goods should also be manufactured by the same manufacturer, preferably not compulsory. So then it will be called as identical goods. So imported goods having the same physical features and characteristics and quality, imported from the same country, imported from the same manufacturer preferably, then we will call it as identical goods. So that identical goods we need to take, and we need to make some adjustments. What are the adjustments we need to make? Adjustments with respect to difference in the quantity. For example, if we are importing 1000 units, but the identical goods are 2000 units, if they imported 1000 units, what could be the difference in the price? So that adjustment we need to make. And difference in the transportation cost. We are importing to one port, but the identical goods are imported to other port. Had the identical goods be imported to our port, what could be the extra transportation cost that we need to add? Then difference in the commercial level of importation. We are importing from one person, say manufacturer level, but the identical goods are imported from the wholesaler level. Had the goods are imported from manufacturer level, what could be the price? That adjustment we need to make. So these are the 3 adjustments we need to make to the identical goods. And thereafter, if we have multiple identical goods, we need to take lowest of the identical goods available. Lowest of such value shall be considered. And rule 5, we will be taking assessable value similar goods. So first T, transaction value identical goods, then yes, similar goods. So in case of similar goods, what is similar goods? Similar goods are also imported goods, and these are commercially interchangeable. For example, you are importing a refrigerator. So that refrigerator is a double door refrigerator. A single door refrigerator can be taken as commercially interchangeable. That is the meaning. So commercially interchangeable, but it should also be produced in the same country, produced by the same manufacturer preferably, but not compulsory. Now in this case, 4 adjustments we need to make. First, adjustment with respect to quantity, adjustment with respect to transportation cost, adjustment with respect to commercial level of importation. What is the extra adjustment that we need to make? The extra adjustment is difference in the materials and engineering work. So if the single door refrigerator to be converted to double door refrigerator, what is the extra cost? That usually what is the price difference between single door and double door? That difference we will be adding. That is the meaning of difference in materials and engineering work. And if we get more than one value, we will take lowest of such values. When the similar goods or identical goods is not possible, then rule 6 says we can interchange between deductive value and computed value. Either we can follow deductive value first and then computed value, or computed value first and then we can go for deductive value. So what does deductive value says? Rule 7, assessable value equals to deductive value. Deductive value means you take the price prevailing in India and reduce post importation expenses. What is the selling price in India? Immediately after importation you take that and reduce all post importation expenses, you will including the customs duty, so you will get the price at the time of import. Okay, so first you need to take selling price, so minus all post importation expenses including customs duty, you will get the price prevailing at the time of import. Then computed value is you take the cost of production, and you add all the cost including the profit margin and up to the place of importation. So then it will be called as assessable value, that is computed value. So computed value, what we will do, we'll take the cost of production, profit and general expenses, freight and insurance, whatever we have seen. So then we will get the value at the time of import. Deductive value is reverse. So we will take the selling price of the imported goods or identical goods sold to unrelated buyers in India minus post importation expenses including custom duty, we get the deductive value. And rule 9 says assessable value is based on residual value, that is whenever the above is not possible, customs officer will determine the value based on the principles of valuation, and that will be called as best judged value or residual value as per rule 9. Now in this regard we need to understand one important aspect, so that whenever they have given X factory price in the question, so when the X factory price is given in the question, say for example the X factory price is somewhere like $1,000, X factory price is $1,000, and freight from factory to airport or freight from factory to load port, okay, so that is somewhere like $200, and loading charges is $100. Then freight from outside India to India, freight from outside India to India is not ascertainable. Outside India to India is not ascertainable, not available. Insurance also not available. So when insurance also not available, then how to determine the CIF price? So we will be thinking that, so we need to take first X factory price. So we will take X factory price, and that X factory price, so $1,000 we will be taking, no doubt, and add freight plus loading charges, this will be called as FOB price. So what is the FOB price? 200 and 100. FOB price will be $300, that is $1,300. FOB price will be 1,300, and this FOB itself is the revised FOB because we don't have any adjustments thereafter. Now to this revised FOB we need to add freight and insurance. So how much we need to add as freight? Usually when freight is not ascertainable, we will take 20% of FOB. So what is the 20% of FOB? $1,300 into 20%. So 1,300 into 20%, so that will be $260 will be taken. But remember, from this we need to reduce, from this freight of $260 we need to reduce, whatever is already considered in FOB. So this 200 plus 100, why? Because as per ICAI study material, they are telling whenever you are taking 20%, that 20% is from the factory gate of the exporter to the importer's place. Due to that reason, so this 200 and 100 which is already considered in FOB we need to reduce, minus already considered in FOB, already included in FOB. How much is the freight already included in FOB? So that will be like $300, okay. So already included in FOB 200 plus 100, so that will be $300, it will be reduced, okay. So then the freight will be negative, yes, of course the freight will be negative. So 260 minus 300, so the 40 needs to be reduced because the maximum is 20% when the freight is not ascertainable. The moment when you take 20%, the 20% is all inclusive, the 20% is inclusive of freight and freight from so exporter's factory to the importer's place. So therefore the $40 needs to be reduced because it will be minus. So 260, 20% of FOB minus already considered in FOB 300, so the remaining needs to be reduced. So therefore 40 we will do the reduction, and then insurance we need to take. So how much will be the insurance? Insurance will be 1.125% of FOB. So 1,300 into 1.125%. So 1,300 into 1.125%, that will be $14.625 will be taken. Now this will be the assessable value. So what is the assessable value? 1,300 minus 40 plus 14.625. So that will come to $1,274.625 will be taken as the assessable value in this case. So this is how we need to compute. Suppose in the same question, what if in the same question, what if the assessable value is somewhere like $10,000, okay? So that is the X factory price is somewhere like $5,000, then what will happen? So then accordingly X factory price will be $5,000 na, and then freight and loading charges we will be taking freight, and thereafter we will take loading charges. And how much will be the freight? The freight will be taken as 200 and 100, exactly the 200 and 100 will be taken. So this 5,300 will be taken as FOB price, and that FOB price will be revised FOB price. So 5,300. Now we need to add freight. So how much will be the freight? 20% of FOB. So $5,300 into 20%. So that comes to 5,300 into 20% comes to 1,060 minus already in FOB. How much is already in FOB? $300 is already in FOB. So the difference will be added here. So 1,060 minus 300, that will be $760 will be added. So don't add 1,060, add only 760, and thereafter insurance. So insurance will be as usual 1.125% of FOB. So 5,300 into 1.125%. So 5,300 into 1.125% will come to $59.625. So if you add this, this will be called as assessable value. So how much? 5,300 plus 760 plus 59.625. So that will be $6,119.625. So this is how we will be taking. Now suppose what if it is like, so what is the extra point that we have? Only the X factory price is given. Now a slight change we will be taking. So that slight change will be like, what if it is air freight and the actual air freight is also given as somewhere like $1,000. So we have the actual air freight, that actual air freight is $1,000. Then what will happen in that case? So air freight is $1,000. Air freight is $1,000 from exporters, airport, it is not port, exporters, airport to India, to importers airport. So then what will happen in this case? So in this case what we need to do is that we need to determine as to how much should be taken as the X factory price. So say 5,000 is the X factory price, no change in that. So X factory price will be $5,000 and add freight, no doubt. So that will be the same, freight up to airport, okay. Then loading charges, that will also be same. So freight will be $200, loading charges will be $100. So revised FOB will be $5,300. So this is FOB price revised. Now what we need to do with respect to freight? Air freight will be compared with actual or 20% of FOB. So add air freight. So remember, this is important. So air freight, what we need to do, take actuals. What is the actuals? So actuals will be 1,000, not only 1,000 plus 200 plus 100. Why 200 and 100? So because when you are comparing 20%, the 20% is from the factory gate of the exporter to the importer's place. So therefore everything you take from the factory gate to the importer, that is, so 1,000 plus 200 plus 100. So that will be coming to 1,300 or 20% of FOB. What is 20% of FOB? 20% of FOB, already we computed 20% of FOB comes to 1,060. So 1,060, whichever is lower, which is lower, that is $1,060, and to this $1,060 minus already in FOB. How much is already considered in FOB? Already in FOB. So already in FOB is $300 that needs to be reduced. So then the remaining should be added as the air freight, that is 1,060 minus 300. So that will be 760. Sir, suppose if the actual air freight is somewhere like $500, what you would have done? So if the actual air freight is $500, 500 plus 300 plus 100, so that will be 900. 900 or 1060, whichever is lower, 900. Then also already considered in FEB, we will reduce. What is already considered in FOB? 300. Then also we would have reduced that. So then what will be the amount? 760 that we have taken. Then finally we will be taking insurance. So insurance will be same. Insurance will be 1.125% of FOB. So that is 1060. What is the FOB price here? 5,300. So 5,300 into 1.125%. So that will be same. That is $59.625. So you need to add this. So how much it comes to? Same. $6,119.625 will be taken as the assessable value. Okay. So this is how we need to calculate even if air freight is given. So these are the multiple combinations which are possible. So please be careful with respect to this kind of questions that can be tested in exam. Now we are moving on to valuation in case of exports. So what should be taken as a value in case of export? So basically FOB price should be taken as the assessable value in case of export, and we don't have to make any adjustments to this. So just whatever is the FOB price given in the question, you take that. And we have some customs valuation rules in case of export. So that is rule 3 says we need to take transaction value, but this transaction value may be rejected by the officer. So if the officer is not satisfied that the declared value is genuine, and even if it is related party transaction value may be acceptable, and assessable value equals to, suppose if it is transaction value rejected, then what will happen? We'll take the value of like, kind and quality. What does that mean? Just like identical goods. So they're imported goods, they are exported goods, same physical features, characters, etc., produced in the same country and exported to the produced in the same country in India, produced by the same person preferably and not compulsory, and we need to make adjustments, same 3 adjustments: difference with respect to the quantity, difference with respect to the transportation cost, difference in commercial level of exportation. Suppose if multiple comparable transactions are found, lowest of such value will be taken. Then rule 5 talks about computed value. In computed value we will take cost of production plus profit and general expenses. So that's why we will be getting computed value. And suppose if that is also not available, then based on the best judgment assessment, that is residual value, customs officer will determine the value. So based on the principles of valuation, and that will be taken. That is with respect to this exportation. Then we have valuation in case of import of second hand goods. So whenever you are importing the second hand goods, in form A, the overseas chartered engineer should certify as to how much is the value of the second hand goods. If he has given the certificate, that will be taken as a value. Whether the report of overseas chartered engineer is submitted in form A, yes, then that will only be taken as the value. Suppose if that information or that certificate is not available, then we need to get the valuation done through a chartered engineer empaneled in the customs houses in India. So that chartered engineer certificate will be produced in form B, but that will not be taken as a value. So there will be a comparison between value declared by the importer and value as per the report of the chartered engineer and the depreciated value of the goods. These 3 things will be compared. So on comparison of these 3 things, so what will happen? So if there is any doubt with respect to the value declared, so no, there is no doubt. So then the value declared will be taken. Means these 3 more or less it is the same. So value declared will be taken. Suppose if there is any doubt, so then a notice will be given to the importer and he need to give the explanation. After explanation, officer is satisfied, yes, then value declared will be taken. Otherwise the officer will determine the value as per rules. So that is about the valuation in case of import and export, including the second hand goods.